Are we live? We are live. If everyone could please take their seats. Good morning and welcome to the OCC Bank Merger Symposium. It is fantastic to see so many brilliant minds come together to debate the future direction of bank merger policy. As you can see, I am not Michael Sue. Although today I'm going to play him on television. I will be your alpha and omega today. I will be giving opening remarks and closing remarks. As I was told about 90 minutes ago that Mr. Sue was going to be unavailable, I thought this must be what he had in mind when he established agility as one of the 3 pillars of our new strategic plan. I'm going to get us started by offering a few rounds of thanks. First, thanks to all of you who are attending the symposium in person and remotely. I am confident that it will be worthwhile. Second, thanks to all of our panelists. I know many of you have traveled long distances to be here and taken time away from your busy schedules. Third, thanks to Professor Peter Conti-Brown for giving the keynote address, which you'll hear this afternoon, the political complexities of bank merger policy, and intellectual and political history. I can't think of a more apt theme to close out today's discussion. Fourth, thanks to our fellow bank regulators, the Federal Deposit Insurance Corporation and Board of Governors of the Federal Reserve System, as well as the competition experts from the Antitrust Division of the U.S. Department of Justice. Our collective and sometimes overlapping responsibilities in bank merger reviews mean that it is critical we work together toward a consistent approach. We appreciate your input on the symposium and for acting as the moderators of our 4 panels today. Fifth and finally, thanks to all the OCC staff and in particular to Amber Melton and Valerie Song for making today happen. I know your team put in countless hours of hard work and it shows. Before we move to our first panel, I'd like to address 2 questions. First, why it's important to have a discussion now about bank mergers, and second, why we believe this symposium can help to advance that discussion. On the first question, bank mergers have received significant attention during Mr. Sue's time as acting comptroller. There is a robust ongoing debate about the effects of bank mergers on competition, on U.S. communities, and on financial stability. At the same time, many experts have raised questions about the ongoing suitability of the current bank merger standards at a time of intense technological and societal change. As Mr. Sue has said before, he believes the framework for analyzing bank mergers needs updating. Without enhancements, there's an increased risk of approving mergers that diminish competition, hurt communities, or present systemic risks. By the same token, a moratorium on mergers would lock in the status quo and inhibit growth and improvements that could help communities and increase competition. We need to build a better mousetrap so that healthy mergers get approved while unhealthy mergers get rejected. Importantly, this mousetrap needs to be not only theoretically sound and consistent with our values, but also capable of implementation within the statutory criteria for merger review. Consider, for instance, the competition prong of the merger review framework. Bank regulators currently use the Herfindahl-Hirschman Index, or HHI, to access market concentration before and after mergers. The most recent bank merger competitive review guidelines from the Department of Justice establish a safe harbor for mergers resulting in HHI levels below 1,800 points for a given market with a rise of less than 200 points. This approach has a number of positive attributes. HHI is a transparent, empirically proven, efficient, and easily understood measure of concentration. The index is objective, based on a consistent measure of market presence based on deposit share. Furthermore, the use of HHI is efficient in that it is simple to compute and provides ex-ante certainty for merger participants. Nevertheless, in some ways, HHI might have become less relevant since the bank merger guidelines were last updated in 1995. For example, the growth in online and mobile banking and rise of non-bank competitors may have made HHI, which is based only on deposits, a less effective predictor of competition across product lines. This is so because a bank's deposit base may have become less probative of its offering of other bank products. In addition, The size of relevant markets for these products may have expanded exponentially with the rise of online banking products and services, while non-bank competitors have grown to an extent unimagined in 1995. I expect a discussion of the use of deposit share to define markets will be one of the many topics our panelists discuss today. Another key topic for today will be financial stability, which became a mandatory component of merger analysis following the enactment of the 2010 Dodd-Frank Wall Street Reform and Consumer Protection Act. From Mr. Su's perspective, the current framework for assessing the financial stability risks of bank mergers bears examining. As he discussed in a speech at the Wharton School of the University of Pennsylvania last year, there is a resolvability gap for large regional banks in that our resolution tools may not be up to the task. We look forward to hearing perspectives on this issue and potential practical solutions from our panel on financial stability. Also crucial to merger review is the analysis of a merger's effects on the convenience and needs of communities served, from branch closures to changes in product offerings and terms. An assessment of each bank's Community Reinvestment Act, or CRA, performance is, of course, a critical part of this analysis, and we believe CRA performance and ratings are only a starting point. The OCC has heard many times from bankers and community groups on the value of public feedback and community reinvestment plans in the regulatory assessment of bank mergers. Our panel on convenience and needs will discuss the many ways that we may refine bank merger analysis to improve banking services in communities across the nation. On the second question of why this symposium can help advance discussion, in our experience, sometimes it takes an in-person exchange of ideas to spur us to action. To that end, we put great care in making sure that each of our panels today represents a range of views and backgrounds, and we left plenty of blank space between panels to allow for spontaneous conversations. We're honored to welcome such a varied and distinguished gathering of thinkers under one roof, and we look forward to putting today's practical idealism into action. Please enjoy our program.
Thank you, Ben. So good morning. I'm Owen Kendler. I'm the chief of the Financial Services, FinTech, and Banking section at the US DOJ's Antitrust Division. I'll be the moderator today. Before I begin, though, I have to give the disclaimer we always give, just in case I accidentally say anything that's newsworthy. So the views I may express today are those of my own views and not necessarily those of the Department of Justice. All right, so with that out of the way, welcome. Welcome to our first panel. Our panel is on general competition topics. So we may touch on some of the issues of the later panels, but that's not the specific purpose. I do want to thank our hosts at the OCC for making this day possible, especially Valerie and Amber, who've been great and extremely helpful. Now, bank merger is obviously a hot topic these days, and Ben touched on that in his opening remarks. We've seen many large bank mergers in recent years, and that's one of the reasons. There was BBT and SunTrust, and there was more recently US Bank and Mitsubishi Union Bank. But I don't think that's the real issue and why we're focusing on bank mergers today. There's a larger conversation in society on corporate concentration, on competition, and antitrust law in general. For instance, earlier this week during his State of the Union address, President Biden expressed his desire to see more rigorous enforcement of the antitrust laws. So it's out there. In 2021, President Biden also released an executive order on competition in the American economy. And as part of that executive order, he called on, or encouraged rather, the Fed, the OCC, the FDIC, and my agency, the Antitrust Division, to rethink how we go about analyzing bank mergers. And of course, the FTC and the DOJ have been much more vigorous and have filed more frequently actions to enjoin mergers across a range of industries. But let me start by introducing your esteemed panelists for today, and then we will move on to opening remarks by each of them. So first, on my left, your right, Sarah Miller. Sarah is the executive director and founder of the American Economic Liberties Project. Sarah leads the organization's mission and strategy focused on distributing economic power and addressing systemic corporate concentration. Sarah served on President Biden's transition team and was previously the deputy director of the Open Markets Institute. And during the Obama administration, Sarah worked as an advisor to leadership of the Treasury Department and the Center for American Progress. Right next to me is Phil Strawn, professor at Boston College. He holds the John L. Collins S.J. Chair in Finance at the Carroll School of Management. Phil also is a research associate at the National Bureau of Economic Research, and previously, Phil spent 7 years at the Research and Market Analysis Group at the Federal Reserve Board of New York. He received his PhD in economics from UChicago, and he publishes widely in the academic journals, and his research interests include the structure, efficiencies, and risk management practices of the financial services industry. And finally, Raj Cohen. Raj is the senior chair of Sullivan Cromwell, and having served as the chair from 2000 to 2009. Raj's practice primarily focuses on acquisition, regulatory, enforcement, cybersecurity, and security law matters for banks and other financial institutions and their trade associations. Raj has been engaged in most of the major bank mergers in the United States, including most recently TD First Horizon, BMO Bank of the West, and the one I mentioned previously, US Bank Mitsubishi Union Bank. And he has served on numerous committees to advise financial regulators at the state and national level. So with those introductions, I turn to Phil for some opening remarks.
Thank you, Owen, and it's great to be here today. I'm looking forward to hearing the lively debate on these important topics. So I thought what I would do is three things just to open this up, is to sort of start with a few facts about banking consolidation, maybe taking a little bit of a longer view than many of you have, and then talk a little bit about what I think have been driving many of the structural changes in banking, and then end with a few thoughts on implications for policy, which I think is really the key of why we're here. So just in terms of sort of what's happened, I think everyone knows well that we have a big increase in concentration in banking at the top of the distribution, with the largest banks owning an increasing share of deposits and assets, and that's been going on for at least 20 years, probably longer. We have fewer banks, way fewer banks than we used to, and in the last decade or so, we've seen a decline in branches as well. Point two, though, is that the decline in branches is not happening across the banking industry. It's happening really among very small community banks. There you see a very, very dramatic decline. You don't see that at larger banks, and that's because what's going on is large banks have basically been buying smaller banks, keeping many of the branches that they purchase, and only closing some of them. The third point, maybe most important in my view from a policy point of view, is the absence of entry into the banking industry since the global financial crisis. And then the fourth point, which I don't know if everyone appreciates, given all of these big changes, you might think, well, maybe something terrible is going on if we look at local markets, and the truth is nothing's changing. So if we look at concentration, sort of the classic tool that's used to assess a merger, the deposit-based HHI, there's absolutely no trend whatsoever. So let me just show you a little bit of data to back up some of those statements. This is a graph of, in the blue line is bank mergers over the past 20, 35 years or so, and then bank failures is the other line. So the first thing that jumps off the page is that the really big merger wave happened already 20 years ago in the 80s and 1990s. It's continued, but at a lower level since then. This is a graph of the change in branching in banking, but it's going back to 2010, and it's separating banks into three types. Two types are relatively larger banks, or sort of the mega banks, the large multi-market banks, and then the line that's really falling very, very sharply. Those are the small community banks. They're losing branches very, very rapidly. So that's the biggest structural change that we've seen in banking in the last 15 to 20 years. Here's the thing that worries me the most about what's been going on. This is a graph of new charters in banking going back to 1984. And if you go back, you can go back to 1934 if you go to the FDIC. They've been counting this since the 30s. What you saw until 2008 was on the order of hundreds of new bank charters every year. It's a very cyclical time series. It goes up when the economy booms and goes down in recessions. But what really jumps out is post-2008, there's been effectively no entry whatsoever in the banking industry. This is the last factual point I want to make, which is, this is data that I put together for the talk. This is just a measure of the average HHI comparing cities is the lower line, metropolitan statistical areas, and then the upper line are counties outside of cities. And the point here is it's always been the case that areas outside cities are more concentrated. That's the level difference. But there's absolutely no trend in either of these. So all of that consolidation that's been happening really hasn't moved the needle very much on local concentration. Now, we probably should talk about whether this is the right measure or not. But I just want to make the point that this thing is certainly not doing much. So just a couple of thoughts on what's driving some of these changes. So the big changes going back 20 or 30 years really was driven by deregulation. So we had lots of constraints on interstate banking that were removed in the 80s and 90s. And so you could sort of think of there was a lot of pent-up demand to consolidate banking, and that led to a huge wave of mergers in the 80s and 1990s. That sort of is played out. That's not what's going on anymore. The last two pieces, I think, are important to what's going on today. So this point two is the rise of markets. So again, going back 30 years, 40 years, financial markets started to provide products that compete very closely with traditional banking. So for example, the rise of mutual funds in the 1980s, particularly money market funds, is a direct competition for funds that flow into bank deposits. On the lending side, the rise of securitization has meant that lending that had traditionally been locked in the banking system can now be financed using bonds and other sources of non-deposit finance. So there's a lot of competition from the rise of securities markets to the banking system, and that's part of what's driving the structural change. That's really salient, going back 40 years, and it's continuing. The thing that's really new is point three, sort of the emergence of fintech. And this is kind of the last decade maybe, or maybe 15 years. And so you see things like the rise of mobile apps to make payments, companies like Venmo and PayPal and Apple Pay competing for the payments role of the banking system. This is a very, very important change. And similarly, on the lending side, you see the emergence of companies, tech companies that are providing lending to the small business sector. So it's sort of the core of what we thought was very special about traditional banking, taking deposits and making small loans. Those kinds of things are now happening on a greater degree outside the banking system. So just a little bit of data on that. So this is a graph of from another couple of academics who study the role of lending to small business outside of banking. And the first point to make here is that there's not good data to be able to keep track of this. So, one thing that the policy world could do is keep better track of what's going on outside of banking. These people were clever, and they were able to construct metrics outside of banking. And what you see in that graph is how important non-banks are to small business, and that their importance has been growing over time. So that's kind of the theme of the new tech, the new kind of lenders, taking away business that had traditionally been a core for banking. And then if you think about, this is unfortunately kind of small, if you think about the deposit role and the payments role of banking, again, it's being dramatically affected by technology. So this is data, again, I took this from another academic paper. They borrowed this from an FDIC survey. The FDIC has been surveying households about how they interact with their banks. And the question is, do you interact through the branch network or through technology? And what this graph shows is an increasing fraction of customers are interacting with banks through technology, through internet, through apps, et cetera. But the other thing that jumps out here is there's a lot of heterogeneity. So older people, less well-educated people, people with lower wealth are more likely to stick with traditional branch-based banking. And one thing that's important for competition and there's new work on this, the work suggests that these kinds of customers are the ones that are most subject to, for example, market power being exploited in the way bank deposits are priced. The wealthier, more educated, savvier kinds of customers who use technology, their deposits are much more mobile, they're much more price sensitive, it's much harder for bankers to exploit any kind of competitive power over that kind of customer. So a couple of thoughts on the implication of all of these changes for policy, and then I'll let the others chime in. So the first point is, given that banking is now competing against markets and technology for services that they've been providing all along, it's not that surprising that the banking industry is shrinking relative to these other sources of supply for bank-like services. So the fact that the number of banks is declining is not evidence of a problem, necessarily. You have to go deeper if you want to argue something is wrong. Point two, though, when I see zero entry, that worries me, because it's very unlikely that zero is the right answer in terms of entry into banking. So what I would urge regulators to do is take a hard look at the kinds of barriers that you're creating to bankers to create new charters. How difficult is it to get a charter? How long does it take? How many lawyers do you have to hire? How difficult is it to get deposit insurance? All of these things, all these hurdles have to be met before you can enter, and I worry that these are too high. Now, that does two bad things. First, it makes banking less competitive, and second is it pushes banking outside of the regulated sector. Third point is the building of these larger multi-market banks. You may be worried about excess concentration at the top, but there's a benefit there that these multi-market banks can move capital around more effectively, and that's efficiency enhancing for the economy. Fourth point, which was indicated in the opening remarks, is I totally agree that looking at local measures of concentration is becoming increasingly dated and untenable with technology. And then the last piece, and I'll stop, I want to give the others a chance, is there's disparities in the impact of technology across different types of people based on education, generation, et cetera. So those are issues I think that are important to think about. So with that, I'll yield to Owen and the others.
Sure. Next, we'll hear from Raj.
Hey, thank you, Owen, and a pleasure to be here. And I want to begin by echoing our appreciation to the OCC for holding this symposium. It recognizes both the importance of the topic of bank mergers and the value of a true dialogue that encompasses a wide range of perspectives. I think this topic is so important because on a macro level, a strong banking system is essential to a strong economy and an inclusive society. And on a micro level, access to the banking system is essential to the well-being of individuals and small businesses. So I'm going to start with proposing 4 basic propositions that should hopefully help shape the contours of the debate on competition in the industry. The first proposition is that bank mergers as a general category of activity are neither a positive nor a negative for competition for bank products and services. Rather, each bank merger should be individually evaluated on the basis of its impact on competition in the specific relevant circumstances. Second, competition can be adversely affected if markets are unduly insulated for mergers. Third, hopefully everyone would agree that the federal banking agencies and Department of Justice are bound by the standards that Congress has established for evaluating the competitive impact of bank mergers, whatever flexibility Congress may have provided. And fourth, a high degree of predictability as to the outcome of the competitive evaluation of bank mergers is desirable not just for banks, but for their employees, customers, and communities, as well as confidence in our regulatory system. Good mergers should not be discouraged by uncertain regulatory outcomes, and uncertainty of outcome should not be used as a policy tool to deter mergers. In the remainder of my remarks, I want to address 4 contextual issues for assessing the competitive impact of bank mergers. And the first, which Phil has already mentioned, involves an historical perspective of the substantial consolidation in the banking industry since the 1980s, but as Phil also mentioned, really in the first half of that period, with one exception. This is not just an academic exercise, but is central to the debate as to whether the wave of bank mergers since 1980 suggests that the current competitive analysis is inadequate. Now, until the 80s, as Phil mentioned, the American banking markets were highly fragmented by statutory geographic restrictions. Banking across state lines was basically prohibited, and even within states, branching was often limited, sometimes to a single city or even a single location. This competitive structure, as a matter of government determination, was unique among both U.S. industries and every other country with respect to its banking system. In terms of convenience and efficiency, bank customers could not use the same bank if they traveled across state lines to work or to live, or even municipal lines. And the constraint on size of banks could adversely affect their ability to offer the range and scope of products and services that customers sought. But of perhaps most important and often overlooked, the lack of geographic diversification played out with devastating effect in the financial and banking collapse of the late 20s and early 30s. Indeed, Congressman McFadden, the sponsor of the eponymous federal statute limiting national bank branching, later commented that for safety and soundness reasons, the McFadden Act was a grave mistake. In view of the artificial nature of these geographic restrictions, it was not surprising that there was a surge of bank consolidation in the years following their dismantling. And this included not only geographic expansion, but in market consolidation to compete with new, often better resourced competitors. Phil, I think, accurately referred to it as pent-up demand. I could also refer to it, pun intended, as damned logic. The second contextual issue relates to the argument that the growth in size of large U.S. banks demonstrates inadequate competitive analysis. But there are 3 factors which help explain this growth and must be taken into account. The first is the sharp growth in the overall American economy during this same period. Using Federal Reserve estimates, the GDP of the United States has grown by 8.5 times during this period. The second factor was the use of the banking system by the Federal Reserve, first in 2008 and then in 2020, to inject substantial liquidity into the American economy. And the third factor is the rescue acquisitions that were essential to the resolution of the 2008 financial crisis. The litany is there: J.P. Morgan Chase with Bear Stearns and Washington Mutual, Wells Wachovia, Bank of America Countrywide, and Merrill Lynch, PNC, National City. My third contextual issue relates to the assertion that the competitive standards applied to bank mergers are too lax, not just absolutely, but relative to other industries. Let me suggest to the contrary, that the banking industry is subject to a more rigorous competitive analysis than any other industry. I'm going to mention 5 aspects. First, only banks are subject to a statutory national market share cap, 10% based on both deposits and liabilities, and 10%, I think everyone would agree, is far below the level at which a single institution's market share is deemed problematic. Second, in assessing the competitive effect of a bank merger, a key metric The market concentration level above which a merger is likely to be found anti-competitive is clearly more rigorous for banks than for every other industry. For banks, this is an HHI of 1,800. For every other industry, the level is 2,500, 40% higher. Third, and several of these themes have already been sounded, there are multiple non-bank competitors for almost all bank products and services, and that competitive impact is either not captured at all in the competitive evaluation or limited. Fourth, and relatedly, competition from out-of-market banks is not captured by the competitive analysis based on HHIs. And fifth, as indicated, every bank merger must be reviewed for its competitive effect by at least 2 and often 3 government agencies. Each agency has, in effect, a veto right on competitive grounds. And at the risk of encroaching, but only slightly, on a later panel, my last contextual observation relates to the suggestion by some that the competitive analysis of bank mergers should take into account the convenience and needs of the communities to be served, or the reverse, that the convenience and needs factor also includes a competitive analysis. This is what some have described as a neo-Brandeisian approach to competitive analysis. Both approaches, however, should be foreclosed by the statutory terms and their judicial construction. Now, again, this is about convenience and needs as a competitive factor, not about it as a separate factor, which the later panel will discuss. Specifically, and I'll bring out one case, it's called County National Bank Corp. The Eighth Circuit held that the convenience and needs exception cannot be interpreted to allow the courts or the agencies to apply a competitive standard that is more stringent than the antitrust standard. And the Eighth Circuit also made clear that you couldn't do the reverse and impart competition analysis into the convenience and needs analysis. And that decision is particularly compelling because, as the Eighth Circuit recognized, it was overriding a federal determination, a Federal Reserve determination, after it had concluded, that is, the Eighth Circuit had concluded that the Federal Reserve was entitled to great deference. And with that, Owen, look forward to hearing from Sarah.
Well, thank you, Raj. Sarah?
The token neo-Brandeisian on the panel. Just saving the best for last, right? Thank you to the OCC for having me and organizing this really important symposium and inviting me to be a part of it, I think particularly since I am a new voice here in these conversations. I appreciate the opportunity, and I think this is going to be a good and provocative conversation. So, as Owen mentioned, I'm an alum of the U.S. Treasury Department, where I had the privilege of serving in the aftermath of the 2008 global financial crisis. In the years since, I've been very lucky to help lead a growing movement to revitalize our nation's antitrust laws and address the threats to our economy and democracy from concentrated corporate power. My relatively early interest in the consequences of bigness was not unrelated to my experience witnessing the vast economic devastation, widespread human misery, and I would say continuing political instability in American society that the foreclosure crisis caused, or most certainly contributed to. Yet merger policy and consolidation in banking and finance has largely escaped the same level of scrutiny and attention that concentration in other sectors of the economy have been subject to in recent years, for example, like with digital markets. This is certainly not because banking is less important, particularly since we know concentration in the banking sector facilitates concentration across the economy more broadly. And again, that's why I'm grateful to the OCC for organizing this conversation, which can hopefully serve as an accelerant as the Justice Department and banking regulators reconsider merger policy in this critically important market. So zooming out for just a minute from the banking sector, I think both research and looking closely at market realities have made fairly clear that a broad range of harms derive from systemic monopolization. Those include things like higher consumer prices, fewer small businesses, depressed levels of entrepreneurship and business dynamism, more fragile supply chains and shortages, which we've all experienced in recent years, markedly lower wages for workers, particularly lower income workers, which the Treasury Department found make roughly 29% less than they should if labor markets were competitive, regional inequality, worse outcomes for patients as a result of hospital mergers and private equity roll-ups, reduced military preparedness resulting from extreme concentrations in the defense industry, the destruction of sustainable revenue model for local news because of Google and Facebook's monopolization of digital advertising, and I could go on. But to zoom back in on banking, I think we now have a relatively high degree of confidence that banks in consolidated markets do things like charge higher fees for overdrafts, stop payments, and ATMs, making it harder for households to stay banked, particularly LMI households. As you noted, mergers lead banks to lower the interest rates they pay on deposits. We know that bank mergers increase the cost of and decrease the availability of consumer and small business credit. And I think that is the beginning of what we see as an ugly story of unintended and far-reaching consequences that extend far beyond price harms. When banks merge, they close branches, limiting Americans' financial access and contributing to the rise of banking deserts. These closures are frequently clustered in poor communities and often push people out of the banking system and into the arms of predatory financial companies like check cashers and payday lenders. In communities affected by bank mergers, research indicates that households are more likely to accrue unpaid debt, have that debt go to collections, and even be evicted. Bank consolidation has been credibly associated to the rise in burglary and property crime. It has been shown to depress real estate values and inhibit local construction, throttling economic development, and correlated to rises in unemployment, declines in median income, and worsening income inequality. Beyond just consumer well-being, business and entrepreneurs suffer because more concentrated banking markets privilege incumbent firms and limit the entrance of new businesses. We saw this when the PPP program was being implemented. Bank mergers result in a decrease in small business lending, while the loans that small businesses rely on to grow become more costly and new businesses have a harder time accessing credit at all. But I think focusing on these outcomes and challenges, as concerning as they are, is not sufficient. And that's because Congress originally passed antitrust laws and laws aligned with them specific to maintaining open, decentralized markets and banking to, first of all, safeguard against excessive and unaccountable concentrations of private power that could grow to rival the power of the state, and secondly, to foster market structures that broadly distribute individual opportunity and prosperity to guard against a loss of faith in American democracy among its citizens. In the 1970s and the 1980s, we forgot or rejected these long-held, hard-learned, and fundamental lessons that had underpinned America's economic strength and democratic resiliency, forging an entirely new and experimental path based on a new economic theory and ideology. Open and decentralized markets, which Congress intended to be safeguarded, were instead recharacterized as artificially fragmented, but under the governance of this economic ideology, they certainly are no longer so. A year and a half ago, President Biden charged the executive branch with revitalizing competition across the economy, including in banking. And I think it's worth taking just a final minute here to repeat what he said when he did so. The President said, 40 years ago, we chose the wrong path, following the misguided philosophy of people like Robert Bork, whose thinking informs the enforcement of bank merger policy, obviously profoundly still today. We pulled back on enforcing laws to promote competition. We're now 40 years into the experiment of letting giant corporations accumulate more and more power. And what have we gotten from it? Less growth, weakened investment, fewer small businesses, too many Americans who feel left behind, too many people who are poorer than their parents. I believe that experiment has failed. I think it is hard for all of us to admit error, but perhaps hardest for a president, no less one who was not only vice president during the financial crisis and sat on the Senate Judiciary Committee for the 2 decades prior, but setting things right is often impossible without it. I think, the work this agency is doing to set things right is so important and so urgent. Every agency who has a role to play in maintaining open and competitive markets, whether in banking or agriculture or technology, also has a role to play in protecting American democracy. We should all be deeply grateful to the public servants across the administration and here in the OCC who are charged with the exciting work of charting that new path, and I think not a moment too soon. So I look forward to an interesting discussion.
Well, thank you, Sarah, and thank you all for your comments. So So I just want to start off with kind of one general question. Why do we let banks merge? Particularly, why do we permit large banks or regional banks of any significant size to merge with each other, given their current size, versus just block those mergers outright and force them to compete in the market? Who wants to take it? Go ahead, Phil. Sure.
I don't think we want to do that. I think we want to allow better managed, better, more innovative companies expand their markets. And one of the ways they do that is by buying less efficient competitors. That's how we improve over time in general. In the context of banking, I think, and I indicated this in my remarks earlier, a big benefit of building larger banks that are operating in many, many places is it enhances capital mobility across regions and local economies. And that's really, really important because, you know, we all benefit when capital can flow toward its highest return. So that makes us all collectively wealthier in our economy. If we stop mergers and we prevent that from happening, I think we end up with a more sclerotic economy, less innovative than we really want. And just, it's a little bit tangential maybe to your direct question, but just responding a little bit to what Sarah was saying in terms of antitrust. I agree that antitrust policy is very important, but I think the number one antidote to bad behavior that may follow a merger in some places is entry. You know, let someone else come in and fill in the gaps that are being created maybe by a merger. The OCC is not going to get every single merger right, and even if they get it right on average, there might be pockets in the market that are harmed, and we need to have more openness to allow new banks to enter those places, and that's where I'm most concerned, as I indicated earlier.
So I guess, Owen, the way I would respond is to go back to where I started. I don't think mergers are good or bad in the abstract. They can produce efficiencies, they can produce critical diversification, they can produce new products and services, but they can also have a number of the ill effects which Sarah mentioned. And at least with banks, unlike any other industry, and this goes back to the neo-Brandisian theory, there are a series of issues which the regulators are supposed to consider. Convenience and needs we've already touched upon. Financial stability is a key, managerial resources, and so on. I just would like to take one moment to underscore something Phil said, if I may, and that is the absence of entry. It is phenomenal. I mean, if you want to look at graphs and look at entry, it may have been a bit volatile prior to 2008, but since then it's been a flat line at zero. And there is, I think, a reason for this, and there are those who will participate later who probably are much more informed than I, but I think what you saw was a reaction by the banking agencies to the fact that the failure rate in 2007, 8, and 9 of newly chartered banks was very, very high. So as a result, newly chartered banks now have very high capital ratios, making, as a prerequisite to a charter, making it very difficult to justify return on equity. And maybe that's the right solution, but I think maybe it should also be re-examined to consider whether those standards are too high.
Yeah, a couple points. I think at this point, the burden of proof that a more consolidated banking sector is beneficial for American society and the economy is on the proponents of that consolidation. I think particularly after the financial crisis, which obviously was deeply linked to a consolidated banking sector, the promotion of conflicts of interest within the banking sector, there should have been, at that point, a serious, much more serious conversation about merger policy that I don't think happened. I think in general there is this goes for antitrust enforcement and merger policy more broadly, has been a lack of rigor in understanding how markets actually operate on the ground and what market realities are. I think the ideological dominance of the consumer welfare standard, which has failed on its own merits in many cases, has shut down the ability to think more broadly about how the antitrust laws around and merger policy should or should not be enforced and what that looks like on the ground. So, you know, I'll go back to what the president said. That experiment has failed, right? And I think it's incumbent upon the agencies who are building a new way to look at merger policy to incorporate things like conflicts of interest across different lines of business, to incorporate things like too big to fail subsidies that benefit larger banks, to look at how not just a regulatory architecture, but market power might inhibit the entrance of new banks, to take into account consumer harms like privacy and data accumulation in the banking sector, which obviously, particularly because it pertains to consumers' financial information, should be, I think, of a high degree of concern, and then how that flows into the additional potential for anti-competitive conduct. And I think, you know, if you look at a bank like Wells Fargo, which has accrued $22 billion in fines since the financial crisis, there's probably something wrong with a bank that can, you know, weather that sort of wrongdoing without feeling like there is any real incentive to stop it. You know, so my view here is that we've not actually been following the law as Congress wrote it and intended it in merger policy, in banks and in other areas. There have been acquisitions since the financial crisis, which should not have occurred. I think, you know, this kind of brings it down to like a level of a real consumer. But, you know, last night I was just looking at the how kind of consumers were reacting to the BB&T SunTrust merger, and there was a local news clip 3 years in with consumers complaining about not being able to reach anyone on the phone, transactions disappearing, you know, their local branches being closed. The bank didn't respond to multiple requests for comment from the news producer, who was obviously upset by that. So it changes the texture of our society and our communities when you have banking in particular, which is an incredibly special function in our society, concentrated at these extreme levels. There's a lack of accountability in addition to kind of all the harms that we walk through. And I do think it is important to take a really hard look at why we have facilitated merger after merger after merger. You know, for example, we kind of assume that divestitures have some sort of pro-competitive effect, but we don't really look back and analyze that, right? So I think that, again, outside of banking, has begun to be rejected as an adequate remedy to solve or cure for competition concerns. And, you know, I'll stop there, but I think at this point, there is a high burden of proof for proponents of consolidation in banking and a consolidated banking industry to meet.
Okay, so a very good discussion. I now have many follow-up questions coming out of this, but I don't want to take too long. But one thing that comes to mind is, also comes out of the remarks earlier, how geographic diversity through bank mergers helped diversify banks' balances and therefore maybe make them less likely to fail. Yet at the same time, in the 2008 crisis, we saw failures amongst larger regional banks that were geographically diversified and led to issues of systemic risk. So what is the right balance for localism versus multi-geographic markets for stability? And I realize there's a financial stability panel later, but how should that play into merger review policy and competition policy, those kind of tensions on geographic balancing the bank?
I think that it's wrong to blame large banks, blame the financial crisis on large banks. I think that really the better analysis is that we had financial stability in what people call shadow banks, which are basically the unregulated bank-like entities like money market funds. And if you just look at the big firms that were basket cases, they're mostly not banks. They're companies like General Motors Acceptance Corporation or Lehman Brothers or Bear Stearns, the two GSEs, Fannie and Freddie. By and large, now I know there were a few big banks that did fail, but by and large, the banking system was a source of stability in 2008, not instability. People were putting their money in the banking system. They weren't running from banks. They were running from markets. The same thing happened again, by the way, in 2020. So to the degree that we have a financial stability problem in our economy, and I think we do, it's not in the traditional banking system. What's happening is the risks that had been locked in traditional banking 50 years ago, most of those risks, or many of them, have gravitated into the markets where we don't have the infrastructure to deal with panics, like lender of last resort facilities from the Federal Reserve, deposit insurance, all of those mechanisms that were designed in the 1930s and worked really well for 50 years. But they're designed for traditional banking, and that has become increasingly less relevant to financial stability. And what's the link to merger policy or regulation in general? The link is this. When we overregulate the traditional banking sector, what the response of the market is to move that business into the unregulated sector where we don't have the tools, or we make them up as we go along like the Fed did in 2008 and 2020. We don't have, though, the tools in place to deal with panics that we really need. So that worries me very much, and I worry about overreach in using tools like antitrust. This is just going to continue to drive those risks into the unregulated sectors.
You know, briefly, Owen, I would suggest that geographic diversification, it may not stop a bank from failing, but I think experience suggests that it helps prevent bank failures. And I referred at the beginning to the 20s and early 30s, but the second, and I think more, well, it's the more recent demonstration, were the rolling failures in geographic regions in the 1980s. Every major Texas bank collapsed when the Texas economy collapsed. Same thing happened in Colorado. Same thing happened in Oklahoma. And there actually was, I think, a common denominator in 2008. It wasn't geographic, it was product. The mortgages, and particularly the high-risk mortgages, you just roll right through every failure or near failure. It was clearly the failure of WAMU. It was clearly the problem at Citi. It was actually the problem at Wachovia, which had a really good franchise, except it bought a California bank, which was a smaller part of, very much had a portfolio like WAMU. So that was a product issue, I think, not a geographic issue.
Yeah, I mean, you'll have the financial stability panel later. I think I would just say that it's not only just a size question, it's a business lines question, right? And consolidation isn't just about size, it's about lines of business. So I think that did play a role in the financial crisis. And I think that even if you take the most sympathetic posture towards the role of consolidation in banking in the financial crisis, the rest of the kind of growing evidentiary case for the problems that derive from concentration are justify a serious change in the way that we execute merger policy in banking.
I actually think it's a great segue to move on to product market. So traditionally, the regulators and DOJ have looked at Philadelphia National Bank and looked at banking as a cluster of services, either a cluster of all retail banking services and small business services, or the way the Fed does as two separate, DOJ, we do two separate ones. The Fed does one large cluster. But that cluster, I think, has come into question, and I'm wondering if you have views on what should be the core products and services the agencies and the antitrust authorities should be looking at when we look at bank mergers? What services you believe have left that core cluster? What services or products you believe should be included that maybe traditionally have not been? So it's really a product market question.
You want me to take that? Okay, I think if you look at banking, right, this is a question that we'll think about in the context of revising the guidelines. But there is a core function that the majority, I think, of Americans, particularly in lower income communities, rely on: consumer banking, consumer lending, small business lending, right? And I think I worry about an excessive kind of focus on product definition and market definition as facilitating kind of a smokescreen for a broader set of product markets that kind of inhibit the ability to continue to foster competition, if that makes sense. So obviously, kind of commonly when you're trying to evade antitrust scrutiny or consolidate markets, you define markets in the broadest possible way. And I think banking is very unique in that the community rootedness of banks is extremely critical, both for the economic well-being of communities and for broader societal reasons. And to kind of get in conversations about, well, is Rocket Mortgage really competing with your kind of local state or community bank, will probably be problematic in terms of restoring and reviving the type of locally rooted banking structure that I think is important to reestablish.
So I think, at the risk of maybe contradicting myself here, I don't think you can separate your question from geography, because if you're looking at a product which is produced in the nation as a whole, then it's very unlikely to be an adverse competitive impact, or a large region. So I'd come back to, if you have a relatively small geography, that helps define what products you should be concerned about. And to me, I think Sarah actually hit them both. It's the consumer and small business. And small business, Owen, you know better than anybody, is analyzed often separately. And I think that's probably appropriate, but I'm going to make a plea. We desperately need better data. Antitrust analysis will fail without the underlying data, and we don't have it on small business. And whatever could be done would be useful, I think, to enable a robust policy to be developed there.
Yeah, amen on the data. I totally agree with that. Just one thought on bundling. I think actually fintech is a really strong kind of unbundling. So I look at, for example, a company like PayPal, and they seem to be going to great lengths to go after the payments business in a big way, but in a way that avoids getting underneath the thumb of bank regulators. And how do you do that? Is you unbundle. You don't combine deposit taking and lending. Once you decouple those things, you're not a bank under U.S. law, and so you kind of can do more things that you might want to do without regulators watching every move. So I think that's a pretty powerful force. And where it leads is, I think you got to sort of think about antitrust in a little bit of a different way, and that the bundling of services approach is hard to really, I think, justify, for the same reason that I think looking locally is getting harder and harder to justify because of technology. It's hard for me to really stand on the research on this point, though, because the research we have is using data that was generated in the past, and these technologies are changing so fast. I think it makes it very hard to know what the right answer is.
Can I just add one more quick point on that? I think we haven't talked much about the PPP program, but I think that's relevant, right? Because if you look at the economic response to COVID and the policy desire to sustain small businesses through a period of kind of artificial demand collapse, and the really kind of inability of the community banking system to do that to the extent that I think policymakers had hoped to do. And then compare that to the ability of large firms, obviously, to access support much more quickly and smoothly from the Fed. You have a moment in which the fundamental structure of the American economy changed and shifted. And kind of technology-based app lenders were not in a position to support that policy objective. And so, I think it makes a case both for the necessity of reviving smaller community banks, not just, to facilitate a better consumer experience or a better small business owner experience, but in moments of significant crisis, when you want to produce a policy outcome that prevents further consolidation of economic power or sustains important economic values that we kind of hold as a country, you're unable to execute that. So, I think obviously the PPP program was important and effective in a lot of ways, but it was very clear, I think, how the decline of kind of locally based banks really inhibited the ability of a lot of small businesses, particularly small businesses in disadvantaged communities, to access financing that they should have been able to access. And it's a policy choice.
So to pick up on the localism issue, because Roger's correct, product market definition and geographic market definition are intertwined in antitrust. I'm noticing a tension, though, between localism and what has been the fintechs and maybe non-banks are competing to a national level. So Phil, your slides noted that many older Americans and lower income Americans still continue to rely on local banks and bank in person. Yet at the same time, we're seeing new competition at the national level or regional level compete for different parts of that traditional cluster. So what is the right analysis, and how do we as bank regulators, banking or antitrust regulators, how should we view this tension between local and national when we review a merger?
That's a tough one.
Good.
No, I mean, we were talking offline about this, and I don't have an answer to Owen's question. It's just, it feels like we're in an awkward transition now because we do have an important sector of the economy that does seem a little bit trapped into the old way of doing things, branch-based banking, and maybe there are some inequities associated with that, and they need to be protected from policy. But I think eventually, as those people move to the next generation, the problems will become gradually easier to deal with, and the markets will become more national. But I admit it's very difficult to know how to handle that now. And just one more thought on that is that there's a recent paper, 2 recent papers actually, that find evidence that depositors that are sort of left behind in some of these banks that haven't adopted technology are facing bad pricing, that the fact that they're unable or unwilling to use technology to their advantage is being, in a sense, used against them, and market power is being exploited by banks. So that's a worry, for sure.
Anybody else want to comment?
Well, I'll just say a couple things. I think there needs to be a much richer understanding of how large banks exploit market power to affect new entrants and affect smaller banks. That's, I think, a really important area of research and analysis. I also think that one of the reasons to be particularly vigilant about maintaining competition in the banking sector is, to use a very formal term, it is a pain in the ass to switch banks. So you don't have the same, it's like, oh, I don't like this peanut butter, I'll get this other peanut butter. It's really hard to switch banks if you're a consumer. So you lack the market discipline that you have in other types of markets because of the frictions and the switching costs. And banks like that, right? They exploit that. And I think the CFPB is looking into reducing that limitation on consumer power. And it's obviously been something that's been a part of the discussion for a long time. But, certainly I think the larger you are, the easier it kind of is to exploit market power in various ways that limits consumer choice or undermines smaller competitors. And that is why I think there is a particular level of vigilance that's required, since there are those frictions inherent in banking between consumers, small businesses, and other market participants.
So there's been a reference to the community banks, so in the United States, unlike, say, Canada, which is dominated by a few very large banks, the United States has a history of large banks, regional banks, community banks, credit unions, thrifts. Are those banks offering different products and services? Are they differentiated products that we should, when we do a merger analysis, take account of those differences when we review mergers? And does that imply that maybe looking at straight deposits, as Ben mentioned in his opening remarks, maybe deposits alone are missing some of the granularity?
Deposits have always been a proxy, really, for that cluster of services. I have always thought it was a little bit questionable. I think I'm right that the HHIs are originally developed for the steel industry, and looking at deposits as a proxy would be look as if you were looking at how much coke a steel plant bought rather than how much steel it produced. So if you take that analysis and assume it's at least partially correct, again, I do think it makes sense to look at loans, but Ben made in his opening remarks a very critical point. You need transparency, and there just isn't the transparency once you get beyond deposits. Deposits are reported, they're available, everybody knows what they are, and I do think it's just, forget the logic of looking at other products, other services. If you don't have the data, then it's just a feel, and then it's just a free-for-all.
Right. Oh, and to my other part of the question is, do you view community banks as offering a differentiated product from other types of banks? Is there something unique and something we should protect about community banks during a merger review process?
I think yes. I mean, I think that the small business lending franchise in small banks is unique. They use different kinds of information about understanding the local economy better than large banks probably do. But it goes back to what Raj said. It's very hard to assess that without data. I mean, like the lending data that is collected is for banks over a size cutoff, so you're kind of completely in the dark on what the smallest banks are up to. And there's no systematic data on the cost or the terms of these loans, just whether or not there was a loan and how big it was. So for researchers, it's very, very difficult to assess what's really happening around mergers. You can see if the total goes down or up, but that's about it.
So I do think there is something very valuable to preserve with community banks. And with all due respect, they know their communities better than a bank which is outside the community, and that can really help. I don't know what the right number of banks should be. I don't think anybody truly does. 30,000, which it was in, I think, 1925, was clearly too many. I begin to worry as we keep going down that 5,000 is too few, but I keep coming back to Phil's point. It's both banks disappearing and banks entering, and that, unless you get banks entering, the number of banks is going to continue to decline.
I agree. Community banks are important. Surprising everyone. I do think one thing, maybe this is I also agree we need more data. But when you look at some of the behavior of the largest financial institutions, the largest banks, I mean, Wells is the most kind of shocking example. They can behave in extremely predatory ways towards their consumers, towards their customers, in ways smaller banks don't necessarily, right? In the systemic way, right? They don't face competitive pressure. they don't often face sufficient regulatory or criminal responsibility for that behavior, right? So I think it's not just about the improved kind of services or the local rootedness of a community bank. There's also questions around the, I think in many cases, lawlessness around abusing consumers and customers that a bank like Wells has engaged in, and other large banks, right? There is just not the disincentive to abuse their customers in these sorts of ways because of a lax regulatory environment, because of lax competitive pressure, because it's hard to switch banks, because you don't know, because financial, personal finances can be confusing and hard to track, and people are busy and overwhelmed and living paycheck to paycheck. But it is a big problem that you have an institution like Wells who repeatedly violates the law.
I think
Smaller banks aren't engaging in that. I'm upset about that.
Yeah, no,
about
but
that
I mean, just
particular
one thing.
case.
I don't know what you think, Sarah, but I think some of the actions the Consumer Financial Protection Bureau has taken to disclose all complaints about banks publicly, I think that's a step in the right direction. It does provide some discipline to companies like Wells Fargo. I think that's a positive.
I agree. I mean, I think we should look at, for a business like Wells that is such a repeat offender, if there are structural reasons why it's such a repeat offender.
So I do think, look, you can point, and Sarah is doing so, to all sorts of failures at big banks. But this is, I think, very difficult to substantiate that it is bigness which is causing the problem. You can see a number of small banks which, let's look at just one example, fair lending, and see where the cases have been brought. They have tended to be at small banks or smaller banks. And for every large bank, and Sarah, I could not agree more, the abuse of consumer is unacceptable, irrespective, but you also abuse a consumer when some of these small banks went out and made risky loans and failed and left their depositors without banking services and without their money. So I don't think this is a question of big versus small. I think it's a question of character and culture.
I think that would be a great thing to look into, actually.
Fair enough.
Because abuse at scale is more significant than maybe abuse at a smaller community bank, and that community bank might be disciplined by the community and by the market in a way that a large institution that counts 1 in 3 households as a customer would not be. But I do think the prevalence of wrongdoing, consumer abuse, and the ties that might have to either size or conflicts of interest is an important thing to understand.
Yeah, I just would say one piece of data will be, Sarah referred earlier to the PPP loans. When the final chapter is written, we'll see where the real abuse occurred.
All right, so we're running low on time. 1 minute. Well, I'm still going to ask one more question. But so changing topics, I have a lot of follow-up questions I'm just going to forget about. Big question I want to leave on is remedies. So traditionally, we and the other agencies have called for divestitures of bank branches in the geographic areas where we believe there's an undue rise in market concentration and market power. Is that the correct route? Are there alternatives? Should we be seeking more divestitures, fewer divestitures? What are your thoughts on remedies?
I can't say I've done the necessary scientific study, so this is going to be more anecdotal, but I think in those markets where divestitures have been required, the banks which have been the recipients of the divested branches, which usually you get a good deal because there's nothing better for a buyer than a seller who has to sell. have done quite well and become more competitive as a result of the divestitures?
Sarah?
Well, there's been, I think, very little actual rigorous review of the effect of divestitures and the effectiveness of divestitures. My sense is that in many cases, they probably actually facilitate additional concentration because of the dynamic that Mr. Cohen describes. Obviously, the antitrust agencies are, I think, beginning to reject divestitures as a cure for anti-competitive mergers for a variety of reasons, and we've seen in other industries kind of some really spectacular failures, like Albertsons Safeway. It's a delightful story of a catastrophic divestiture that cost communities thousands of jobs and shut down stores, and ultimately the seller ended up repurchasing remaining stores. So I think in many cases, if you want to maintain a competitive environment, there is a very simple solution to maintaining a competitive environment, and that's blocking a merger. I think the burden of proof, it needs to be much higher that a merger will not materially undermine competition. We obviously have seen very few mergers blocked in the banking sector. So.
Oh, and could I just add quickly, sorry, that I think also this is very fact dependent, because you want to block a merger because there is an overlap in a very tiny piece of the entire transaction, and just say, therefore, the entire merger shouldn't be permitted if divestiture can't solve the problem. And so there, I think that is the issue you will see more. You had referenced, for example, U.S. Bank, MUFG Union, or Mitsubishi Union Bank. It was tiny little pieces. So would you block the whole merger because divestiture wasn't satisfactory in these three communities?
Phil, any final remarks? No. Okay. All right, well, thank you for letting us go a little over. Thank you to our panelists. Thank you, Sarah, Raj, and Phil. There'll be a 30-minute break before the next panel, so you can hound these three people and ask them follow-up questions. Thank you all for coming to the panel.
All right, welcome back from the break. Okay, so first let me express my thanks to the OCC for organizing this great forum for discussion on a very important topic. I'm Gloria Hsu, and I'm an economist at the board working on antitrust and merger-related issues. It is a pleasure for me to introduce our session covering economics research on competition. I will start by offering the standard disclaimer that the views I express today are my own and do not indicate concurrence by other members of the board staff or by the Federal Reserve Board of Governors. Furthermore, nothing we discuss today should be taken as an indication of policy decisions or directions. Research on competition in banking has a long tradition going back decades, driven by the many interesting questions that arise, several of which we heard raised in the previous session. There have been active discussions about how we should conceptualize and measure concentration and competition, about the methods we should use to define markets, and about how commercial banks interact with other types of non-bank institutions, among many other topics. Our three distinguished speakers today are presenting recent, in-progress work that is at the forefront of these conversations. We will begin with a presentation by Dr. David Benson, my colleague at the Federal Reserve Board, speaking about the role that geographic proximity plays in bank competition. Then our next speaker, Professor Alan Berger of the University of South Carolina, will present research exploring the determinants of banks' pricing in an account-level data set. Our final speaker is Professor Jonathan Wallen of the Harvard Business School, who will present on the competitive impacts of multi-market contact in banking. Each person has 15 minutes for their prepared remarks, followed for some time for discussion. And with that, I will hand it over to David.
Thank you, Gloria. Since I work for the Fed, I also have to give my own disclaimer. Anything I say today are my own views. They don't represent the Fed. Today, I'm here to talk about the role of geographic competition in banking. Our motivation for writing this paper has already been discussed today to some extent. Banking antitrust is heavily reliant on the HHI, measures of market concentration that take market shares within a geographic area, square them, add them all up, and then try to figure out if they're below certain thresholds for policy. 1,800 in a level, 200 for the effect of the merger on the HHI to increase the HHI. These things have a lot of advantages that have already been discussed. HHIs try to measure substitutability between the merging parties, overall competition, competitive nature of the local area. However, HHIs can also be vulnerable in practice. To use an HHI, you have to define a market. You have to pick some products. You have to carve out a local area. And in a differentiated product setting like banking, those types of lines that are drawn are very difficult to do in practice. And you might be able to draw those lines several different ways, and it's difficult as an agency to draw those lines, to know exactly how the HHI will come out and how competition will be reflected in those resulting measures. So these we call vulnerabilities to the HHI. You might mismeasure substitutability of two particular firms, of emerging banks. You might not convey information about the synergies in the merger. We talked about geographic diversification of risk in the previous panel. There's also synergies that are potentially conveyed in a merger about quality, how convenience might increase or decrease after a merger. And that information is difficult to capture in a market share. And you might overlook other harms of a merger. So we talk a lot about effects of mergers on prices, but in the neo-Brandeisian sense, there are effects on non-price outcomes. Quality might go down or up. Non-price outcomes that other people care about could also change. So what we're going to do in this paper is we're going to wonder if the HHI is vulnerable to missing some of these important things, in practice at least. Maybe in theory it's good, but in practice, given the limitations, what shows up in the data. So what's interesting about the banking industry, even though these vulnerabilities might occur in all the different industries that you might imagine using the HHI, banking has an extremely important determinant of substitutability, information about synergies, and potential non-price harms. That's the proximity of the branch networks of the merging parties. Location in survey data is the most important reason consumers choose their bank. It is by far more important than the types of services that the bank offers and the prices that the bank gives or charges consumers. Location also determines a convenience synergy. Mechanically, if you combine two branch networks into one bank, consumers of that bank now have more places that they can go to access retail services. That's a synergy. If you combine two networks that are far apart from each other, you might diversify certain risks that are associated with geography. Those are synergies that are determined by the proximity of the branch networks. So in our paper, we do a retrospective analysis. We look backward in time at all of the mergers that have occurred since 1984, and we ask, ex post, what are those effects of the mergers, and how did those effects depend on the HHI and proximity? Here's how we do that in practice. We use natural experimental variation from the merger that's induced because some mergers have overlap markets, so local areas where the two merging parties compete with each other. And they also have markets where the parties operated but did not compete before the merger occurred. So that latter group, the merger doesn't really have a mechanical effect on competition. The parties don't compete, at least in the local sense. But the former group, the markets where they overlapped and had overlapping branch networks, The parties have a type of competition that at least the agencies, like the DOJ and the Fed, would use to assess whether the merger has a competitive effect, say in deposit markets. We're going to use a difference in differences strategy. What that means is we're going to compare the overlap markets to the non-overlap markets before and after the merger and tease out the effect of the merger by the differential change in that overlap market. This figure plots every bank merger since 1984 crossed with the local area where the banks compete, and we divide that world of bank mergers that are overlapped into 4 quadrants. So on the vertical axis, we give the distance between the acquirer and the target, and we cut that by the median distance between the acquirer and the target in the local market. It's about 4 miles. So that's that horizontal line. On the x-axis, you see the effect of the merger on the HHI, the increase in the HHI. We give it here in log points to illustrate. But the vertical line there is the regulatory threshold for scrutiny, 200 points. The increase in HHI that would trigger scrutiny by the Fed or the DOJ. So this divides the world into 2 areas, or into 4 areas. Kind of on the right side of the vertical line, mergers that are scrutinized by the agencies. The purple dots are mergers that had close proximity banks. Maybe these banks competed fiercely with each other in a proximity sense. They were scrutinized by the Fed or the DOJ or the OCC or the FDIC. The blue dots were banks that also increased the HHI a lot but were far away from each other. They might have different effects. The black dots in the upper left corner of the figure, those are mergers that neither increased the HHI a lot, nor did they involve very close geographic competitors. So maybe these mergers are the ones a priori that we think are more benign. Maybe they have more synergy or less effects on competition. And then that leaves the group of red dots in the lower left. Those red dots are the potential vulnerabilities of the HHI. So these are mergers that flew under the HHI screening threshold of 200, but involved geographically close competitors. So maybe there were smaller synergies in those mergers, or maybe the HHI mismeasured substitutability of the parties, and there are competitive effects that were missed by the policy. We'll estimate difference and differences for each of these 4 groups, and here's what we find. The empirical effects of past mergers show that the value-driving product characteristics, these non-price outcomes like convenience, branches that people can go to, size of the network, we estimate effects on those, we estimate effects on prices, and then we try to put that all together and get a sense of how consumers maybe valued these different effects all together with their utility functions in the analysis of quantities. Close proximity mergers that fly below the HHI screening thresholds led to more branch closures, they reduced convenience for people, and they had disparate impacts. So what that means is close proximity low HHI mergers had effects on consumers that were bad in some parts of the market and good in other parts. We also find that close proximity mergers that flew under the HHI thresholds led to lower deposit interest rates, which is bad, and they reduced deposits growth, which suggests that kind of consumers' willingness to pay for those banks that merged in that group went down. So our evidence altogether suggests that antitrust policy, potentially misses some adverse outcomes of mergers just by focusing so much on the HHI, and that using an objective criteria based off of something like proximity could result in better screening or enforcement outcomes. So, we could stop there. I'm just going to show you some pictures from the paper to illustrate what I mean by these effects. One of the leading results that we have is that close proximity mergers cause branch closures. Whether or not the HHI goes up by a lot or a little, it doesn't seem to matter. Close proximity seems to matter. So what I'm showing you here is the difference in difference estimates going backward in time. The closer those lines are for -4 to -1, closer those are to 0, it's good. It means that our markets in the control group are very comparable to the markets in the treatment group. The merger happens, that's that vertical line. All of a sudden you see an increased probability of branch closures, total branches goes down. The merging parties close branches. They reposition their branches, they get rid of them. The purple line is markets where the HHI increased by more than 200 points. The red line is markets where the HHI did not increase by more than 200 points. It doesn't seem to matter. Close proximity matters. The next thing we look at is more interesting measures, perhaps, of convenience. We measure the distance between consumers and the branches in the network, and the distance between consumers and any bank in the market. We take different stabs at this in the paper. If you're interested, take a look. What I'm showing you here is the distance between consumers and the bank that acquired in the specific transaction. All of those branch closures that we just saw have effects on distances to consumers in the market. What we find for mergers that increase the HHI by more than 200 points, but were also close proximity, roughly 15%, so adding those purple dots together, roughly 15% of the market experienced an increase in distance, reduced convenience to the acquiring bank. This is despite any synergy. So the acquirer gathers new branches. Despite all of that, the closures and the repositioning of their retail network reduces convenience for 15% of the market. The mergers that flew under the screening thresholds, the red line, also reduced convenience by less, but they also reduced convenience. It was missed by the HHI. And then the black line, those are mergers that neither had close proximity, nor did they increase the HHI very much. These are the benign mergers that we might expect, and they appear to be benign in our regression results. We also see adverse effects on deposit interest rates. Here I'm showing you the deposit interest rates of competing banks, so not even the banks involved in the merger, but banks that compete with them in the local area. Those banks reduce their deposit interest rates when the merger involves firms that either increase the HHI a lot or are very close competitors. They don't seem to increase their prices after these more benign mergers of far or low HHI merging banks. So competitor deposit rates go down. We have some mixed evidence about the prices of the merging parties, potentially for various reasons, including uniform pricing incentives of the banks themselves. So what does all this mean in my last couple minutes for antitrust policy? Going back to that scatter plot where we divided the world into 4 quadrants, the current policy is essentially the vertical line, the HHI thresholds. You might imagine a counterfactual policy where you use a horizontal line, you use a distance threshold to increase scrutiny or even to trigger scrutiny in the first place of merger transactions. We do a few different such policies in the paper, and we don't have the apparatus to really predict what the world totally would have been like. We can't predict consumer surplus or welfare. We can't predict prices. But what we can do is just add up the number of banks that would have been subjected to additional scrutiny or to additional enforcement under these policies. So here I'm showing you a 1 mile threshold. The upper left, kind of unshaded areas, these mergers wouldn't be scrutinized by such a counterfactual policy anyway. Also, the shaded area to the right of the vertical line, those mergers were scrutinized and weren't subjected to enforcement and would be under the counterfactual policy. So the new ones, the kind of lower left shaded area encompassing some of those red dots, say after a mile, within a mile proximity, would be subjected to more scrutiny or potentially more enforcement. What do we find? HHI alone overlooked a lot of 1 mile proximity transactions, about 75% of 1 mile proximity transactions. Proximity, if you enforce this screening threshold in addition to the HHI, would have basically doubled the number of mergers that the authorities looked at, so 120% increase if we used a 1 mile threshold. And for those kind of special mergers, extra bad, the ones in the far lower right, the purple dots that are both below 1 mile in proximity and to the right of the 200 HHI threshold, we would have probably put extra enforcement on 54% of those mergers. So, I think I went too far. So what's the conclusion here? We can look at past mergers. We can estimate the effects of those mergers using econometric techniques. And we can condition those effects on observable characteristics that the agencies would have before the merger occurred, like the HHI and proximity. We do that, and we find that close proximity, which is outside the policy, identifies a substantial number of transactions where the HHI was vulnerable. More branch closures, smaller synergies, reduced convenience, desperate impacts on different types of consumers that we know from the last panel are more likely to be low or moderate income, perhaps, or older consumers. It led to worse prices and reduced deposits growth. So people obviously didn't like what happened in those cases and took their money to banks that didn't have these adverse effects. So we might consider, as antitrust policymakers, so we've been pleading for data. I think extra data would be great, but it would also be a great plea to consider perhaps reforms to practice that are practical and make use of the data that are available and the imperfections therein to identify more transactions of close substitutes that might be missed by perhaps crude measures or crude market definitions. Thank
you, David. All right, so now we have a couple time for a couple questions from me. I'll start off with, given that you're looking at this branch distance, do you think that any of your results affect the way that we should interpret geographic banking markets?
Yeah, I think excellent question. So there's a couple ways to interpret our results. One is certainly that geographic banking markets used by the agencies are very broad, and you could narrow those markets or perhaps make them more merger specific and improve those geographic markets at least in a transaction by transaction sense. There's also a sense, I would say, regarding a policy is that that's a very information intensive exercise. Potentially it requires so much information that it's impractical. So, you might consider alternative screenings like just a proximity threshold to trigger review, and then you could define better geographic markets afterward.
I think that's pretty interesting. Would you also, so maybe conditional on the geographic market that we posit, is there another interpretation as to whether or not there's just variation in the closeness of competition for competitors that fall within that definition?
Oh, yeah, certainly. And we kind of know this not just from our paper, but from several other papers. Kate Ho and Joy Ishii have some work that estimates price elasticity, so consumer responses to prices conditional on how close and far the two substitute banks are. And in their work, you find close geographic proximity banks have much fiercer price competition than far. So that's prices, but there's also the convenience, the quality that is very location determined, and there's almost like a mechanical way that type of competition for quality, for convenience would enter into that. Yeah.
Okay, now I think that's a pretty interesting discussion. All right, so a slightly different topic related to your research. So as we were discussing in the previous panel, there's a lot of traditional commercial banks and newer fintech firms that are doing a lot of their business online. And then how, if at all, do you think that those types of trends affect any implications for your results in terms of policy recommendations or just how they apply?
Right. There's definitely a lot to say about that. The first thing I would say is introducing new competitors to a market, fintech firms, things like that, that doesn't make the existing competitors less close substitutes. So banks are going to still compete with each other locally, whether or not you add an internet bank into the mix. That's just adding additional competition, but that competition that existed between the two local banks is still there. So that's important to think about. So the effect of the transaction, we think about how overall is the market competitive? Is the local area competitive? Does adding more substitutes in, improve outcomes? Certainly. But to the extent that there's two close competitors, the transaction merges them and gives control over those entities, you might see a competitive effect, no matter if you include internet banks or not. The second thing I would say is fintech firms, shadow banks, they're not banks. They don't have deposits for the most part. If they're going to make loans, if they're going to engage in these pseudo-bank activities, they have to get their funding from somewhere. Where do they get the money? They get their funding mostly from banks. So it's not like these are total outside entities of this sector. The sector, even with shadow banks, is very intertwined with the banking industry. And our current policy apparatus doesn't necessarily take all of that interconnection into account, especially with all the nuances that are there. But it's not like banks are gone from this competitive environment. They've, in some product markets especially, have just become funders of the non-banks that they end up competing with in the retail service. Another thing maybe to add is, retail products are themselves a special product. So, you have to go to a bank branch to get a cashier's check. You have to physically go to an ATM to draw out cash. Those are in-person, location-driven, geographic competition-determined outcomes. An internet firm or a fintech firm or some other pseudo or non-bank, shadow bank, has a difficult or impossible task of replicating the production of those goods and services. So to the extent retail competition is its own product, introduction of these other alternatives is less important, and that bears out in the data. So we know, we don't know locally how big fintech is, but we know kind of nationally how big fintech banks are, and we know that online banking shares, market shares at a national level are pretty small relative to banks that have brick and mortar services.
All right, no, I think that brings up a lot of really interesting issues there. In terms of the data that you would think to use to kind of get at some of this activity, is there a way to incorporate that into your distance space, or have you thought at all about that?
We've given a lot of thought. I mean, in a sense, the whole exercise we do is basically in a world of imperfect data, what's your second best or third best? What are practical solutions? If you had more granular deposits data, say very local deposits data that reflected the geographic nature of competition better, that would go a long way probably toward, even within the current frameworks, improving the assessment of mergers, of bank mergers. Certainly, in the last session we talked about how poor some of the small business lending data, and we know from research that small business lending is a very local market for the most part, geographically very local. So the data being highly aggregated across space are at odds with the local nature of competition in small business lending, and having local small business lending data could probably help the regulators do a lot. So tying the data to this need for geographic, for reflection of geographic substitution between merging institutions and the non-merging parties in the local area would probably help.
Okay, great. Thank you, David. So now we'll move on to our second speaker, Alan.
Thanks very much. Hi, I'm Alan, and my co-authors Lynn and Troy are here, so you can bother them with the difficult questions. And of course, they have to worry about the FDIC, so we're going to assume the disclaimer. So we're going to talk about bank competition, but this is a conference on bank mergers. What does competition have to do with mergers? You all know the answer. It's everything. Everything is about competition. And we've known about the benefits of competition for a very long time. We kind of think economics kind of started with Adam Smith in 1776, so we should have right then done something. It's 187 years after that before we decided, competition should be applied, analysis should be applied to bank mergers. And the most brilliant economists involved thought that up. It was the Supreme Court of the United States, and we talked a little bit more about this Philadelphia National Bank case, which I won't read. But basically, the Supreme Court said you have to consider competition mergers, various details, but we don't need to go into all of those right now. And the party began. So that means that we started analyzing the effects of bank competition seriously for merger analysis, and we've been doing it for 60 years, and here we are again. We're doing it. I think it's great, and I appreciate the invitation to talk about it. So actually the whole time, all 6 decades, a lot of stuff is going on in the Chicago Fed, the conference for 50 years, and all about the Supreme Court case, and a little bit more generally, we looked at what is the effect of competition. It's really important, and lots of quality research papers that maybe wouldn't have been done before. It started a lot of research careers. You know anybody who has research career based on that? I'm Alan, that's me. That's my career. I was at most of those conferences, not the whole 50, but not in 63, not that. Okay, but anyway, but it also continues today at all the banking agencies, the Justice Department. We're looking at this competition in banking at universities around the world. I'm still doing it at a university. It's really very good, and this is the panelists and other papers. I was really, really great that we're still focusing on this. So, and actually, it's even beyond this because in industrial organization, which is sort of the part of the part of economics generally that looks at competition, actually banking is pretty much their favorite topic. They have trucking and airlines and other things. This is the one they do. So we see on the screen there, Bain, that's the structure kind of performance hypothesis. Baum, Panzer, and Willig is contestability. Shepard is relative market power. It's all got to be applied to something, and banking is a great place to apply it, and they do it. And so we have the most important topics like bank merger analysis, regulation, deregulation. All these topics are related to competition, and it's a great choice to do it. And guess what? Banking has the best data sets. We have a lot of complaints today about data sets. Okay, they're not insufficient. They're the best. They're the best. The public data sets, the private data sets, these other deal scan, everything. This is all about banking, private sector, public sector. Really good data overall, really, you have to say that. And so the research traditionally focused on HHI and these other measures we're talking about. I call it traditional external competition, what's going on in the market. And that's kind of the way the research got started. HHI, if we have these core no competition, it tells you what price and profits will do, and that's what it was. We looked at bank profits, interest rates on loans, interest rates on deposits, function of the HHI, and it got more sophisticated over time. Other measures like financial health, efficiency, number of branches, and so forth. And we're seeing another extension right there. And, Jonathan will come up with another one later on, which I already know about. And then other issues, competitive strength of the bank itself, it depends how strong it is. Relationships. Relationships is an enormous topic in banking, and it affects competition too. And then a couple of these external competition things maybe aren't looked at as much, like the effect of large banks on community banks and the effect of competition from credit unions. So there's a lot of stuff, going on, and but maybe not perfect. So actually, the research in this paper, we're going to be a little bit different. So normally, this research, you look at one thing. You look at HHI or something else. Maybe you hold constant. Control variables, one of the other two others. And it's not a criticism, but if you don't control for the other ones and they're correlated, it doesn't work very well. It's not a complaint about anybody. It's not a complaint. You use what the data will allow you to do. So you need to have escape from that reality. And so I put a little, I don't usually put my jokes on the screen. I put that one on, so I want to laugh on this one. So we're going to escape from reality, but now with drugs, but with better data. So, all right, thank you. Okay. So we're going to employ what we call an extraordinary data set, and we're going to comprehensively test. We're going to test all these 5 facets of competition together, and we get 2 things out of it. One is that we get a lot of different answers, and then we're also controlling for the other one, so it's pretty good. And we're going to focus on community banks because they're the ones subject to the competition, really. And big banks, there's not enough of them, really. You get better answers for the community banks. There's a lot of them. Okay, and so we have 800,000 deposit accounts, over 500 community banks, over 20 years. And that's enough. You can get statistically significant results. That doesn't mean they're always right, but you're going to get those results. And we get pretty interesting results for all 5 facets. And data even better than that because we have account-level deposit information, or certificates of deposit on the days they're issued. What's so good about that? The rate is set on the day. You know what the competitive market is on that day. We got deposit location, amount, origination, all kinds of stuff. And really, for a certificate of deposit, that's the only product. you just get some money back in 8 weeks or something when it's done. So there's differences in quality of product. There's any. It's very good, and then actually and the spread on it doesn't change a lot. So even if the bank gets worse or gets better, it's still there. It's still an accurate measure of what it was on the day that it was issued. So now, you also, how do we measure this company? So we just heard about proximity and so forth, and there's always a problem with measuring HHI in markets. There's no way around it here, and we typically look at markets. We define them as MSAs, rural counties, or whatever, and we normally do the competition around the bank. Is that right? Is that really exogenous? So if I have a depositor, where he chose his bank, that's endogenous. So it's best if we can actually make the market around the depositor. So we draw a little circle around the depositor of a certain number of miles around. I won't go into detail. And that's pretty much you don't move to a place for your banking. You just move there because you have your job or something. And then the actual banking, what happens there after that's endogenous. And if you pick the bank branch beforehand and look at the effect of competition, it's already too late because that's already been chosen. So I don't want to go into the econometric details, but I think you probably get the idea here. So now, there's always a catch. Great data set, there must be something wrong. Yes, there is. The data are all from failed banks. We plead about the data. Well, failed banks have great data. FDIC has their whole books. We can look at every little thing there. And that's going to create some sample selection issues. And we try as best we can to, assuage these concerns. They're not perfect. So we look at the time of issuance. It's not when they're failing. So, presumably people don't know the bank's going to fail. And we do other things like, do it only at least 6 months before the failure. Look at ones with camels 1 and 2, so they're pretty good at that time. And look at insured deposits, they're not going to run anyway. It's not perfect. And when we think about the main part of the price is determined by the other banks. You don't just set the price based on one bank. It's the other bank's market. They're not all failing, so something. And we do the best we can to account for the health of the bank. Not perfect, but pretty good. Okay. So we have lots of interesting results, all these 5 facets. Tough luck. I don't have enough time to tell you. So I'm going to go with one of the facets, which I think is really important and really under-researched. And you're going to ask me later on, what are you doing that one for? It's credit unions. So the credit union competition is normally not looked at. Doesn't exist primarily in the bank merger analysis. It can be considered later only if you fail that first screen of the 200 and 1800 that you heard about earlier. If you don't fail that, credit market competition is not considered. That could be a problem. And also, this seems to be a big social issue here, that the community banks are complaining about this. I'm sure you've heard this before. They filed lawsuits, it's unfair competition, they don't pay taxes, how dare they? They have these common bonds and all these other things. It's very unfair. So when you hear arguments like that, what do you think? Do you just believe them and just say, oh, well, it must be right if they're upset about it and everything else? No, you say, well, let's think about it. There might be 2 sides to every argument, so let's look at both sides. Okay. It could be that they're right. Credit unions are really strong competitors. They don't have to pay taxes, so they can just afford to give the depositors a better rate. What do they care? They don't have to pay taxes, and it's unfair competition. And we know that consumers kind of trust, from surveys, they actually trust the credit unions more. They like this cachet of we're nonprofit and serving the community and things like that. So they kind of have a lot of advantages. And so maybe they make the banks in their markets with more credit union presence, they make the banks have to pay higher rates, and it's kind of unfair competition. It could go the other way, though. So it could be credit unions might be weak competitors, and And they kind of have a little bit more narrow product mixes. There are certain rules about that change over time, what they can do. They normally have fewer branch offices because they have these restrictions on common bonds and so forth. And, and so maybe they're not as good. And you know what? Maybe this, getting away from capitalism, we don't have a profit motive. Maybe we don't work as hard. It's often thought that might be true. So maybe they actually are worse competitors or weaker competitors, and actually it's a benefit to the community banks to have more of these things around. So which is it? Which is it? You know what the answer is going to be. It makes it more interesting. It's the opposite of what the community banks say. It's actually they're weaker competitors. If you have more credit unions around, you pay a lower spread. It's good for the community banks, or so it would seem. And I didn't want to show you too many regressions, but here you can see you do the samples different ways, different things. You always get the same result. A minus sign means you pay a lower rate, and a t-statistic of over 2 means it's statistically significant. And we got lots of observations. Some of these are a little bit, it's 300,000 observations because a little bit less data on these credit unions, but it seems to be good. So the credit unions are actually weaker competitors. That's actually good for the community banks to have more of these around. It's research, so you can't. We have to say the data suggests that this might be true. That's how we have to say it, to get in journals and everything. But that's what I'm saying. So so we're out of time here, and I'm finishing before the 1-minute mark, so we'll have a little extra time for questions. Lynn, Troy, and I tell you have to read the paper, but you don't have to. We'll just hang around here, and you can bother us at lunch and not let us eat. That's okay, we don't mind. And we'll be around. But it's really great to be here in person. I want to hear the comments, and just the reason why we have conferences to confer. So please harass me with your questions afterwards. Thank you.
All right, thank you very much, Alan. All right, so I'll kick off some questions. All right, so as you mentioned, you've covered in your paper a bunch of different determinants of these bank prices, and today you talked about the credit unions. But given the topic of our symposium, how do you think how do you think any of those would be impacted by a merger, or in what way? And how should we think about that in terms of merger analysis?
I would say in terms of bank merger analysis, the biggest contribution to our paper today is really, let's think about how we might incorporate this credit union data, because, as I say, in our frontline analysis, or I forget what you call it, but the safe harbor, you can get away without considering the credit unions. If the 1800 and 200 are not violated, they're not even considered. And so I think it's really important to see this. If they came out to a 0, forget it. It doesn't matter, but they do matter. And so when we're considering even just a bank merger, 2 banks merging, we need to know really if the credit union presence is significant or not. And that would be, and also note that we didn't really make a big deal about it in the paper, but this, we're seeing more and more here this issue of, well, what are these markets? And I think, somewhere down the road, we might want to think about how we define the market. And of course, we don't have data on every depositor all the time. But when we talk about what data would we like, we'd actually like to know where the customer of the bank is, not just depositors, small business, and so forth. And that would be a better way, really, to see what is the effect of mergers. Let's see what happens where the customer is, not where the banks are. I think it'd be better.
Thanks, Alan. And on that note, so maybe you could explain a little bit about your data. You are observing customers at their given location, but then for the credit unions, are you just observing their branch locations, and that's kind of the best thing that you can do for measurement there?
Yeah, the credit union data is not as good as the banking data. So we don't really have reliable data on their financials. So we just go with the share. There may be something else I'm not aware of. Try to do all the work. So I haven't had a job since 1989. Just so you know, I've been doing research all the time, but I haven't touched data since 1989. I get other people to do it, so sorry about that. So I can't always answer those questions.
Yeah, I think
I'm still working, but I just don't have a job.
sounds like an interesting life, Alan.
It's pretty good. That's like half of it.
So to that point, really what you have here is this data set that's like pretty unique that comes out of these FDIC bank failures. And then my understanding is it's also your focus is on the community banks as well, given the set. And I think that's like, as we were discussing in the earlier session, that's a pretty important set of institutions. But nonetheless, like we have mergers that we're looking at that are between many, banks across the entire spectrum. So what advice would you give in terms of interpreting any of your findings, kind of like how can we interpret those findings from this particular data set and draw any lessons, if any, for any of the other contexts?
Yeah. So I think, there's so many things to worry about with bank mergers. Some of the things you should just worry about more than less. In my opinion, the ones we want to worry about are the customers, really, of the small banks. The community banks, the community banks are the ones that are disappearing. The big banks, they're not really going anywhere. When they go somewhere, they're absorbed into another big bank, so they're not going anywhere. And analyzing the big banks by themselves, it's not that good of an exercise. There just aren't enough of them. The data are just not rich enough. We can really understand what's happening with the community banks, and that's where we want to do it. But for all of these bank mergers, whether it's two big banks getting together, big bank buying a small bank, two small banks together, we always want to consider whatever we can, the best information about their markets. And just, if we're not considering the credit unions, we're not including everything. If we're not considering where the customers are, we're not including everything. And I don't have all the answers. Again, it's easy if you don't have a job to criticize people who have jobs. Some people have to collect the data. I don't have to do that, fortunately. Very privileged position. Be a college professor, I can do whatever I want. I have to teach my classes, but other than that. So, but my recommendation is, take this research seriously if you're a regulatory agency. And I'm always available. I answer the phone every day of the year for anyone that calls me. If you want to talk about it, I'll give you 5 minutes at least. And, the research can really inform some of these things. So,
yeah, I think that's really helpful. And you started talking a little bit there about how kind of these different types of banks and the credit unions and other institutions would be like, we are differentiated.
Yeah.
And also kind of alluding to market definition. Are you suggesting like maybe it's important to have the data that can really, speak to the ways that these things do interact, but also like talk about that differentiation as in, most of what we have is deposits.
Yeah, let me go back to what we were discussing in the previous panel, because I think it's a very interesting discussion, particularly Phil came up with discussion of what's going on here. So initially, why do we even have consolidation? So, initially deregulation, 80s and 90s. Okay, we know that. That's kind of obvious. He said the rise of markets, and we know that. It's actually partly technology too, because technology. Before the 70s, you couldn't have money market deposit accounts because you couldn't chop up the treasury securities into little pieces because the computers couldn't do it. But you got that. And then the rise of fintech and these other things where you use your telephone and everything else. But the other thing I think we're all obligated to do is look to the future. We can't do that much about the past. It's there. Everybody knows it's path dependent, but the future is a little less path dependent. So there's one area which I think we have or maybe two areas that on data that we haven't really thought about very much. So one is, Phil mentioned, this kind of unbundling where you go to fintech, everybody does one little thing, they avoid regulation, everything else. But there's another way it can go, and I call it big tech, where Alibaba was the first firm to kind of go this way, and the government doesn't like them very much in China, but they want to give you banking with this, Alipay and Ant and all these other things, and WeChat and everything else. And in the US, we haven't really quite gotten there, but just think about it. We don't know where we're going in the future. Nobody ever knows. But if these technologies keep getting better, we may have Amazon and Facebook and those gigantic firms. They got this tremendous data set. They got everybody's preferences from all over the world, Google. And if they get into banking and they offer a service, okay, here's your banking services. I'm gonna give you, instant messaging, social media, watch a movie, buy a lamp, buy a book, So just tell me what you know about that. You don't know anything. Nobody knows anything, but if it's going to work or not. So that'd be somewhere we could think about going. And then there's another area that I think we already kind of know what's happening is the area which I call decentralized finance, or DeFi. We got to know that was threatening for a while, and maybe now it's not. I think you know what happened there. So we can think about it. So those would be areas, if we could think about how do we collect the data, how do we analyze that. I don't have any answers for you, but I think that would be a nice place to be thinking about. At least some of it, you can't do everything, okay? But at least some of our efforts, try for that. Can we get data? Can we figure it out?
All right, thank you, Alan. Just newsflash, economists want more data on everything. All right, and with that, we will turn it over to Jonathan for our final presentation.
Hello, everyone. I'm Jonathan Wallum from Harvard Business School. No disclaimer, other than I will try to keep it brief because I am keeping you from lunch. So this is a project with my co-author, John Hatfield at the University of Texas. And what we really sort of have in mind is thinking about a narrow sense. We're going to look narrowly at deposits and think about how can we measure the competitiveness of deposit and understand how that competitiveness varies by across markets and also by across banks within market. So let's spend some time with this figure. So what I'm showing you on this figure is a number of axes. Look at the far left axis, the interest rate. Here I have an interest rate. On the x-axis I have time. On the second y-axis I have a pass-through rate. Let's look at the black line. The black line is the Fed funds rate. This goes back to about 2001 to 2020. We see that the Fed funds rate was high, and then after the financial crisis, we had a period where it was zero for a really long time. And then we had a rate hike cycle that started in 2016 where it went from 0 to about 2.5%. The red line is the deposit savings rate. This is a rate from RateWatch that measures the rate at which consumers earn on their savings accounts at bank deposits. What you see is that in the early 2000s, that red line tracked the black line a little bit. The pass-through rate was about 30%, meaning that if the Fed funds rate increased by 100 basis points, 1%, consumers on average saw 30 basis points in their savings accounts. If you look at the recent rate hike cycle from 2016 and 2019, the Fed funds rate went from 0 to 2.5%. Consumer savings rates went from 10 basis points to 20 basis points. This pass-through rate is about 5%, meaning that banks kept 95% of the rate increases and passed on 5% to consumers. Now, this project started in interest and in response to this very low pass-through rate, but we're currently living through another rate hike cycle, one that's super salient to consumers right now, where the rates went again from 0 to up to now 4.5%. Deposit savings rates right now are about 35 basis points as a national average. This pass-through rate, despite all the salience and interest that we have, and the Wall Street Journal reporting on interest rates every single day, we're seeing that the pass-through rate has been tremendously low. We think about this pass-through rate as capturing how competitively banks interact with one another in order to compete for your deposits. What's fascinating about measuring this pass-through rate is that it's clean. You can see in the data that large banks tend to offer lower deposit rates. Small banks tend to offer larger deposit rates, but that's because we think that large banks offer better services than small banks. They've got these cool apps that you can use and a phone line that you can call 24/7. I admit myself that I use a large bank for these conveniences and a large network. So we don't want to look at the deposit spread as a measure of markup or how much they charge or how much market power they have, but we can look at the change in how they pass through changes to the Fed funds rate to consumers. Why? Because the identifying assumption that we think is that the quality of the services don't change in response to changes in the Fed funds rate. The Fed funds rate goes from a few months ago from 3% up to 4%. We think during those rate hikes, the quality of banking services haven't changed. But what I can look at is I can look at for each of these banks, what fraction of that is passed on to consumers and how that varies both across banks and within market. And what we're seeing here in the data is that in the time series, deposit pass-through rates have fallen dramatically, indicating that banks are competing a lot less for deposits now than they were in the past. If we think about our classic measures of competition, we think HHI, and we may infer from these prices that HHI must have increased a lot during this period. We have some academic work that uses cross-sectional variation across the US in concentration to measure differences in pass-through rates. Dreschler, Salvin, and Schnabel showed that in areas with more concentrated banking, these are the counties with the redder colors, their HHI is higher. We see on average for those counties that pass-through rate tends to be lower. This is particularly true for smaller banks, that for these red counties, you see consumers getting less of the Fed funds rate increase compared to areas that are less darkly colored where there is more competition. Now, this is what the map looked like in 2005. If I flip to 2018, that's mislabeled, that's 2018. You may be misled in thinking that there's not much of a difference, and that's true. In 2018, the concentration averaged across all deposits was 0.23. In 2005, it was 0.22. Phil earlier showed this, but in sort of time series figure, that line has been absolutely flat. And here you see that geographically, there hasn't been much difference either. So that, turning back to the first slide, raises this sort of puzzle. How is it that if we think that local concentration is a good measure of competition, that the pass-through rate, in other words, the fraction of interest rate rises that consumers sees, has fallen dramatically from about 35% down to 5% over this time period, but local concentration has remained unchanged? What has happened in the market during this period? What has happened is multi-market contact has increased a lot. So a fact about the banking markets that probably you all already know is that 10% of banks own 90% of bank assets. It's tremendously concentrated. So what we do in this project is we look at the very largest banks, the banks that operate not within one state but across state borders, and we see to what extent has their network overlap changed. And because that's hard to show graphically, I'm going to focus on three of the largest bank branch networks, Bank of America, JP Morgan, and Wells Fargo. We see Bank of America in blue. This is back in 2005 where they were East Coast and West Coast. JP Morgan, where you see a lot around the Chicago area. And Wells Fargo, where you see in early 2000s, primarily on the West Coast. What happened over this period from the early 2000s to the late near 2020 is that we go from primary to tertiary colors. So you see where blue and yellow overlapped, where Bank of America met Wells Fargo, we have green in this map. And later on, where all three of them meet, we have much darker colors. And here you see a lot more overlap amongst the very largest bank networks. This is true not just for the largest banks, but also for the regional banks. Over this time period, over the past 20 years, multi-market contact measures of bank network overlap increased by 60% over this period. This is broadly consistent with a larger economics literature showing that concentration at the national level for the US has been increasing over time. At the local level, concentration has stayed the same, in part because of heavy regulatory scrutiny on local concentration. But through horizontal mergers or market extension mergers through geography, firms have been able to expand their networks such that they meet each other much more often. Now, the paper is complicated. There's a model where we theoretically talk about how multi-market contact can help banks behave less competitively with one another. And the intuition behind that, sort of I'll verbally explain. The idea is that if you and I meet in just one market, then my competitive interactions with you just depend on that one local market. But if you and I meet in many, many markets, like if Phil and I meet each other in lots of markets, then if we have a market where we earn lots of profits in it, we can threaten a price war with those profits to get us to behave less competitively in what would otherwise be more competitive markets. Sort of the technical econ term here is that we have many incentive constraints if you think of the world as each little local market being its own island. But when you recognize that it's the same economic agent meeting each other across all these markets, that incentive constraint doesn't scale by the number of markets. It's still just one incentive constraint. When you look at how JP Morgan set deposit rates in the early 2000s, they had 46 nodes by which they set deposit rates across the US. But all of those rates were determined at headquarters. It's not that each local branch is making their own deposit rate and choosing their competitive behavior. Rather, when JP Morgan thinks about how do I compete, they think of a national competitive strategy against their competitors, as well as with Fargo and Bank of America, and how they compete depends on the extent to which their networks overlap. What we show in both a model and empirically is that when banks have more network overlap, they behave less competitively. To give you a sense of scale, if you look at how local concentration affects pass-through for small banks, we show that large banks behave as though each local market is twice as concentrated as it actually is. So rather than an HHI of 0.2, they behave as though HHI is 0.4 due to these effects of multi-market contact. In extensions to the project, we think about counterfactuals where multi-market contact were lower. We also look at cases where there appear to have been price wars between these large banks. For instance, when Wells Fargo was subject to an asset cap due to bad behavior, Bank of America and JP Morgan came out and announced that they were opening up more branches. We saw that rates fell in markets where they would have competed and a possible price for during this period. We also have extensions in the paper where we show that they don't just compete in deposit markets, but they compete in other product markets as well. For example, Bank of America and Wells Fargo have a tremendous amount of deposit network overlap, but they also co-syndicate 70% of their syndicated loans together. We show that if you have more deposit network overlap, you're more likely to collaborate with each other in these co-syndicated loans as well. So here we're pushing this research agenda where we think that we should stop thinking about each market as its own little island with its own little competitors that sort of think very narrowly in a competitive strategy sense for just that island. But rather we want to take in consideration the fact that if you have the same competitors who meet each other in the same markets over and over again, they're going to think about the competitive implications of their behavior in one market on all their markets. And that relaxes the constraint necessary for more collusive behavior than if you thought about the world as market by market. All right, that's all my comments.
Thank you, Jonathan. Okay, so I think this topic of multi-market contact is a pretty interesting one. For us, when we're thinking about how to look at mergers, I think I could imagine a scenario where we're looking at a merger and imagine it increases concentration in some local markets. So that's one thing that we're often concerned about. But maybe just because of the way things work out, it actually could decrease the similarity in branch networks, say between regional banks. So I could see there could be things that could be going multiple directions here. So do you have any ideas or thoughts about how you could weigh those? Which effects would you think would be first order, for example?
Yeah. In the paper, we focus on the large banks and show that large banks are more sensitive to multi-market contact, the extent to which their networks overlap, than they are sensitive to local concentration. Part of this is a feature of how they set rates. These large banks will set rates that are have broader geographic area than just for smaller banks do. For instance, they'll have one node for all of Massachusetts, for instance. So that matters more to the extent to which they meet other large banks. Now, the answer differs depending on for a smaller bank merger.
Yeah. So that's interesting. So it seems like this could depend on the extent of the geographic networks now between the merging parties, and then also what we know about the way they set prices as well.
What's powerful about this measure as well is that it's pairwise. For instance, I can tell you that Bank of America and Wells Fargo have a lot more overlap than, for instance, Citi and Bank of America. So there you can look at to what extent you have the networks influenced when you're looking at various pairs of large bank competitors within a market.
Okay, so given that, you do have a specific measure of multi-market contact that you talk about in the paper. So for a merger reviewing authority who's thinking about investigating this particular theory, is that what folks should be looking at, or are there other types of data that you think should be collected to look at to investigate multi-market contact or certain types of evidence? Like, what are your thoughts on like what are the pieces that should be looked at to see whether or not this is an issue?
My measure is the best measure. No, I'd say that in many ways.
Spoken like an economist with a working paper out there.
No, in many ways, I think that the measure, it's a nice feature of it is that it's very simple. It's literally just we show as in many academic papers, you've got to be very nuanced and very careful and do a lot of robustness. But at the heart of the measure, it's simply to what extent do your networks overlap. If, for instance, you have if you have Wells Fargo wants to buy this local bank that operates in the market with Bank of America, there you worry a lot more because their networks overlap a lot. Versus if they're buying a local bank with like Fifth Third, where they overlap a lot less, and they would otherwise meet. So there, it's simply to what extent do your deposits as a network overlap with one another. So it's in that sense, it's a simple measure to construct.
Yeah. So just for the audience and benefit a little bit, you don't have to go into technical details, but my understanding of the data requirements is you need the branch locations. So you're using the branch locations and the deposit information, which is reasonably accessible. Is that fair to say?
Correct. Yeah. We scale size by dollars of each branch, but that scaling isn't even necessary either.
Okay. No, I think that's to Dave's point earlier about data availability. That is something that we have available. So I guess another thing is when we're talking about collusion in industries, it comes up, I think a lot of people think about, okay, what aspects of an industry make it more or less susceptible to collusion? And I think for banking, when some people tick off things, they're about like certain types of like pricing behaviors, or are the prices transparent, or like how do customers flow, is there switching costs, that type of thing. In your model, are there things that you think are like a really good fit for banking, or are there things that you would maybe say, oh, like this is maybe not quite as good a fit, but we think that like it captures a certain part of the dynamic nonetheless?
So one of the reasons why we use the banking industry as a laboratory to study this idea of how competition changes depending on multi-market contact is because, one, it's huge. It's like 15 trillion in deposits. And the spreads that are being earned are enormous right now. Deposit rates for consumers are 40 basis points and Fed funds rates of 460 basis points. That like approximately 400 basis point spread is sort of like an enormous cost to consumers. What's also nice about this setting is that the product is relatively homogeneous. A deposit is a deposit is a deposit. There are different services attached to the deposit, but that homogeneity allows us to study sort of the differences in the spreads across these institutions. And then we've got this beautiful pass-through where we have the Fed raises or lowers interest rates, and we can directly see how that passes on to consumers, depending on banks. So it's sort of, I chuckle a little when you complain about the lack of data, but this is one area where the data is actually outstanding. We can show very cleanly high-frequency measures of pass-through and how that varies by bank and by location.
Yeah, so I think to summarize, your contention here is that because it's a deposit product that is reasonably homogeneous, and you have a pretty clear indicator that everybody observes of an input cost. And so therefore you can kind of read the pass-through off of that works well with this thought process.
Correct.
Okay. So actually, we've gotten through my questions. You guys were all super on the ball in terms of time.
Let me just, maybe I could just add something here.
Yeah,
because
go ahead, Alan.
I think all three papers just plus the session earlier this morning, the content is the same thing, is that, there's a lot of things to analyze. We probably can't do them all. So we have, this proximity issue, we have the multi-market issue, we have, is it the customer versus the bank issue? We have, do we need to worry about fintechs? Do we need to worry about big tech? Do we need to worry about regular shadow banks like money market mutual funds, things like that? And, yes, you have to worry about all of them, but I think as regulators, if we go back to that, that's what we really want to do, is the goal here is to give the best advice we can to the regulators. And I don't know the answer, but I know this is the list of things you need to think about. So I don't know, if you call me on the phone, ask me which one I can think about, I don't know the answer right now. But there's a lot of things, you cannot tackle and prioritize all of them. It's not possible. But, we're giving you a very nice list of things to think about. And I'd say, keep track of them and figure out your best move in terms of where you want the data to come from and your research economists, what do you want them to do? So it's just, it's easier to pose questions. There's a good one for you. You guys have to answer it.
Jonathan, you want to follow up?
If I could tack on to that, we shouldn't let the complexity of banking sort of overshadow the simplicity of the problem that we face in this figure. The strength of the U.S. financial system is that borrowing rates and savings rates are generally pretty close when you look in the U.S. compared to across the world. When I teach Fin 1 to the MBAs at Harvard, I say the success of the financial system is that we have small spreads. This is an egregiously large spread that we're facing here between borrowing and savers. If we think that savers and the Fed is trying to influence monetary policy for consumers to get them to save more to control inflation, if consumers are seeing savings rates of 40 basis points, even the Fed has hiked rates up to 440 basis points, maybe it's not surprising that it's hard to get inflation under control. This is a remarkable failure of the U.S. financial system that there's such a huge spread here. And it's not complicated, it's apparent and easy to see. You all see it in your checkings accounts versus the Fed funds rate here.
Yeah. I think Jonathan's right. He actually wins the battle here because I think he's right. This 400 basis point difference or whatever it is, that's got to be like the biggest, the biggest distortion. So maybe that's a top priority to look. I mean, I'm not saying everything else not, but that's got to be a big one. It's got to be a big one.
Yeah,
and,
no.
And by the way, this didn't start with, this didn't start. So these issues, these are actually older issues about multi-market contact and asymmetry of response. And it's interesting that we're getting here and we haven't solved this problem. So these are problems from the 80s and 90s. I can tell you what the research is there. A few very important people like Loretta Mester and me. We did all this research, and we didn't, I guess we didn't get very far. So let's redouble our efforts here. I think you're right on this.
Yeah, I think it's a situation that gives us just plenty of places to look for research and just raises a ton of interesting questions. Would anybody else like to, we have a couple minutes left if anybody else wants to summarize before we.
Just a thought about, there is this dichotomy, right? To do research, economics often has terrible data, and banking has comparatively much better data relative to many other settings. It's a separate business to conduct policy. To conduct policy, to look at a real-world transaction, and to decide if this policy is a threat to the statutory requirements of the law or something else that you might care about, like a counterfactual policy that gets better outcomes in the spirit of the law. That requires a different set of data. And I think just for anybody who hasn't put that piece together already, the type of boots on the ground conduct of policy would certainly benefit from better data. And then we as economists could use it.
Yeah.
So.
More data, more research. Everybody's happier. All right, well, I think we'll conclude there. Thank you very much, everybody, for presenting 3 great papers. And then my understanding is there's lunch now, so.
It's in the same room where we
we go ahead?
Yeah, go for it. I think everyone's ready.
Okay, welcome everybody. We're delighted to get started after a nice lunch and some time to chat and visit.
Are we on?
There we go. Thank you. All right, hi everybody. Welcome to our afternoon first session in this terrific conference. I'll start just by saying thank you so much to the OCC team for putting on this terrific symposium for all of us to be able to engage in so many interesting topics. I'm Beth Kaiser. I'm an economist and associate director at the Federal Reserve Board in the Division of Research and Statistics. I support the board by providing oversight and guidance for the staff work in policy analysis and research on a range of topics in economics, including competition, financial stability, and banking mergers and acquisitions. We have terrific panelists with us today, and I want to also thank the members of the audience, both here and virtually, for contributing questions. We got a wonderful set of questions from a wide range of participants, so thank you for those. We hope to dive into some of those today. Okay, a disclaimer, of course. Any thoughts that I might share today are mine alone and do not necessarily reflect the views of the Federal Reserve Board, other agencies, or staff. So thanks so much. Okay, so I'll start by introducing our distinguished panelists, which we're delighted to have here today. Dan Aubrey is a professor of law at Cornell Law School. He's taught and published research in a range of topics on financial regulation in many scholarly journals. He's provided expertise to a number of regulatory organizations and agencies. He's co-authored a leading textbook, and he's a founding editor of the Journal of Financial Regulation. Dan, thanks so much for joining us today. Moving down the table, Tim Clark is a senior banking advisor at Better Markets, a nonprofit that focuses on promoting the public interest in financial markets. Tim is a former deputy director in the Division of Supervision and Regulation at the Federal Reserve Board, with previous experience at the Federal Reserve Bank of New York. He's got deep expertise in supervision and regulation of large banking organizations and was responsible for launching the Federal Reserve's program for supervising systemically important financial institutions in the wake of the Great Financial Crisis. Randall Quarles is chairman and founder of the Synosia Group, an investment firm. He's a former member of the Federal Reserve Board of Governors, where he held the role of vice chair for supervision and where he served as chair of the Financial Stability Board. Earlier in his career, Randy was a partner at the Carlyle Group and other firms, and he's advised multiple Treasury secretaries, has served as a Treasury undersecretary, and also as the U.S. Executive Director of the International Monetary Fund. Graham Steele, at the end of the table, is currently the Assistant Secretary for Financial Institutions at the U.S. Department of the Treasury. He served previously in Stanford University's Graduate School of Business as the Director of the Corporations and Society Initiative. He has broad and deep expertise serving and working with the Congress, including serving as a Minority Chief Counsel to the Senate Banking Committee and as Staff Director for the Subcommittee on Financial Institutions and Consumer Protection. Welcome, panelists. We're so delighted to have you here today. Okay, so let me start by just saying a couple of words, and then I'm going to dive into some questions. We've got a lot of questions that we could work through. This is a rich and wide-ranging topic. So I'll start. The Dodd-Frank Act in 2010 directed the federal banking agencies that are deliberating proposed acquisitions by firms to consider the risk to the stability of the U.S. banking or financial system and whether a transaction would result in greater or more concentrated risks to the stability of the U.S. financial system. A number of years have passed since then, and I'd like to invite your perspectives today on a range of topics related to banking acquisitions and financial stability. So first off, I think I'll start right here with Dan. We'll try to move up and down the table a little bit. And so I'll just start by, let's talk about the types of transactions that we're thinking about. When considering banking mergers and acquisitions, what types of transactions, if any, do you believe have the potential to create greater or more concentrated risks to U.S. financial stability? And what types do you believe do not?
So I think there's a range of transactions that I think most people in the room in the OCC's combinations manual would probably start with, and I'm not going to focus on those. So those are the combinations that involve size, complexity, or interconnectedness in effect. And wanted to focus on two types of transactions that maybe haven't happened a lot yet, but I think may going forward. And those that are between low-tech and high-tech banks, and those that involve banks and non-banks. And those are going to interconnect, right? Those are cross-secting issues. Much of what we may see are low-tech banks looking to acquire high-tech non-banks. And there's actually quite a few drivers for this. There was a great slide at the start of the day that there was this peak of mergers and acquisitions activity for banks in the late 1990s. I don't know if you remember this, sort of 98, 99, a lot of merger activity. And of course, the first commercial API comes out, web-based API comes out in 2000. All of these mergers and acquisitions involved enormous IT integration challenges, and all of them were on the verge of technological revolution and didn't know it yet. It's like a whole bunch of horse breeders got together and merged right when somebody was about to invent the automobile. We're still living through that very messy technological transition. That is really twofold. One, the ongoing integration challenges that differ between large banks, medium-sized banks, and small banks. And then different levels of web compatibility across the front, middle, and back office. There's all sorts of reasons then that we might see mergers between, for example, banks that decide that they want to buy instead of make a world-class IT infrastructure or access into markets. And in doing so, there's a lot of integration risk, but also a lot of really important risks that we don't tend to think about. Still, again, I know in the OCC manual, things like cybersecurity risk, things like the managerial risks that come from when a low-tech banker is now running a high-tech bank. And what it means to understand from a management perspective what sort of risks are entailed, and the ability to talk to a whole bunch of people that don't talk bank speak, but tech speak. These are the sort of things that I think may become increasingly of import in the merger context as we look ahead, and these are the transactions that, if they do happen, I think will warrant special scrutiny.
Thank you. Tim, what would you have to offer the types of transactions in terms of conveying risk to the financial system?
I guess I would focus a little bit more on the obvious ones that he didn't focus on. So, from my perspective, basically any transaction, be it a merger or expansionary activity of a different type in an already large bank, that increases the likelihood that a bank would contribute to financial stability or increases the potential severity of the outcome should we enter a period of financial stability, actually is how I would define that at a very high level, by which I guess I mean that in any case, the question really I think that we are should be most focused on here is, will the government feel that it has to intervene to provide support to protect the financial system and the economy and the people of the country when the bank is deteriorating rapidly? So I would say pretty much a range. One of the things that we'll get into, I think maybe a little bit later, but I'll start by just raising out the elephant in the room here, or maybe I should say the elephants in the room here. When we talk about concentrating or increasing issues, financial stability issues, we have a handful of banks that are so large right now that if you're looking at the context of sort of a level of systemic risk, in the context of mergers, we have a long ways to go. There's a number of things that can happen for banks that would never put them at the same level of systemic risk as some of those larger banks. And yet, there's still a lot that needs to be done on the merger side, even for large regional banks, as it's been well acknowledged. So, but I say that because I want to make sure we acknowledge that we also have very large banks that are already too large, I would say, and they continue to grow quite rapidly. So whether it's a transaction or not, that level of growth, the increase in the systemic importance of those banks, the increasing potential threat that they pose, I think is the key consideration here.
Great, thank you, Tim. Randy, what would you add to this discussion? What issues would you raise?
Well, I guess, the question of what types of transactions would result in greater or more concentrated risks. I mean, it does begin to, and I think later in the discussion we'll get a little more in detail, it throws into this question of, that's kind of a weird instruction from the Congress to say results in greater or more concentrated risks, because you have to, it presupposes then that there are some transactions that could result in more concentrated risks that are not greater. And so we're instructed to consider them, but it doesn't tell us how to consider them. Or at least, on the face of it, that's what that phrase would seem to say. If you would say greater or more concentrated, there must be some transactions that concentrate risk but don't increase them. So the first question would be, so why should we care if they concentrate risks but don't increase them? So then you say, well, maybe they didn't mean to say greater or more concentrated. Maybe that was just sort of knee-jerk legal bloviation. Or maybe it was, maybe or more concentrated was somehow qualifying greater. So it's greater or more concentrated. So that would mean that actually that phrase is greater and more concentrated, which would not be the weirdest thing that a court would ever do in interpreting statutory language. But I think at the end of the day, to try to make sense of what is a weird instruction, you'd say, well, the addition of or more concentrated must have been intended to say, we can't always tell, whatever our measures are for measuring whatever the level of risk is, we can't always tell what that level is. And we know that concentration is going to have some effect on the level of risk. And so we're going to sort of add that as, in the spirit of the leverage ratio, so that you're not simply coming up with a framework to measure level. You have to have some sort of framework to measure concentration as well. So then you really have to say, well, then what's that framework? And we're given no instruction as to what that framework ought to be to measure concentration. As to why we should care about concentration. We care about concentration for competition reasons. We just had the panel that tells us why we care about concentration for competition reasons, but we've got a whole competition section. We can't be recapitulating that in the financial stability section. So I think what that leads me to is that at the end of the day, you're evaluating both greater and more concentrated, those two elements of the test, through the only framework that we have, which we spent a long time on, which is the GSIB assessment framework. And so we should, in determining whether a particular transaction should be approved or not, we evaluate its effect on both the level and the concentration of risk through the GSIB assessment framework, which we already have out there. So, on one instance, I would agree with Tim, which I'm sure no one here expected that to happen, but I would agree that any transaction could have an effect on both the level and the concentration of risk. But I think that we have done a lot of work on and have handy the framework for assessing both of those elements through the GSIB assessment framework, which would tell us that it's kind of a high bar for you to actually say no to a transaction on the ground of either of those elements, because you'd have to push yourself up into a GSIB level.
Thank you, Randy. Graham, would you like to take the baton from there?
Sure. And I will surprise folks as well by agreeing with the vice chair that we need a better framework here and a little bit of a more comprehensive and clearer and more standardized understanding of what agencies are evaluating when they're evaluating the financial stability factor in these transactions. So I will agree with that part of it. But probably not surprising many people, I'll disagree that the GSIB framework is necessarily the right one here. And I'll try to use a couple of particular kinds of transactions to illustrate the point why I think maybe it can be part of it, or maybe we need a modified, perhaps like a domestic version of those metrics to try to better capture the essence of what the Financial Stability Review ought to be about a little bit more. So one set of transactions that I would highlight is where there are firms that provide critical services or functions that are merging, and so those functions are coming together. Using the Method 1 score in the GSIB framework, there's a cap on the substitutability factor, which measures those kinds of critical functions. So if you're using Method 1 for that purpose, and these firms are merging, there's a limit on whether, that you only get so much credit for that particular financial stability impact, and yet you're bringing together two custody services, two clearing services, two platform services, whatever the particular issue is there. So it kind of misses an area where you might be both increasing the systemic risk and or concentrating it because these functions are being done by one institution. And you can think about the merger between Bank of New York and Mellon in 2007 that brought a lot of that stuff together. How would agencies evaluate that transaction now? How would it look under the GSIB framework now? What would the outcome of that be? And so I think that you could ask yourself that counterfactual and see, does this system work well as we've currently structured it? I think another example are the large regionals, frankly, where they are not global institutions. And so measuring their global systemic importance, things like cross-border exposures, just are not going to factor. They are never going to trip that wire because they just don't meet one of the criteria. Similar to capping substitutability, they're never going to hit it, and yet domestically, the merger might have financial stability impacts. And so, another historical example I would think of is Wachovia pre-crisis. Over the course of 4 years, did two transactions where it acquired what would be the 2023 equivalent of about $260 billion in assets. So its own Category 3 firm it acquired in that period, and we know what happened. It got close to bankruptcy. Wells Fargo had to acquire it, and again, how would those transactions have been evaluated under the framework we have right now? Would they have been approved? Were they beneficial from a financial stability perspective? And so, I think, again, I agree we need more clarity here about what regulators are looking at. A lot of the decisions so far, purposefully so, have been ad hoc to try to test out and learn over time. I think we have the ability to reflect back now on some of the transactions that have happened recently. A GSIB acquiring a non-bank firm, to Dan's point, has been allowed. Two very, very large regional firms merging together, that has been allowed. Regional banks purchasing the operations of FBOs, that has been allowed as well. Each one of the analyses has been a little bit different. They haven't been totally standard. Some of them use Method 1, some of them have not used Method 1 at all. Some of them have just been a little bit of a discussion about the trade-offs. And so I think in general, all outsiders see when they look at that, number one, to borrow a phrase, they see a Delphic and hermetic process that is very ad hoc.
That's a good phrase.
And then it is. And then others, people see a rubber stamp. And so I think, I'm glad you all are having this conversation because I think agencies really benefit from a little bit clearer, a little more standardized, a little bit more transparent framework about what they are assessing and why they're assessing it in each one of these transactions. I think it's good for the public. I think it's good for the industry to understand and have predictability. I think it's good for the agencies themselves as well to explain their work as they're evaluating these transactions.
Terrific, thanks very much. And actually, I think I'm going to jump to a follow-up question about measurement. A lot of people are interested in this question of measurement. How do we measure the financial stability implications of an acquisition on the broader financial system, so not just on the bank itself, but on the broader financial system. So let me ask, what types of measures would you all suggest or believe could be useful to assess these questions? And in particular, I guess agency staff have, as you suggested, Graham, unpacked things like size, interconnectedness, lack of substitutes, reliance on short-term wholesale funding. So those GSIB subcomponents individually, which are available in regulatory data in some circumstances. So what would you suggest as metrics that could be improving upon the existing practices or processes? And if you don't mind, Graham, can I start with you since you
come
spoke
back
to that
down the line?
specifically?
Sure.
Maybe we can come back down the line.
Yeah, right. So I won't just say what I don't like. I will also say, I think some of the factors are right? In both method 1 and method 2, there are things like short-term wholesale funding that we know have financial stability implications, that even small institutions that use those sorts of funding sources will create contagion effects, will have financial stability issues. So I think some of them are right. I think the thing that I am looking for in a more searching review is, number one, the domestic component of it, right? Because it is the financial stability to the United States, right? It is not necessarily global financial stability that U.S. regulators need to be concerned about when they're approving transactions that involve U.S. institutions. And so maybe we look less at the global footprint, or it's part of it, but also the domestic footprint is important too. And then you look at things like retail payments. You look at sort of the more domestically focused footprint. And there are a lot of other countries. I know we like to do our own thing, and America is exceptional, but there are a lot of other countries that have implemented domestic, systemically important bank frameworks that use a lot of these metrics that are relevant to their local economies. And you could do it at the national level. I also think we've got to think regionally as well. I think we have to think about the impact on communities, not just of the consolidation when two large regional firms merge that have overlapping product markets and there are branch closures, but also what would it mean if two firms with concentrated footprints merge and then that firm fails eventually? What does that mean for an economy in the Southwest if they lose a major source of financial services? And so I think part of it is where to focus, which is here, not everywhere, and another is look at what the particular functions and metrics are that are relevant to either national or regional economies.
Interesting, thanks. Randy, I
Sure.
remember you mentioned metrics as well. What would you add to the discussion there?
Well, I think the only thing that I would say is, so I completely agree. The important thing is that we need an agreed and clear framework for evaluating financial stability, which we have not articulated. And indeed, one of the reasons I went through that kind of comical, what on earth might the Congress have meant, is that at least at the Fed, we had not at an institutional level even done that, let alone come up with, okay, well, how would we implement that? Or if we had done that at the Fed, no one told me. Now, that did happen from time to time. But so we need to have an agreed framework. Where I would disagree with Graham is that I think that the GSIB assessment framework is good at doing that. So yes, if you're looking at the regionals, a material portion of the GSIB assessment framework is your cross-border activity, but it's a total of 20%. So 80% of the assessment of the systemic importance of a firm has to do with the GSIB factors relating to size and complexity and interconnectedness, and involvement in financial infrastructure, all of which are sort of exactly what Graham was talking about, and for which we have a framework, and for which we have measures, and by which we currently measure all of the regionals as well as all of the GSIBs. So there are some flaws in it. For example, one of the things that the GSIB assessment framework doesn't take into account is cybersecurity risk, which, if you were to ask me today, what's the potential, the largest, the greatest potential source of the next financial stability incident, it will be something to do with cybersecurity as opposed to something inherent in the financial system. And we don't really assess cybersecurity soundness as part of a financial stability assessment of anything currently. That's part of the supervisory engagement with firms generally. So I'm not saying that there aren't ways in which one, that the GSIB assessment framework couldn't be improved, but we should approach it as addressing a framework as opposed, and one that is largely on these issues pretty good, as opposed to creating something entirely new and separate from that GSIB framework.
Thank you. Tim, what would you add in that whole discussion and context?
Yeah, I will exercise my option to answer a slightly different question, which is, there's a lot of pros and cons to various metrics. I think that both have mentioned them. I agree with Graham that there actually should be some greater domestic considerations put into the analysis. But much more importantly to me is some kinds of thresholds, or some kinds of understanding of what one is looking for. I talked earlier a little bit about level, growth versus concentration. Just to take the example of the Morgan Stanley E-Trade transaction, I may forget the numbers, so you probably remember them if I do. But I think the outcome was that the GSIB score went up by 2%, and the GSIB score was given, and the 2% increase was what was given. I don't know if those were considered negatives, positives, why those, what is the amount we're looking for here? Are we focused on, if you're focused on the level, then again, as I was talking about earlier, I think you have a serious problem because we've already let a handful of banks become far, far too big. And so just because another bank, a merger creates a bank that doesn't come even up to those levels, does not make that bank not systemically important. It does not mean that in the event of serious economic difficulties, the government will not have to act. And I would just use the example of 2008 when I believe TARP was provided to 700 banking organizations. So there's, in the event of a crisis, there's a lot of decision making that goes into who's going to be affected by this, et cetera, et cetera. So I'm slightly digressing. So back to my point though, on the analysis needs to have some clear thresholds, right? And I think I would suggest that the reason it doesn't is because when you put thresholds in place that draw a line sort of at absolute level, you're going to find that there are a handful of banks that are so far above those that it's going to make obvious the question of what are we going to do about that. To that question, I would say I look forward to the OCC Symposium on what we're going to do about banks that are too big, and I hope they'll invite me back. But in the meantime, I don't think that's what we should be thinking about with respect to large regional bank mergers, because I don't think that the question is, do we let ourselves create even more banks that are just far too big? The question is, does the merger process lead to greater risk that the taxpayer underwritten, government-funded support will have to be provided in order to protect a variety of stakeholders in the event that there's a problem at a bank? I'm kind of front-running some of your questions, and I apologize for that, but that's why I think the resolution considerations is one thing from the analysis right now in financial stability that is sorely lacking and absolutely critical to address as soon as possible. So I'll stop until we get to that.
Thank you. Thank you, Tim. Dan, what would you add with regard to measures? And then maybe after that, we'll talk about resolvability.
Great. So I'm sure at this point we all have a favorite Comptroller Sue speech or document over the course of his tenure. And mine, by a country mile, is his May 2022 speech on the topic of today, on bank competition policy. And his basic message was, we're often quite top-down in competition, and I think we're also similarly top-down in our analysis in the financial stability implications of competition. And what we need is a little granularity, a little bottom-up approach to understanding these issues, because they are unique to all of the GSIB banks and a lot of the regional banks that, in the context of acquisitions, may become more systemically important. Goldman Sachs is not JP Morgan, is not BNY Mellon, and understanding the institutional features of those institutions, the markets in which they play, is extremely important, I think, for financial stability analysis. These risks are not things that then can mechanically just sort of be evaluated in the context of merger policy. You have to get your sleeves rolled up and get dirty. And just to go back to one of Randy's points a minute ago on a slightly different issue, take the issue of cybersecurity risk, for example. I guarantee you there's like 5 of us in the room who are freaked out by this and about 95% of us who aren't. I encourage the 95% who aren't to go look up the cost of insuring cybersecurity risk for banks and how it's changed in the last 36 months. Some people who are on the hook for these risks seem a lot less willing to take them than they used to be. These are the sort of risks and the sort of data that we can use on a more granular level to understand what the sort of stability implications are. And I'll just finish by linking this up to my first point. In a world where we're going from the 1990s of closed technology systems to the world of 2022, 23, where our systems are increasingly open, that openness gives rise to a set of cybersecurity risks that, for those of us that remember fondly working on Y2K, are just orders of magnitude more scary. And understanding those risks are not something that are to be trifled with, but they do require you to be very granular in your analysis and then get creative with the sources of understanding those risks, like looking at market-based measures such as insurance. That's just one example. I think there's lots that we could look at. They vary across institutions, but as a plumber, I like to start with the detail.
Terrific, thanks so much. So let's dive into this question of resolvability, and I'll unpack that a little bit. So if in posing the question, I'd ask, how do you think the resolvability of a resulting merged institution in the event of the institution's distress or failure should be considered as part of the financial stability analysis for the merger itself? And also, are there structural remedies or conditions, for example, either divestitures or commitments that the agencies could require that you would view as appropriate to address potential financial stability risks from an acquisition related to the ability to resolve it? Dan, do you mind if I start with you and we could go down the table?
I guess the elephant in the room on this particular question is that the primary way that we seem to be approaching resolvability is the assumption that another very big institution will come along and buy the failing institution, which of course cuts against all the other policy objectives that we've been talking about today. So let's just get that out there and deal with that resolvability is really saleability, and especially in a world where we haven't seen what OLA looks like in practice, I don't think we should expect much than the worst case scenario. There's also quite a few banks now that have had serious regulatory pushback to their resolution plans. And I suppose while it's a very modest and kind of obvious sort of remedy in that regard, it would seem to me extremely prudent to have a very clear policy that as long as you have outstanding concerns around your resolution plan, that M&A activity for you is simply off the table. If you can't get your existing house in order, why am I going to let you build an extension on the second floor without planning permission? And so I think I'll leave it at that.
Thanks so much. Tim?
Yeah, so unsurprisingly from what I was just saying, I think the resolution is really kind of the crux of the matter here in the consideration. So just to directly answer the question, I think that when there's a merger of a bank, of two banks, whatever, an acquisition of a bank that's going to lead to a bank that is likely to require some sort of government assistance should matters come to that. In the interest of meeting the objective of Dodd-Frank to end too big to fail, right there you've got right there is a red flag. So I would require a pro forma resolution plan from the surviving bank, as they call it. And I would definitely look at that with some great skepticism. And I would also require the bank to provide a detailed accounting, and I'd require the agencies to actually respond to that accounting of the ways in which this merger will increase the obstacles to the resolvability of the combined entity, and the ways in which it may decrease obstacles. And frankly, from my perspective, if you're talking about a bank that is bigger than any bank that's ever been resolved safe, non-disruptively in resolution, in either under Title II or Title I, if the answer is that it has increased the obstacles to resolution rather than decreased them, I think the presumption should be you would not allow that merger. Where you draw the line on how big a bank has to be to fall into that, we can all debate about that. I would again go back to the original Dodd-Frank, set the line at 50 billion for systemically important. GRIPA has changed that. Wherever one sets the line, a bank has to internalize the cost of preparing itself to take actions. In fact, I would probably even go a step further, go back to recovery planning, which doesn't get as much discussion as it used to, and I wish would get more. But nonetheless, I would require detailed recovery and resolution plan pro forma. I remain very skeptical of the likelihood of Title II even being attempted, especially when it's most needed in the midst of a crisis where a number of institutions are declining at the same time. I'm even more skeptical of trying to resolve one of these firms in bankruptcy. So I think the Fed and the FDIC have correctly noted publicly and sought comments on finding ways to address this. I think Mike called it the regional resolvability gap or something like that. It's really important. Clearly, a $600 billion bank is, I think, very unlikely to be resolved either in bankruptcy or Title II in the event that there's a significant downturn going on. So we have to have some kind of plan. The bank should pay the price for that plan. The bank should take the actions to make that plan more achievable. Last thing I'll say on this, on resolution, I think there's a couple things that need to happen to make this all work better. One, I think that the liquidity and capital guidance that have been provided to institutions and to how to think about the needs in resolution should actually be turned into rules rather than guidance. I think it would make them much more powerful, certainly more enforceable, and much more clearly and consistently applicable. And I think there needs to be a much greater focus on separability. And there is, again, guidance on separability. I think there should be a lot of focus on separability and a lot more expectation of the firms making themselves more easily separable in the event that they start to deteriorate substantially. And again, what better place to start considering this than in a merger when you're actually doing the opposite of separating? So I think these are my main points.
Thank you. Randy, on resolvability.
So I guess I'd make just a couple of points for time. I mean, I could talk a long time about this, but so with respect to Dan's point, which is a very common view among the supervisory agencies as well, which is kind of as a way of providing incentive to address supervisory concerns, whether it's work on the resolvability of the institution or any of a range of supervisory concerns. You won't be allowed to do M&A until you address this other completely unrelated thing, potentially. I'm uncomfortable with that sort of blanket prohibition as a way to gain leverage over an institution. So just to take an example, if you had a very large, sort of highly wholesale funded institution, the single most important thing that you could do for the financial stability of that institution and of the United States, if it was of a sufficient size, would be to merge that institution with a sort of plain vanilla commercial bank that had a source of stable deposits. And if that very large wholesale funded institution had a variety of supervisory issues, it would be a perverse result to use the building authority example, because you haven't addressed our concerns over the asbestos in the attic, we will not allow you to undertake this transaction to shore up the foundation. You will not get a permit to do anything until you've addressed the asbestos in the attic. But that is kind of the prevailing mindset in the supervisory institutions currently, which is we want you to address the asbestos in the attic and we will not look at anything else. So that hypothetical is hypothetical, but it's not it's not entirely theoretical. There are a number of institutions in the country that would benefit from that sort of merger activity that we should actually encourage for the sake of financial stability. So that's why I'm uncomfortable with the sort of no mergers unless you've addressed resolvability, because there could be particular mergers that would be that would have kind of a higher priority in the financial stability hierarchy. Again, the second thing I'd say is just to go back a little bit to sort of measuring the level, and particularly the focus that we've discussed here, and that's certainly very live in Washington, which is the large regionals and merger activity for the large regionals. Again, the size is the single largest element of the GSIB assessment framework. And if you measure the large regionals on the GSIB assessment framework, they do not come anywhere close to the GSIBs. They are simply not as large a risk to financial stability. They could have a significant increase in their own complexity and interconnectedness and size before they would be a risk to the financial stability of the United States. And I think it's not the right way, it's just not the right way to run a governmental process to say, in 2009, the game of musical chairs ended, and whatever chair you were sitting in, you are stuck in. And JP Morgan happened to be sitting in this chair, so it can be this big, and you were sitting down here, so you cannot be any bigger than this, even though you could become much bigger without, on the only measure that we have formally agreed to for financial stability risk, you pose no risk, no material risk at all. So those are the two things I would say. Sorry, I was getting a little carried away.
Passion is always encouraged.
I think we found the place where we disagree.
I think we have. It's hard going down and back because you have like 2 rounds of things that people have said that you want to respond to. So this might be a little bit of a flyby. Sorry. I mean, I think the original question was about resolvability. I think consistent with my earlier comments about considering domestic and regional impacts, I think it's got to be a part of the calculus. I think that's one of the reasons that the test itself is there, is experiences that we had with large merged firms and the fact that they were unresolvable back in 2007, 2008. And I think it's a good complement to what we've talked about a little bit in having a certain amount of analytical rigor in a quantitative assessment of some of these metrics. And then what I think of as this qualitative piece of a forward-looking consideration of what happens in the national or regional economy if the firm fails, and what the scenario looks like if you're trying to resolve the firm itself. And so I think something like a resolution planning process that is part of the merger review seems appropriate to me. I think you can't just say, because firm that wants to merge because your existing living will is inadequate, you don't get to merge it once, that's fine. You got to think about the post-merger firm and what you do with that. So you almost have to do a resolution planning process of the post-merged firm pre-merger. Now that's pretty awkward, isn't it? So, but that's the kind of thing that I think you have to think about if you're going to evaluate the financial stability impacts of the merger itself. And so, I think you had also asked about divestitures, is that right?
Remedies,
Remedies, what you do about that? Yeah, I mean, that is both a remedy in banking law when a firm becomes either a safety and soundness concern or a risk to financial stability. And it's a well-understood other antitrust remedy in broader mergers when you have overly concentrated markets. Obviously, it's part of the competition review. Branch closures are a form of divestiture or selling them off. So it's understood in other contexts. It doesn't seem to me like it would be unreasonable to also have a component of that in the financial stability test. But I think that can't be a substitute or a piece of window dressing for waving a merger through. Yeah, if you just get rid of like a little bit of assets over here, then we'll say you're fine and we'll move it on through. I think, I mean, it's hard right now, right? Because it is effectively a binary choice. And I don't think, I mean, correct me if I'm wrong, I don't think there's ever been, that had been a remedy at least on the financial stability side, for any of the mergers that have happened post-Dodd-Frank. So I think you got to make the financial stability assessment first and then decide as an agency, are we just going to deny this? Like, is there never a world in which we think this firm could ever be not be a financial stability risk, or we think if a material business line is moved off either to somewhere else or someone else, then we would be okay with it. So I think they have to be independent assessments in my mind. And then just one point on the cyber risk thing. I mean, this is one area you could go down a real rabbit hole in thinking about how you even measure that piece of it, because as someone who is paid to be freaked out about cyber risks in the financial sector, that is my portfolio, those things cut different ways as well. One of the biggest challenges we hear about firm mergers is the integration of the IT systems is a huge challenge. You have for years and years and years. The firms are never able to integrate. That creates operational risk. It creates other kinds of problems for the firm. However, we have seen cyber incidents recently where the fact that have occurred at firms that have acquired other firms had not fully integrated the systems, and the fact that the systems were not integrated meant that the entity that had an issue was segmented and firewalled off from everything else. So, there's a way in which cybersecurity and integrating it can be a benefit to financial stability. It can also be a detriment to it. And so I think, again, very hard to come up with a way of actually evaluating that isn't, I guess, kind of facts and circumstances based is the way I would think about it.
Can I just, real quick, if I could, so just on one of the points that was made earlier. First of all, actually, I'd say I ignored your divestitures part. I didn't mean to. I think planned divestitures actually could be a very important part of consideration of a merger. I don't think commitments is a particularly good idea. Commitments tend to be broken. They tend to be ways to find extensions to the commitment, and things can drag out. But that's I would be a little more skeptical about commitments. But on this other issue, and this is again, I think where we may have a definite disagreement here, the Dodd-Frank Act, clear objective, end too big to fail. We have not ended too big to fail. There are a number of very, very large firms in this country that, in fact, have continued to grow substantially since the Dodd-Frank Act and become even, I would say, more difficult to resolve, more too big to fail. Because they exist, I don't think that can be a rationale for saying we should have more of them. That we can't try to limit the number of those simply because we already have a handful. Dealing with that handful is probably the most important issue going in supervision and regulation right now, and the work is far from finished. A lot of work needs to be done to address the threat that those firms can face. But just because they're there doesn't mean we should create other firms that also pose similar, if not exactly the same magnitude of threat. And the ultimate threat being the need for taxpayer-funded government support to a private enterprise that ultimately finds itself having not prepared appropriately to keep itself in business.
Thank you. Okay, I'm going to pivot to a related question. I call it an adjacent question, thinking about financial stability in the context of supervision and regulation of banking institutions. And I'm going to pose the question in the negative. What types of risks to U.S. financial stability arising from a bank or the banking system do you believe have not been or cannot be, maybe most importantly, cannot be addressed with supervisory and regulatory tools? And Tim, can I start with you? Oh, sorry.
Gosh, I really
Randy,
should
go
start
ahead.
with Randy.
No, I'm happy to start.
I saw your finger go up.
Usually, I'm the only supervisor on these panels. There are two of us here today, so this is good. I would defer, if you'd like to go first. That'd be,
All right. So I'll
Please.
I'll go first, or otherwise we'll be here till 2:30. So has not, I think, we've talked more than I think probably any of us expected to, or that the audience expected to, about cybersecurity, and that has not yet adequately been addressed by supervision. It may not be adequately addressable by supervision, or at least by bank supervision. Certainly the most fruitful, helpful engagement between the government and the financial system with respect to cybersecurity, I think, has tended to come, at least up to now, between the national security apparatus of the government and the banks, as opposed to from the bank supervision apparatus of the government and the banks. But it certainly hasn't been up to now, and I think that's something that we should be cognizant of.
Thank you. Tim?
So I guess I would just say simply that the one thing you can't stop, eliminate altogether for all time due to supervision and regulation is the reality that there will be periodic financial and banking crises. So it's a little bit of a circular answer to your question, but the point being, you know, no matter what is done on the supervisory regulatory front, something will happen. There will be a crisis coming down the pike. So a lot of good work has been done to strengthen the banks, make them more resilient. Right now, the focus has to be on a clear understanding that there will be future crises. They will have broader implications, and we need to consider that carefully when allowing banks to become of great size.
Thank you. Graham?
All right. Well, I think number one, again, it's important to remember, you know, to the extent that we're talking about firms that fall under the Enhanced Prudential Standards framework in particular, that those standards are not a substitute for this particular financial stability analysis. They are separate provisions of the law that presumably mean different things, or at least have a different relevance and different significance. If they weren't, then this review shouldn't exist at all, but it does because Congress wanted it to. Now, obviously, what it says and what it means, complicated question, but they're different, and there's a role for both of them here, I think. And so, you know, they're trying to achieve different goals. I think one is the prudential standards are there for, there is a firm in a particular category, however it got there, should be subject to certain levels of capital, liquidity, should be filing its living wills, should be stress tested. That is when the firm is there, however it got there. Organic growth, merger, whatever, once you're in that category, this stuff applies to you. And particularly for the GSIBs, the agencies are trying to make you internalize your costs to the rest of the system if you actually were to fail, to sort of offset your systemic footprint. The financial stability framework, that review is, should we even let you get into one of these categories to begin with? Is there a world in which you could have a firm where the framework does not actually allow them, that does not offset some of those risks? And not to go back to the same set issues over and over again, but some of the categories that exist right now do not necessarily grow progressively as firms merge within them. So you could think about a firm that can merge. It could start as a Category 3 bank. Let's say you have two Category 3 banks that merge. They're still Category 3. Nothing meaningfully about their footprint has changed other than they've got significantly larger. By the way, we know we have research from the Federal Reserve Board and others that say as you get larger, you do have more systemic risk, and yet they could have the same common equity tier 1 requirements they had pre-merger. So you could have one firm that has $250 billion in assets beforehand, later is $1 trillion, but is not a GSIB, and it has the same capital afterwards. And so I think there are areas where there could be gaps in those evaluations on the enhanced prudential standards side that do not capture what the increased risk is, and that's when something like a more searching financial stability review might be appropriate.
Interesting, thanks. Dan, what would you add in this dimension?
Sure, so I'm going to focus on two things, and I'll admit that I'm not entirely sure how either of them relate to the merger review process itself, but I'll throw them out there and see if anything sticks. The first is that there's been a lot of evolution in the ecosystem surrounding banks. We can call it unbundling, we can call it whatever we want, really. There's lots of manifestations of it, broker deposit changes, banking as a service, all of these sorts of things. And while the banking agencies, I think, have been pretty good at acknowledging that this ecosystem is changing and that it involves risks, it's growing, it's changing. There's not a lot of regulation constraining it, in my view, at the moment, and some actively encouraging it, that then creates cross-sectoral risks that we don't fully understand. And whenever I don't fully understand something, that's normally my trigger for thinking that there may be other people who don't understand it as well. The second risk is the post-crisis move, which was in many respects helpful towards liquidity regulation that somehow managed to make the US Treasury market more important, while simultaneously not moving forward with reforms to reflect the change in the structure and stability of the Treasury market. And they're a similar sort of story where changes in who's playing the game and what game is being played have not been something that regulation has necessarily targeted. While there have been obviously movements towards acknowledging these risks, it is a bit of the third rail. It is like brain surgery. We all understand that once you touch it, things can start to twitch and potentially die. But that doesn't mean that sometimes brain surgery isn't the thing that's in order to ensure the long-term health of the patient. So those two areas, I think, are one where the existing regulatory apparatus has not addressed potential risks. And I do think, especially, I know I'm the only person who ever talks about broker deposits, but stuff like broker deposit rules or the changes that were introduced in 2020 are actively creating these cross-sectoral risks and magnifying them that I think need to be taken into account, possibly in the merger review context, but just in financial stability regulation more generally.
Terrific, thanks. Okay, we're getting close to the witching hour here. Let me just give everybody 15 seconds to say anything they would like to say at the end. And let me just say before we wrap, I just so appreciate the incredibly substantive and detailed and specific sets of perspectives and information that each of you has shared today. I've found it terrifically valuable and insightful. So would you like to say anything quickly?
I'll just make a comment about the conference in general, that I'm really heartened by what I think is an increasing open-mindedness to understanding different proxies for the way that we measure competition or stability. I think this is a hugely important area, and 10 years ago, this was a much different conversation, and I'm happy that it's going in this direction. Thank you.
Thanks so much, Tim.
Yeah, I would agree with that 100%. It's fantastic. This stuff is getting a lot more discussion than it has in the past. I'm not sure I have much to add. I've sort of beat my horse a few times already. I guess I would just acknowledge the challenges, to be fair, to acknowledge the challenges in the financial stability assessment quantitative analysis category. And point out that the challenge doesn't lie just with the banking regulators, but across the regulatory framework. I still personally find it fairly hard to believe that in the United States there is not one non-bank financial institution who is currently designated as systemically important. So clearly we have an issue with our measures of systemic importance and how we make a new determination that an institution has now become systemically important.
Okay, thanks. Randy, final thoughts?
Sure. Dan's very last comment about sort of the relationship between banking regulation and kind of financial instability, the financial instability channel from the Treasury market, is hugely important. And if we had another 2 hours, we could talk about it. But my last comment will, I think I'll just sort of focus again on the large regionals. Because I don't disagree with Tim that we may not want another GSIB. Now, maybe if you broke into me sort of alone in prayer with my God, I might be praying for another GSIB. I don't know, but my point is simply that on the measure of financial stability that we have currently, the large regionals could become materially larger without coming anywhere close to being a GSIB. And I don't think that the right answer is just to say the game of musical chairs is over, but to live by our analysis with the frameworks that we've developed and lived with internationally and say this is our measure for determining whether there is a systemic problem, and there is not here. That's my last comment.
Okay, thank you. Graham, last word.
So I'll end on a positive note and the note of agreement, which was going back to the beginning of the conversation, which is I would just say I really do think this is an area where clear, transparent, and consistent standards, at least as an initial part of this analysis, would be really, really beneficial. Number one, You can put it out for notice and comment, and you can have people formally on the record as part of that process, debating some of this stuff in a more fulsome way. It is transparent, it is potentially more consistent. I don't think you can lose the qualitative part of it. But I also think over time, these things just have a way of kind of atrophying or just kind of becoming rote processes. And so I think without something on the books that people can really hang their hat on, I think this process could really start to devolve. And so I think it would be really, really beneficial to have something out there that people can respond to and that they actually look to each time you have one of these transactions. So I'll stick to a process point and not talk about anything else.
Okay, thanks so much, and thanks to everyone for attending. Thanks to the OCC for sponsoring. We're going to break now for about a half hour. We'll reconvene for convenience and needs at 2:45. Thanks.
It was a pleasure. I was having breakfast with Joe Carapi at this.
Our last panel of the day. As you know, prior to approving any merger, the banking agencies consider several aspects of the proposed merger, and one of the factors is the convenience and needs of the community to be served. This factor has received lots of attention over the past few years, and I'm excited to be part of this panel today to discuss several areas for us to consider when addressing this factor. We have a lot to cover in our session, but before I ask my first question, I want to introduce our panel today. On my left, we have Pat McCoy, is the Liberty Mutual Insurance Professor at Boston College Law School. Pat is a nationally prominent scholar in financial services regulation and helped form the CFPB back in 2010. Catherine, or Kate Judge, is to her left and is the Harvey Goldschmidt Professor of Law and Vice Dean for Intellectual Life at Columbia Law School. Kate is an expert on banking, financial innovation, financial crises, and regulatory architecture. Greg Baer is President and Chief Executive Officer at the Bank Policy Institute. The Bank Policy Institute is a lobbying and advocacy organization based here in Washington, D.C. And then finally, Renita Marcelin is the Advocacy and Legislative Director at Americans for Financial Reform. Americans for Financial Reform is a nonprofit organization that's comprised of approximately 200 consumer, labor, and special interest groups and advocates for financial reform in the United States. Now on to my first question for the panel. In evaluating the convenience and needs factor, the agencies review each institution's CRA performance evaluation record. What else should the agencies consider? For instance, what is the role of each institution's consumer compliance examination record and any existing consumer compliance orders, ongoing enforcement actions, or pending investigations? And I'll start with you, Pat.
Thank you. And I first wanted to thank the OCC for organizing what has been a really refreshing, forward-looking, visionary conference that has really opened up the discussion to these incredibly timely issues. It really is an honor to be here, so I want to thank the Comptroller. Since I'm a lawyer, I'm just going to start with the Bank Merger Act statute. It expressly states, in every case, the responsible agencies shall take into consideration the convenience and needs of the community to be served. So it mandates this as an independent factor in bank merger review. And it's a factor that reflects the long U.S. history going back to the first Bank of the United States, emphasizing impartial allocation of credit and enshrining that as a national value. So the words "in every case" means that the convenience and needs test needs to have bite. It needs to mean something. Unfortunately, research has shown, and we've seen some of that research today, that Bank Merger Act reviews have not necessarily served the convenience and needs of retail bank customers. There is extensive empirical evidence that after bank mergers, on average, bank fees go up, interest paid on deposits goes down, access to credit contracts to consumers and small businesses, and bank branches close, especially in underserved communities, following which predatory fringe banking institutions move in. And David Benson's paper was, I think, very instructive on that score. To give bank merger reviews teeth, I'd like to propose two sets of possible reforms. One are procedural in nature, and the other are substantive. With respect to procedure, the time has come to insist in the convenience and needs factor on evidence-based bank merger review. There should be no presumption that convenience and needs has been met. Instead, regulators should focus on outcomes. First of all, they should put the burden of proof of public benefits on merger applicants. This goes straight back to the Supreme Court's decision in Philadelphia National Bank. Secondly, regulators should insist on strong evidence, real evidence, demonstrating that the proposed merger will actually produce concrete public benefits. Assertion should not be enough. If there is no proof, there should be no merger. And finally, on procedure, projected cost savings to the institution to satisfy convenience and needs should not be enough absent proof that the bank will pass through those savings to consumers. And Dr. Wallen's paper is very much on point there. With respect to substantive reforms, regulators should consider three factors. One is the probable effect of the merger on consumer outcomes, the availability and price of credit, especially to small businesses in LMI neighborhoods, the availability and cost of other financial products that will help the financial health of retail customers. Branch closures or openings would be good, and the resulting effect on customers, the quality of customer service, and consumer data protections and privacy. Second of three factors, the institution's consumer compliance record needs to be taken into account, including exam ratings, enforcement actions, and adequate systems to ensure future compliance with consumer laws. Among other things, the meaningful input by the CFPB should be formalized. And then lastly, and I will conclude, let me just briefly mention CRA performance. We all have noticed great inflation with CRA. It seems to me that for a bank merger to be approved, the minimum CRA rating either needs to be an overall rating of outstanding, or if the institution's overall CRA rating is satisfactory, then all of its performance test ratings should be high satisfactory or above. Regulators could also consider a look back to the past two CRA exams to encourage institutions to make a long-term commitment to community reinvestment and discourage strategic behavior. And finally, I'll just close with an editorial comment, which is I think the proposed new CRA rule, if finalized, will improve matters measurably by making CRA ratings more objective and less prone to great inflation. So thank you.
No, thank you, Pat. Kate.
So I agree with everything Pat just said, and I'll try to keep my comments a little briefer in some ways because of it. It's funny, I'm a lawyer as well, so even though I automatically think about what I know goes into the merger requirements, I also started immediately by going back to the actual statutory scheme, and you see it embedded actually in two different places, and there right at the end is absolutely central. And yet, in some ways, it's one of the least developed of the three different topics that we're spending time on today. And I do think, unfortunately, the CRA is part of the reason. I mean, the CRA is an absolutely vital mechanism through trying to ensure that the institutional biases that have been built into the banking system and the provision of financial services is slowly corrected over time by having more accountability. And we know from like the first 12 years after the CRA passed, when it didn't have the teeth that it does through merger review, there really wasn't much of an impact. So it wasn't the legislation, it was the merger review, the mechanisms through which we gave the CRA teeth that we've actually seen some improvements, though I also agree that there have been concerns, and I think those are going to be addressed, actually, hopefully, once this new rule is finalized. But what's unfortunate about that is that even though that is absolutely necessary when thinking about whether or not a bank and then also a bank merger are going to serve the convenience and needs of the community, it's by no means sufficient. And if we think about the three different prongs, competition plays out differently in banking than it does in other spaces. You need to understand the unique dynamics at play with banking and financial services. On the other hand, there's a lot out there for what constitutes healthy competition policy and how to do competition policy. Then you actually have this concern about systemic risk that makes a lot of sense and it's unique to banking. And I think the last panel we actually saw that there's some disagreement, but there's also some agreement and there's like a lot of understanding, or here's what we don't want. And that's really what the systemic risk and concentration is about, is here's what we don't want mergers to allow. Convenience and needs is asking something different. It's asking affirmatively, what is it we do want? What is it we want out of the banking system? What is it we want out of banks? And therefore, what are the positive attributes, the types of services that we want to see improved upon as a result of enabling particular mergers? And I think it's really hard to answer that without some vision, some broader vision about what we're trying to achieve. And traditionally, again, the bank merger has actually played a very small role against a system where we really, through decentralization in unit banking, said what we want is a highly decentralized system. We actually are okay if there's high levels of concentration on a local basis because we're so worried about centralized power. And so we're going to have other mechanisms through which we really regulate the structure of the banking system to further particular aims. And then we really shifted. I mean, for the past 40 years, we've averaged 400 mergers a year. And the height of that was actually back in the 1990s. This isn't a partisan issue, right? It was under Clinton. I think it was 1997 was the absolute apex. And there we had a very different vision. The vision of that time was we're going to conserve Americans and consumers through globalized economy. We need multinational corporations that are being served by large multinational banks, and we need our banks to be competitive. So we had an affirmative vision. So it played out in these different prongs, but there was an affirmative vision that we actually wanted in some ways to allow not just banks to engage in a far wider array of financial services, but we wanted them to be of a particular magnitude, to be able to play a particular type of role. And I think what's interesting right now, and the reason the convenience need is having this like kind of mini heyday in terms of a conversation, is it begs us to ask, what is it we're trying to achieve? Like, what is it we affirmatively want to achieve? And I had some things here, and I think Pat went through it nicely, and that's where we can also start to bring in the empirical evidence. And it's not that all mergers create problems. I mean, small business lending is a great example, right? Small business lending, there was actually recent research that suggests when you have a large out-of-state bank acquiring a small bank, small business lending tends to go down. By contrast, when you have a merger between two small banks that are already operating in the same state, small business lending actually tends to go up. And so when we're thinking about convenience and needs, those are like the types of considerations that can now come into the picture of like, are you actually providing credit? Are you providing credit through the cycle for the different type of customers that are in your district that are not going to have access, whether it's to credit or to other financial services otherwise?
Greg, any thoughts on what else we should be considering in addition to CRA?
I'll start with a slight note of agreement. I do believe, and I think both of the prior folks agree, that if we're going to do anything here, we should actually write down what the rules are. Say that as a lawyer as well. Government works best when we have transparency and clarity. And to put it mildly, the convenience and needs factor is the least developed of all the factors. If you think about the process now, it is effectively a secret process. There are no real rules, and there's no real deadlines. And so if you think about this from the perspective of an acquirer, even if you have an outstanding rating, you enter the process de novo. While the agencies will tell you you do not have to do a community benefit agreement in order to have your merger approved, every deal for the last 5 years that's been approved has had a community benefit agreement. So you're probably going to be at this a year. That seems to be the new standard. You're going to have to negotiate secretly with a group of folks to which the agency has outsourced this function. The resulting plan will probably be secret as well. And then you may or may not get an approval. That's the bad news for the acquirer. For the target, even worse, right? Because the moment the deal is announced, people start quitting. And that continues for that year. And then at the end, what do you have left if it does not go forward? In the past, they've been able to negotiate breakup fees or ticking agreements. But I think as uncertainty grows, that will be more and more difficult to do. So it's really quite a mess. So the real question around convenience and needs and perhaps the system more generally is, first, do you actually want regional banks and mid-sized banks to continue merging? Or do you want to create a process where that is extremely unappetizing? Now, some people may say, yes, we absolutely want to stop that, and this is as good a way as any. But I think the last panel sort of hinted at the fact that, well, maybe those are the folks we want to be merging to compete with the very largest banks. And I think there's a lot of justification in that. The second, and it's sort of getting to what Kate was saying as well, the next question is how relevant do you want CRA to be? As you probably know, CRA is not self-enforcing. There's no enforcement mechanism. It's generally enforced through this process. So certainly banks have a reputational interest in having an outstanding CRA rating, but they also like having an outstanding CRA rating in their back pocket in the event that they decide that they want to do some M&A. And if you're effectively saying, well, that's not going to work out for you anyway, well, what's your incentive to have an outstanding CRA rating? So if you want to maintain the relevance of CRA, you need to maintain the relevance of the M&A process. And the third, and here I'll be a little mischievous, the next question is how political you want this process to be. Because if there are no rules, there are no rules, right? So, I've heard a variety of factors that should be considered. I could imagine appearing on this panel in 2 years. I might be the only one of us that's on this panel, but I might be with somebody from the American Petroleum Institute or some other organization. And the community benefit plan will be about ensuring that the bank or the merged bank agrees to support the oil and gas industry or other things. So again, if you want predictability and constancy, you probably ought to write it down. It's actually interesting. I looked at the the handbook, the acquisition handbook or whatever it's called for the OCC. It actually has fair access language in there. It's something about you need to ensure that you have continued to offer accounts to people and not terminated accounts to people based on the type of business they're in without a risk analysis. And that's pure fair access language from the last acting comptroller, which could certainly come back. So putting all that together, clear rules, making CRA relevant, depoliticizing. I go exactly the opposite way, I think, of some others, which is I think, when you do your CRA exam, that's a public record. People are able to comment on that process. I think if you get an outstanding CRA rating, you should have a presumption of approval. Obviously, if there's something that occurs afterwards, that could be revisited. I think if you have a satisfactory, it ought to be a mild presumption of approval. And if you have a needs to improve, it ought to be a presumption of denial. But I think that at least would add some rigor and certainty to the process. So,
Thank you. Renita.
Hi, yes, thank you. It seems like I'm the only non-lawyer on this panel, but either way, I too want to go back to statutory language. And as Pat said, the convenience and needs, and Kate said it as well, it's mentioned numerous times. So the first time is mentioned just as one of the other factors with, financial stability, which was added post Dodd-Frank, managerial resources, and such. But the second time it's mentioned is actually a higher standard, in that if the bank, the pro forma bank is formed, and the DOJ in their review sees that there will be anti-competitive effects, that it's on the bank actually to prove how this merger will be in the benefit of the public. And they use the language convenience and needs to go forward with the merger despite the anti-competitive effects. And, I think, one, that it's mentioned twice, and then two, that there's this higher level of scrutiny that the law then applies to it, speaks to just the importance and the, serious congressional intent of this criterion. And the fact that it has not been fully developed as such is really jarring. And I want to go back to the historical perspective as well that Kate mentioned regarding the CRA. Yeah, it is kind of true that unfortunately when the CRA got passed in 1977, that the convenience and needs factor really kind of went downhill. If you look in the 60s and 70s, banks would, regulators would actually look and evaluate and see, oh, this, merger will, advance overdraft services, and this is not in any way an endorsement of overdraft products, but, or, 24-hour banking, or, they will be expanding check-in that this pro forma merger would allow. And the regulators will actually comment on, what the benefit will be. We see post-CRA, it kind of just became an assumption of, how are your CRA compliance, which is also a little bit of a problem, to put it mildly, because it's supposed to be prospective analysis and not retrospective, which is what the CRA does. And then it gets to the point where the regulators are kind of just repeating what the merging parties said in their application, and then just saying, yes, this is how it will benefit. So, with all that context, just to add, I think part of the issue, and Kate went into this, is the fact that we have not actually defined what convenience and needs looks like for a particular community, for the communities involved that would be affected by any given merger. So like I said, in the 60s and 70s, they tried to do that, but even still, it's one of the mergers, and I'm probably gonna mess up this name, but US versus Crocker Anglo National Bank, the federal court literally said, first, the regulators need to define what the convenience and needs is of this community, and then determine how the merger will affect. And I think that definition and really like that positive view of, well, first of all, what is it that this community needs, right? Is it more branches, right? Is it more ATMs? And then from there, deciding how the merger will affect that. That is, I think, how we should be thinking about this aspect. And, I agree with some of the other criteria that was already pointed out. Small business lending, right? HMDA data, mortgage lending data. Even now we have digital payment services. How will this, affect? A lot of us do online banking. That may not be the case in low and moderate income and, Black and brown communities. They, those communities, you tend to see a higher percentage of in-person banking. But still, all of these things should be considered and evidence-based, not just, speculative language, but what is pricing gonna look like before and after merger? What will be availability of your services before and after merger? That is, I think, how regulators should be approaching this factor.
And I want to touch and expand upon one of the aspects that you talked about. The agencies, as you know, currently are trying to see what benefit the convenience and needs are to the community. And this is obviously a forward-looking review. To what extent should applicants be expected to provide forward-looking information and projections, such as projected branch closures, consolidations, openings? And is there any quantitative information that should be required? And I'll start this time with Kate.
So I think very obviously yes, in terms of should this be a more forward-looking process than it has been. And I think it's been one of the great developments in a lot of different policymaking arenas. And we see it in bank regulation, in the shift from, let's just look at capital ratios based on static, backward-looking balance sheets to let's engage in stress testing. We're seeing it in competition policy where HHIA is the starting point rather than the end point. And you're thinking about, well, what would the changing competitive landscape have evolved to potentially look like? Rather than just looking at what it looks like at a starting point. So I think one, there's been a really important move to say it's noisier, it's more speculative, and it's a lot more difficult. But for a lot of what we care about, what we want to do is try to balance out rigor with an effort to actually look at forward-looking at what is going to be the impact in ways that actually matter. So I think that overall shift has to be part of it. I think it already is part of it. And one is banks are already providing a lot of this information. We just haven't created a good, structured, transparent way to figure out how that relates to convenience and needs. So if you look at the merger application, they are having to say, here's what our balance sheets are going to look like. Here's what our income statement is going to look like 3 years out. Here's a bunch of assumptions that we're making to make those determinations. Here are the banks that we're going to potentially close. Here are the significant changes in the services that we're going to provide. So a lot of it is being provided already, but it's not been linked to, and this really is one thing that came through, I think, all four set of comments, in an explicit way. Well, what does that actually mean for the communities that you're talking about? What are their needs? And then what is the relationship between the types of changes that you foresee? And then how do we go back and start to think about accountability? And again, I think there is a place for more transparency. So is it something like comply and explain, where there's a public process, there's not actual teeth to it, but there's at least ways of having structured and continual look back. So when there are promises, we can see, are they promises kept or are they promises that are not kept? And were they not kept because the pandemic hit and, things change? Or were they not kept in ways that we're actually really worried about whether they were made in good faith, in which case maybe that needs to trigger some supervisory concerns as well. So there's a bunch of really interesting tools that we can think about that just help to connect the dots through some of what is already happening. But going to Renita and the point so many others made, we need to have that vision over what we're trying to achieve.
Greg, any thoughts?
Sure. I think we probably all agree the current situation is a little odd, and that you make these commitments, some of them aren't even public. There really isn't an enforcement mechanism for them. Of course, the banks would be very leery to make those commitments if there was an enforcement mechanism, because the future is very hard to predict. I think on the case of balance sheet, sure, they make projections of the balance sheet when they do their application, but if there's QE or a financial crisis, nobody's going to accuse them of breach of contract and make them pay a penalty. So this is a very difficult area, because the more you make it hardwired, the fewer you're going to get, and the more awkward they might become. So, I don't really know where you land on all that. I am sensitive, though, to the fact that it is sort of odd if you have policies you want, whether it's setting prices or 24-hour banking or digital or services or whatever, that you would only impose those to banks that choose to merge. I would think if you want those things, and Congress wants those things, or maybe Congress gives the authority to the regulators to require those things, you need to require them for everybody. You wouldn't just wait till every couple of years somebody files a Bank Merger Act application and say, okay, well, you've got to offer 24/7 banking or do the following ESG agreement or whatever it is. So it seems like a very clunky way to regulate, especially with no real statutory sort of force behind it in terms of anything specific. Again, getting back to the fact that nobody knows what convenience and needs means. But so I wouldn't try to put too much on this horse, lest it sort of break down and become awkward.
And Renita, I know you spoke a little bit on this. I don't know if you have more to say, but I want to give you an opportunity if you did.
Yes, I do. So, well, first, those are examples of how the digital banking services and the overdraft protection, for examples of how regulators actually try to do their jobs in the 60s and the 70s and actually, figuring out how it will benefit, I think the main point here is when you are actually evaluating the convenience and needs, that you actually point to tangible benefits that the pro forma bank, the merged bank, could provide the community. Secondly, I just want to also touch on the point of the community benefits agreements, which Greg, you mentioned earlier. That, it has really been outsourced. And I think one of the things that we can do to make the prospective requirements actually codify that. Like in the approval order, as you go through the community benefits agreements, what has been hashed out, and I don't think it should be outsourced. We have NCRC, for example, a wonderful nonprofit National Community Reinvestment Coalition that spends a lot of hard, earned time doing this, and it should kind of be a governmental function. And, if we go back to example for Key Bank and First Niagara, their merger, what was that, back in 2016, and you see NCRC very publicly breaking with them, actually in December, that just passed, saying that they really did not hold up to anything that was agreed in the community benefits agreement. And as a matter of fact, they slashed their lending to LMI communities, low moderate income communities, by half, going from 35% to 18% from 2018 to 2022. So we see, like, it sounds good and, and makes everyone involved kind of feel good, but what's the point if there's no enforceability? So, maybe one just very obvious solution would be to codifying this. And the benefits that the merger applications, some of them write a paragraph, some write more, make sure that this is being held, whether it be in the supervisory, the examination process or the supervisory process, but this is actually being revisited.
Thank you. Pat?
Tara, this question sounds technical, but it really is the real rub. Because both Congress and the Act and then the Supreme Court said that bank merger review is to examine whether the merger itself will result in public benefits, and by implication, greater public benefits. So I think Congress has made that decision, and it's in the Act. I would, channeling Renita, I would require applicants to submit what I call a public benefits plan to the regulators that identifies the public benefits that will result from the merger. And this maybe is a substitute for community benefits agreements. I haven't really thought that through carefully, but instead of outsourcing it, we might take it back and have the plan be made to the government so that it is enforceable. In the plan, the projected benefits must be concrete and quantified. Now, of course, the question is, well, these are forecasts. However, forecasts can at least partly be anchored in actual facts that are demonstrable. And to that extent, real evidence can be brought in to prove that these are solid assumptions. So I would be more probing about that. I might, where possible, require applicants to provide actual contractual commitments to expanded activities, or at least business plans that have fleshed out what an expanded product offering would look like. Secondly, there are also situations where applicants promise not to curtail specific services or not to sell consumer data. I would condition approval on those commitments. I would make that part of conditionality. Third, I would require the resulting bank to disclose all expected branch and ATM closings as part of the application, and then place a moratorium on any other disclosures, any other closures over the next 2 years. In other words, the response, we haven't made a decision yet, is just not good enough. We need a commitment at the application phase, and if not, then there will be a moratorium. And then the last thing is I would require the resulting institution to present a concrete plan for how it will integrate its systems to ensure a smooth customer transition and the accuracy of consumer accounts. And I'll just close by saying, back in the 1990s, as a young lawyer, I got a car loan. I bought this car. I paid off the loan after X number of years. And then sometime later, I went to apply for a home mortgage, and I was told I was 3 years delinquent on this car loan that I paid off. And it had just gotten lost in a bank merger, and the systems did not integrate. Fortunately, we straightened it out.
Thank you. So I do want to switch gears and talk about the term community, because it's a very broad concept. And are there ways that the agencies can better ensure that the convenience and needs of all stakeholders in the community are appropriately understood and evaluated? And Greg, I'll start with you this time.
Short straw. Yeah, I mean, it's a very interesting question. What's the community? And who decides? I mean, it's clearly not supposed to be a vote. I mean, there's not supposed to be a referendum, although, now we have public hearings fairly regularly. I actually went back to see where we first saw convenience and needs as a standard, and it goes at least back to 1935. It was originally a standard for getting de novo deposit insurance. There was also a suggestion that it was sort of an offset to competition, where even if it was going to be a little anti-competitive, if it would serve the convenience and needs, you go ahead and approve it anyway. So that seems to envision sort of a narrower vision of community, I think, than perhaps some would envision. But I don't know how important it is to define community as long as you have a process, whether that's through the CRA process or some de novo process at the time of the application is filed, where anybody who feels like they're part of the community can step forward. Of course, that, this being, human beings, that will tend to be the unhappy people. The person who's gotten the successful small business loan or really likes their app probably isn't going to step forward and say, I'm part of this community, approve this merger, but, what can you do? So I'm not sure there's a really easy answer to this question, but I'm not sure there's really, and it's really that important to answer that question. I would say just one other thing, sort of going back to the last question, because I had a new thought. I think in terms of what everybody seems to want, which is we need to know what the rules are, the bank needs to do what it promises. This would all be a whole lot easier if there were shorter timeframes on all this. It's sort of a weird historical accident. Someone might know the reason that, under the Holding Company Act, it's 90 days. Bank Merger Act, it's 1 year. Of course, conceivably, the Fed could decide after 90 days, and then you'd wait, another 6 months. But it tends to go the other way, which is it's a year. If you shortened it to, say, 60 days and said, okay, well, we're going to decide in 60 days, and we're just going to turn you down. I think that would be a lot more transparent process. Banks would know rather immediately whether it's going to work out or not. And I think that's a way to solve some of the uncertainty and oddness of the process that we have now.
No, thank you. Renita.
Yes, thank you. AFR and BPI agreed on some points. It's nice to see sometimes. But no, I do agree that maybe going back to Pat's comment on if we start with a presumption that it's not going to benefit the community, and therefore it's a much easier route, and then you prove how you are, and then then it's yes, then all parties involved will kind of know upfront whether or not this is going to work out. But in terms of define a community, I do think it's important. I'm going to give a little shout out to my former coworker, Patrick Woodall, who actually did some research using FDIC's data and showing, so for example, the geographical markets that is used to determine how condensed, using the HHI to determine the HHI factor, which goes back to the competitiveness. If you, for urban areas, the MSA is used, which includes like the urban core center and then the surrounding suburban areas. So, I'm from Brooklyn, New York. There's a Chase on every block. If you go out to Long Island or Westchester, that's not the case, right? So like the banking experience that I have in Brooklyn is much different than some of my friends in Uniondale, for example. And Patrick's data really emphasized that point, that where you define community will give you a very different outlook on what those needs are, and then going back to the competitive factor, which I know is not necessarily the purview of our panel, but they kind of interlap here. So the question you kind of ask determines the answer you get here. And the community area you're looking at, I think it's important to be clear on what is again, going back to this positive vision, if we want to see what this community needs, it's very important that you define who and what is in that community and the boundaries of said community, because then you can lead to very different outcomes.
Pat, any thoughts on community?
Okay, thank you. My remarks would be a little adjacent to the core question. I was thinking about ways in which the term community loses meaning, and one of the ways that it loses meaning is to the extent that the public is excluded from the bank merger review process. And I've been actually very heartened to see that across our panelists and across multiple panels, there have been calls by virtually every speaker for greater transparency. And I think this is a place where it also gives real meaning to what a community can offer. First of all, for large bank mergers, I would provide more public hearings. The Comptroller, in his amazing speech on the bank merger review process, stated that the OCC was considering adopting a presumption in favor of holding public hearings in mergers involving larger banks. I think that's an idea worth consideration. Second, if I can return to my proposal for a public benefits plan, I would require applicants to work with community members and community groups to develop that plan. And then finally, I'm going to close on a controversial note, which is I would reform the current pre-screening process. Currently, regulators sometimes grant a confidential pre-screening of merger proposals to merger partners. This cuts out members of the public from having input at what is a very crucial early stage. And once regulators inform applicants that they see no, I think the term is barriers to approval, there's, if I can hearken back to behavioral economics, there is a concern that the decision makers subconsciously are now predisposed to approving the merger at a point at which there has been no public input. So I would prefer to eliminate pre-screening, but if not, then make all of the discussions, analyses, and research during the pre-screening phase public and provide an opportunity for public input.
Great, thank you. Kate.
A lot has been said, so I probably want to reframe and really bring out what I think has been a central theme, which is understanding community in this context has to be co-determined with understanding what are their convenience and needs and how they interact and how they're currently being served and how they could be served. And it's one of the key points I think Renita is really bringing out is we're dealing still with an environment that's incredibly diverse depending on where you are. And when you're looking at a map, you're not going to capture what you need to capture. And so the notion that you can kind of like sit on a map and draw a line, and here's how we're, here's where these current banks operate, here's where these banks operate, and that's how we're going to define community, isn't going to work. What you really do need is a process that's both top-down and bottom-up, where there is the guidance and the principles that are being provided from the top, so that there is some type of analytical framework and consistently applied analytical framework that gets refined over time, so you have something that's workable. But where there is the mechanism for the community feedback that Pat was talking about, because it allows you to see very different types of communities. And I would actually disagree with Greg that the only people who are gonna come out are the people who are unhappy. I mean, I think actually there's a lot of banks that have very close relationships with at least some of their clients, and it depends on the bank. But I mean, I've recently had to deal a lot with the State Bank of Graymont, which is a very small bank in Pontiac, Illinois, because I'm now managing finances that involve 40 acres of farmland. And it's been an amazing relationship to have. But there, the needs look very different. I live in Manhattan, right? So even a community bank in Manhattan that's serving small businesses is going to be very different than Ashley, who knows everything I could possibly imagine about farmland. I mean, she understands kind of all these tax issues that I didn't understand and has like been guiding me through all these different processes. But then understanding the convenience and needs in that community is necessarily going to look different. So there is this balance between standardizing and creating rigor and transparency, and then understanding actually different communities have very different needs, which is why you need the mechanisms for feedback. And so it's why thinking, as I think Pat is highlighting, we have to think about this procedurally in addition to setting out the principles and understand how those can be co-determined in a time frame that's realistic, given the circumstances, and in a way that creates a record that also allows future potential merging parties to be able to look to that and understand what they can look to. But I do think community might be a squishy word, and it might be a word that came from a very different era, but it's a word that they've chosen to leave in. It's there throughout the statutory scheme. It's there for chartering. I mean, it's at every single stage, and you're asking kind of like, well, why are we worried about this moment? And I think Congress has chosen, like, at chartering, when you're engaging in a merger, when there's certain types of decisions, where we're going to do something that goes beyond what we're going to ask of companies in other spaces, and this is one of those areas.
So before I move on to the last question, Greg, I didn't know if you wanted to respond to any of that, or?
No, I think I generally agree with that. I mean, I think it's also worth noting. I mean, I think, and some of this gets to the timing point, but I agree with a lot of what Kate said. I mean, even if there were none of this, banks announcing a big merger, perhaps like other companies announcing a big merger, would announce a community benefit plan, right, on their own motion, right? They want new customers. They want people to think this merger is good for the company and for the community. And so left to their own devices, I assume any bank in America announcing a merger would come out with a presentation about how they're going to benefit the community. I think where we ought to be in terms of a process is they make that announcement on the day of the merger, and then they're judged on that, as opposed to they make that announcement and then they go into purgatorio for a year, where other things are discussed non-transparently and with no guidance or rules. So again, I think you can easily combine the desire to do more for the community, accountability, and benefits for everybody, including the banks that want to have some certainty, if you just sort of have it clear at the outset what the rules are, and then have a time frame that's conducive to actually getting things done.
So I know we've gone through several different issues, but I did think it was important to kind of have one final question that allowed you to talk about anything we haven't talked about here today, because this group is not shy. They have a lot of ideas, and they've been a great panel to work with. But I did want to make sure that you all had an opportunity to talk about anything else that you wanted to talk about as well. So I will open it up to see if there's anything else that you want to address. And I'm going to start with Renita.
Thank you, Tara. Lively discussion indeed. I think, going back again to the examples, because to me at least, it was kind of astonishing and pleasantly surprising to see the amount of, challenges that actually, like whether it be the DOJ, bank mergers was not a foregone conclusion that your merger would get approved. Going back, I'm a millennial, so 30 years ago, like I get messed up, so what's that, like 50 years ago? So, going back to the 60s and 70s, and I'm struggling to count how many decades that is, but yes. But my point is that the reason they were able to do that is because, the banking industry, one, we had the law where you weren't allowed to lend more than 10% of your capital to any one borrower, right? And, the banking industry still was in a very innovative phase, and, some may argue that they are still today. But my point is that it's not as clear to what the public benefit of a merger is right now. Greg is smiling at me, but the public benefit of a merger is right now. Whereas I think, if we look in the 60s and 70s, when the industry is not what it was today, that it was more clear then. So if we start from there, and again, going back to this point, I think we need to put a lot more emphasis on the banks to prove, more than a paragraph in their application statements as to how they're gonna benefit the public. And that really needs to be developed. And again, the tangible evidence-based plan that they put forward and regulators using that. The one thing I will add is we talked a lot about the supervisory process and how a lot of that is done in secret. That's the supervisory process in kind of in general. And a lot of folks have called for more transparency there and lots of other facets of bank supervision. But it is really hard now to see how mergers, just in general, at least the vast majority of them benefit the public. And I think that's something that regulators, it's a real reframing and shifting in our thinking.
Thank you. Pat? Or I can go elsewhere if you want me to start.
No, I got complacent. I just made an assumption. This is good. Keep us on the toes. So I guess my one thought is to think about the interaction between approval of a merger and subsequent CRA examinations for the resulting institution. What is that interaction? And one thought that occurs to me is in subsequent CRA examinations, the agency should include in the rating the fulfillment of commitments that the resulting bank made during the merger process. Now, part of those commitments will be general commitments about expanded deposits, flow through pricing advantages to customers, et cetera. Others might, there's this controversy about enforcing community benefit plans because they're negotiated with non-governmental agencies. One reason I find my proposal for a public benefits plan offers an advantage is that would be a commitment to the government and would be enforceable and would be rankable in a CRA examination.
Kate. So first, before we get into what else we said, it's worth just emphasizing how much, there's been some meaningful differences, but there's also commonalities, right? Which is that this process does need to be more transparent. Things like the community benefit agreements have served a very useful role, but they might not be the optimal tool for a lot of what we're trying to promote. It doesn't necessarily create the public conversation, the breadth of conversation that we would like to have, and it also doesn't create that ongoing understanding over here's what we need to have in terms of when other potential merger partners are looking at whether or not this is something that's going to work, they're able to actually look at a very clear track record of here's where the deals actually managed to get approval, here's where they got approved in a timely way, and then what are the steps that we need to take, not just in negotiating with the potential target company, but also in engaging with the community. And there's no reason that has to start later on. That needs to be, and for a lot of banks probably is, already an ongoing process, but what do all those different pieces look like? So one of the things that just to note is already where we are at right now is different than what this scheme looks like, and is moving towards saying there's at least some areas where we need to move forward. In terms of additional things, I would say that we ought to look at this as a real moment of opportunity. We are at a point of time where there's been a real shift in economic policymaking, generally speaking. There was, for a very long time, a focus and assumption, and Pat referenced it earlier, where we assumed that mergers were going to create efficiencies in banking and in other domains, and we assumed that those efficiencies would eventually accrue to the benefits of consumers. And so I think part of the reason this is underdeveloped is because of the role the CRA has played, and partly is because of certain assumptions. And we're starting to see a very different mindset taking hold of economic policymaking in a whole variety of ways that is yet to fully infiltrate conversations around banking and financial services. And I think in some ways it's importantly a different conversation. You know, I think part of what the conversation is we need to have here is if we actually want to have what, again, two different administrations, so it's not a partisan divide, have said where we want there to be slightly less concentration, and we also want there to be real opportunity for small businesses, and at least more recently, there's also been a lot of concerns about equity and impact. Well, what is the financial system that provides consistent through-the-cycle capital to enable that economy to flourish and to enable individuals within that economy to actually flourish? Like, what does that system look like? And I think part of the convenience and needs is not trying to figure this out in isolation, whether it's looking historically, even though that's part of it, or looking just at the communities and perfecting the processes, but it is starting to develop that broader vision. And I might be biased. I came this morning from another event where people are rethinking the federal home loan banks, and I'm so grateful they are, but part of that too is we have this incredibly large GSE that has gotten very far removed from its initial mission. And that's also an invitation and an opportunity to rethink, well, what is it we're trying to achieve? So I would just put in a plug for convenience and needs being one mechanism of a broader conversation that we're only going to make meaningful progress on when we start to understand what does the banking system look like relative to the non-bank system, and what do we have? We have a positive vision, even though we can't figure it's not going to be centralized planning, but affirmatively, what is it we're trying to achieve? And I don't think we yet have that full consensus, but I think we can understand it by looking at the banking system, or even looking at the banking system and financial system, is looking at the two in connection with who they are serving and who they're not serving in the real economy.
And Greg, last but not least.
Yes.
Get the final words on this.
As a former litigator, the perfect dream, the last word. I'll take it in a very different direction, and then maybe come back to what Kate was saying a little bit. I just wanted to talk just for a second, because it's come up on this in other panels, about the overemphasis, one might say, obsession with branches in the context of mergers and acquisitions. Here's some things we know. For the 30-year period, 1980 to 2012, the number of banks in the country went down by more than half, so I think 14,000 to 6,000. At the same time, the number of branches more than tripled. So 38,000 to 85,000. So record consolidation in the number of banks, record bank branch growth. So clearly mergers did not then lead to branch closings, quite the opposite. Over the last 10 years, we've seen branches close, 10,000 branches. Now, is that because all of a sudden bank mergers are having the opposite effect, or is that because of mobile banking? Seems like it's probably mobile banking, but we actually know for sure because our researchers, I shout out to Paul Kalem, who's our lead researcher in this area, did research and showed that the number of branches closed by banks that did not engage in a merger was about the same, actually a little higher, than banks that did engage in a merger. Which kind of makes intuitive sense, because if you think about your street corner or your neighborhood, it can probably only support so many branches, and it can support those number of branches whether there are 3 banks that own those branches or 1 bank or 2 banks. We also know, which is super fun, in terms of LMI areas, that over the last 10 years, 16% of the population growth has been in those areas. 23% of the branch growth has been in those areas. So those areas are getting more new branches than other areas. We also know on the flip side that they're getting, there's still net fewer branches, so they're getting branch closings, but they're also getting fewer branch closings than non-LMI areas. We also know, great fun data set, that the average distance to branch that you have to walk from your home in an LMI area over the last 10 years has changed from 1.35 miles to 1.34 miles, so 50 feet. So that, again, does not seem like a big driver of problems. And the most interesting and important thing, though, is if you look at the question of financial inclusion and who's banked and unbanked, and the number of unbanked is shrinking a lot, the branches are not a driver. The driver is access to technology, access to a phone, and financial literacy. And so if you care about the future and you care about financial inclusion, you'd stop talking about branches and start talking about things like those. You'd also talk about, and I think a signal success, and this gets to sort of the broader picture that Kate was trying to paint, or was successfully painting, is the Bank On program, which I don't know has gotten any mention today, where you now have, I think, over 60% of the accounts in America, banks in America are offering a low-cost bank account, which is a great thing. I think they will end up getting CRA credit for it. I would hope they would get credit in whatever merger process exists. But if we're thinking about how to make it a more inclusive system, I'd stop talking, especially given that there are digital-only banks out there that don't have any branches at all. So I just think it would make a lot more sense if we got off that and onto the things that are actually going to matter in terms of whether people are going to get banking services. And with that, and with no fear of rebuttal, back to our moderator.
I know, I was a little hesitant to give you the last word, but I did. So a couple of things. One, I did want to say thank you to the OCC for letting us have this panel. And I do want to thank the panel themselves, because you guys have been a pleasure to work with. It's a very passionate group, and I've enjoyed all the conversations we've had prior to today as well as today. So I just want to say thank you to you. And then third, I did want everyone to know you have a 30-minute break until the next session. So thank you very much.
Thank you. If are we live here? We are live. If everyone could please take their seats, we're approaching our final session. Please make your way to your seats. Get comfortable. I wanted to take a minute to offer a round of applause for all of our panelists and moderators right now. So thank you. It's just been a tremendously positive conference. Just far, far, far exceeded my expectations. This has just really been a rich and interesting conference so far. It is now my great pleasure to introduce our keynote speaker, Professor Peter Conti-Brown. Professor Conti-Brown is the class of 1965 Associate Professor of Financial Regulation at the Wharton School of the University of Pennsylvania, co-director of the Wharton Initiative of Financial Policy and Regulation, and non-resident fellow in economic studies at the Brookings Institution, and he deserves every bit of that title. A financial historian and legal scholar, Professor Conti-Brown studies central banking, financial regulation, and public finance. He has authored numerous books, including The Power and Independence of the Federal Reserve and The Law of Financial Institutions, a leading textbook on financial regulation. He is also the author and editor of several other books and articles on central banking, financial regulation, and bank corporate governance. He is the recipient of numerous honors, grants, and awards, including multiple Excellence in Teaching and Research Awards. He's also the author, with Sean Vanetta, of a forthcoming history of bank supervision to be published by Princeton University Press. Last year, Peter invited Mr. Su to give a speech at the Wharton FinReg Conference, where Mr. Su addressed the topic of bank mergers, and to quote a song from the 1980s, "One thing leads to another." Please join me in welcoming Peter Conti Brown.
So that's why I was invited to give this keynote. I'm honored to be here. You can tell how honored because I wore a tie for the first time in an academic setting since I was a PhD student. But you can also see that I haven't let this go to my head because I'm still wearing a tweed jacket with elbow patches to stay true to my academic roots. And before I get started, in the tradition of a Washington, D.C. speech, my disclaimer. I'm not important enough to have anyone interested in disclaiming what I have to say. But if I were, I would insist that if anything I say seems wrong-headed or factually flawed, please blame Comptroller Hsu and Deputy Comptroller McDonough for inviting me, since they should have known better. Now let's take a look at some trends in the number of banks over the last century or so. So here we have 1950 and 1940, the incredibly sharp decline from 30,000 banks down to 14,000, followed by a tiny blip upward and then a steady decline thereafter. Here, jumping ahead, 1985 to 2000, I jump ahead because that 14,000 number, keep your eyes on the y-axis, stays relatively constant until, in the 1980s, it collapses yet again to where we are today. And this leads to some important conceptual questions, such as, does the secular decline in the number of banks matter for the policy purposes for which we regulate banks and regulate markets? Also, why do we regulate bank mergers at all? What are the political implications of more bank concentration? What are the political implications of less bank concentration? And which is better for financial stability, for consumer financial protection, economic growth, even dollar dominance? Are traditional principles of antitrust compatible with traditional principles of bank supervision? Are innovative approaches to antitrust compatible with innovative principles of bank supervision? And let me rephrase the question at the top because it's at its core. What is the purpose of bank merger review at all? In my remarks today, I'm going to answer none of these questions. And that is, I'm not going to answer any definitively. But I hope to convince you through a brief tour, about a 30-minute tour through our history, that these questions are indeed unanswerable definitively, because bank merger policy has long been, and is ever likely to remain, the domain of political contestation precisely along these lines. It was a delight as a historian to attend such a robust conference where we saw in each panel a commitment to a particular pillar or silo that seems not only separate from the panel that came before, but in deep tension with it. And so it has always been. My hope then, like any good historian, will be to destabilize your certainties about this melange of factors and increase the coefficients of doubt in your mental Bayesian model of what you think bank merger review should be for. Because if you feel sure that concentrated banking is bad for these factors, consumer financial protection, financial stability, competition, and the like, I'm going to present some inconvenient facts that would make that mental model at least a little harder to sustain. And if you feel sure that concentrated banking is the key to economic growth or financial innovation or competition or to all of these other factors, I hope to convince you that you too are very far away from a sure bet. So let's start then with the long and what I'll call the awkward progressive era, by which I mean the uneasy interchange between the Morgans, and there's J.P. Morgan, father and son, and the Roosevelts, Theodore, his niece Eleanor, and his fifth cousin once removed, Franklin. When Theodore Roosevelt, the great Rough Rider, came into the White House in tragedy, it was not obvious that he, a Republican, would do so as a reformer. To be sure, he'd made his bones before his great charge on San Juan Hill as a reforming governor of New York and the head of reforms in civil service, but in the Gilded Age, reform simply meant opposition to machine politics and the spoils system of the Jacksonian democracy. Roosevelt had a partisan interest in this kind of reform in New York State, but he also had a family and patrician interest in keeping the corridors of Republican power more or less intact. So it was that he accepted the nomination as vice president on a presidential ticket that was the very embodiment of machine Republican politics, this time out of Marcana's Ohio. But this was not to last. Roosevelt, after the assassination of William McKinley, proved to be his own man, including and especially in relation to one of the leading issues of the day, the problem of the trusts. He assaulted the, quote, malefactors of great wealth, in that evocative phrase that's sometimes mistakenly attributed to FDR. He continued, great corporations exist only because they're created and safeguarded by our institutions. It is therefore our right and our duty to see that they work in harmony with these institutions. And with this, it was a declaration of war, as the Roosevelt Department of Justice launched into an affront to the Morgan interest. Now, J.P. Morgan, the man and the institution, was the face of these targets of presidential ire and governmental prosecution, what he and his associates might have termed governmental persecution. What is ironic for our topic today is how little TR cared about the question of banking at all. For so prolific a polymath as Theodore Roosevelt, he was, there's no better word, ignorant on the fundamental operations of the financial system. We have very few recorded thoughts that he has on the topic, none where he acquits himself well. And in fact, he appointed his tennis buddy, Lawrence Murray, I assume his portrait is hanging somewhere in this building, as Comptroller of the currency at the twilight of his presidency. And during the Panic of 1907, one of the greatest cataclysms financially the world over, Theodore Roosevelt could barely respond to telegrams. He delegated the responsibility to his former personal secretary, whom he had appointed Treasury Secretary, George Cortelyou, who in another twist of irony felt helpless and delegated the government's response and the government's money to J.P. Morgan himself. Now, the Panic of 1907 reflects the first moment of tension between the trust-busting president, the ethos that takes on the malefactors of great wealth and their concentrated power over the economy and the polity, and the problem that occurs when a mostly ignorant, diffident banking president like Theodore Roosevelt lean on those very same people to save the nation from ruin. What accounts for this tension? How do you go after J.P. Morgan, the man and the institution, and those interests that he had helped organize through trusts and consolidations in one minute, and in the next hold up J.P. Morgan, the man and the institution, as the last best hope from financial ruin? Well, the explanation for that tension is in the very conception of what banking and antitrust meant to each other in the progressive era. The money trust, as it came to be known 5 years later, was a great evil to progressive reformers, but not because of their concerns about concentrated banking. The evil was in the ways that such bankers would concentrate and manipulate industry to its own ends. Now, despite the fact that the primary articulation by Louis Brandeis, whose name has been invoked in this conference today, on his views on antitrust was in fact directed at bankers, his book, Other People's Money and How the Bankers Use It, still rewards its readers. I still assign it to my MBA students when they take my financial regulation course. The fact of the matter is that in that book, he doesn't care at all about the concentration of money. Arsène Pujol, who launched the money trust hearings in 1912, which was the but-for factor in the passage of the Federal Reserve Act, did not care about the concentration of banking. They cared about the money trust controlling access to funds for other parts of the industry, industries, which were then in turn organized and concentrated. Now, the Wilson administration did little to shift this gaze. The Clayton Act of 1914, which was passed in response to Louis Brandeis's essays and book, took aim at bank participation only at the level of bank and business corporate governance. So note well that Brandeisian influence. But it did little else to reflect on bank mergers themselves. A major part of this failure was because there could be no effective concentration of banking. Not then. State and federal laws prohibited it in this age of unit banking. The Federal Reserve Act of 1913, the other major piece of Progressive era reform legislation, has almost nothing to say about bank mergers beyond reaffirming that uniquely curious American commitment. All of this started to shift during the New Deal. And here, Franklin Roosevelt, the former progressive stalwart in the Wilson administration, who recovered from polio and a walloping in the 1920 presidential election, where he was the vice presidential candidate, by becoming an innovative governor and the most successful presidential candidate in U.S. history. His election came at perhaps the most important moment in U.S. banking history. The Great Depression had been great by the time of his inauguration for many years, despite the optimistic and often repeated protests from Herbert Hoover that the Depression had already ended if only the economy and the public would cooperate. But the slow burning of banking crises that began in 1930, that had turned into a raging conflagration by the long winter of 1932 and 33, had changed all of this. By the time of Roosevelt's inauguration, the nation, the financial system, indeed the world, was in shambles. Recall that Hitler's ascent to the German chancellorship and FDR's inauguration were separated by just 4 weeks. In a rumble, thousands of banks closed. In a stroke, all of them did in the great bank holiday of 1933. And for that, let me turn to the man himself. Let's hear what he had to say about this.
My friends, I want to talk for a few minutes with the people of the United States about banking, to talk with the comparatively few who understand the mechanics of banking, but more particularly with the overwhelming majority of you who use banks for the making of deposits and the drawing of checks.
We'll stop right there. I share this with you because this is, it's fantastic to hear Franklin Roosevelt in his very first fireside chat delivered at 10 p.m. at night. Nearly every American crowded around their own radios and storefronts or others to hear this unique institution, something that Roosevelt had started as governor of New York, but then he instituted more widely there. But think for a minute on what he just had done. This was at the end of the bank holiday, not the beginning. Confusion reigned supreme. The bank holiday began in February with state declarations in Michigan and elsewhere, and turned into a place where, in the great euphemism of government bureaucracy, banks were just on holiday, right? You could enjoy their services when they returned. The story that we tell about the bank holiday of 1933 goes something like this. It performed the same function. Here I'm quoting historians Charles Beard and George Smith, who wrote about it just a few months after the fact. It performed the same function, they said, as a slap in the face of a person gripped by unreasoning hysteria. So the idea is that Franklin Roosevelt, with his prestige coming on the heels of his extraordinary electoral victory, had seized control of the situation and shook people free of that unreasoning hysteria. But this isn't correct. This required a very specific kind, not just of government announcement. Herbert Hoover was really good at government announcements. It was a specific kind of government policy that was deployed, and because deployed, it was further developed and entrenched. And that policy was bank supervision. And here I'll make a plug for my forthcoming book, as Ben mentioned, on the history of bank supervision. It's called The Banker's Thumb, A History of Bank Supervision in America, co-authored with Sean Vanatta. I expect all of you to buy it, and 20 copies for your beloved ones when it's finally up. No, Roosevelt couldn't command peace. Hoover had proven that again and again. What he needed was technocrats and policy to make it so. The technocrats were bank supervisors, and the policy was essentially massive, unprecedented, extraordinary concentration of the banking industry. Over the course of these panics, fully 10,000 banks closed. Here's a zoom in on that section of the of that history. Now, when I say 10,000 banks closed, let's be clear, very few of them were fully liquidated, turning the depositors back to their mattresses. Nearly all of them meant that a flood of deposits that had been removed from the banking system from 1930 to 1933 were reversed in a great flood of deposits into the banking system. They just flooded into a world with vastly fewer banks. Now, this move to sometimes ask, sometimes compel private actors to act as instruments of policy, to concentrate and collaborate their way out of crisis, was a hallmark of the New Deal. It was an unconstitutional one, in fact, as the Supreme Court ruled in a ruling that still stands, unlike some of the other New Deal era Supreme Court decisions, that this kind of delegation to private sector to sort out their own problems was not going to be that feature. But in banking, that idea mostly stayed there. Here I'll foreshadow a little bit my discussion of the 2008 financial crisis. Now, herein arises the first well-articulated principle of bank merger policy beyond mere unit banking protections. Banks must merge to save the financial system. Now, as so many stories about banking must do, here emerges the long shadow of Mariner Eccles. Eccles, who seemed to take real delight in fighting with almost everyone, had a big fight that defined the way we think about bank merger policy even today. And if you're curious about how hated he was in the FDR administration, in which he sort of served as the Fed chair, go ahead and look up Henry Morgenthau, who was the Secretary of the Treasury during that period. His journals, he was a copious journal writer, are available online. Search for Eccles' name. It shows up hundreds of times, and I think you can find at least one positive mention. Now, one of Eccles' great antagonists was this man, A.P. Giannini, another great figure of importance and color in banking history, the father of Transamerica, Banca d'Italia, which eventually turned into Bank America, and then eventually Bank of America. Giannini adopted the bravura and promoted the image that he was the people's banker, so persuasively, in fact, that Frank Capra is rumored to have based George Bailey on him. Now, not everyone felt this way about Giannini. His aggressive sales tactics to small dollar depositors offended the financial incumbents whose business he stole, sometimes quite literally. He used a network of spies who would pilfer client lists from rivals. If you let AP on the loose, said one new dealer in 1937, he'd have 1,000 banks under his belt before you could say stop. And I'd add not just banks, but salmon fisheries, canneries, farms, all kinds of commercial interests that seemed in flagrant violation of the law. By 1945, over 4 million Californians were his clients. If you're wondering, there were only 9 million Californians total. Now, Eccles himself is reported to be the very organizer of who's the very first organizer of a bank holding company in the United States, was appalled by these actions by Giannini on essentially traditional progressive era antitrust grounds, meaning that the pre-New Deal vintage of antitrust. Eccles asked the Truman Justice Department to look into Giannini's empire, but they refused to do so. So he took matters into his own hands and authorized the Federal Reserve to sue under the Clayton Act. And it was a spectacular failure, legally and personally. Legally, the Third Circuit gave the Fed such a drubbing for getting basic arguments about facts and law so wrong. To our 21st century sensibilities, it's a painful opinion to read because you wonder how on earth they could have made the arguments that they made, where they badly defined markets, they badly defined products, they badly defined competitors, and they essentially said, we do not like this, give us the authority to stop it, which the courts did not do. Personally, it was probably the move that cost Eccles the Fed chairmanship. He was publicly humiliated by Truman shortly thereafter, and Giannini was an extremely well-connected Truman Democrat. Now, that takes us then to this arrested development of what might have been a different trend in bank merger policy that feels in neo-Brandeisian views that are redolent of the Biden administration's new commitments. And that is, what would the world look like had either Eccles been better advised by more competent antitrust lawyers rather than banking lawyers advising on antitrust, or what would have been if the idea of this kind of extraordinary concentration in the banking sector been stopped under traditional antitrust grounds. Well, that didn't happen, and that takes us to about the 1960s. In the 1950s, the unit banking lobby roared back into attention. There was a long budding sense that all was not right in banking, that unit banks needed more help than they were receiving from the US government, and I do not know where this comes from. This is not a period of substantial bank consolidation. This isn't a period of a lot of new charters, as would come a little bit later. But it was a period where unit bankers had convinced their political allies that this was a major focus. The first result was the Bank Holding Company Act of 1956, for which most everyone voted and even more people hated. And then eventually the 1960 Bank Merger Act. This Merger Act, which has been quoted a few different times over the course of the day, was meant to answer two questions that Eccles' misadventure with Transamerica had posed squarely, if ineffectually. And the first question is, how should bank mergers be evaluated? And the second is, by whom should such mergers be evaluated? Now, today we've almost taken these questions for granted, but I hope that you don't. There is a genuine conflict here on both of these questions. Now, how we've explored pretty thoroughly in each of the four panels. By whom is subtler and more difficult. Now, if the federal government had not answered these questions well, states had not answered the questions very well either. Here is an excerpt from the congressional hearing preceding the passage of this act. Here, what we have here is the display of each of the states and each of the reasons for that states were meant to consider bank mergers. From public interest to capital structure to other to conformity with state law, and on and on. Federalism was no laboratory of democracy. It looked much more like a not very well organized construction site. And the Bank Merger Act was meant to bring clarity to these very questions by organizing what should motivate the government when they see something like Transamerica to say, this isn't working. Well, the act was passed. And the factors that were to be considered were, number one, effect of the transaction on competition, but also the financial history and condition of each of the banks involved, the adequacy of its capital structure, its future earnings prospects, general character of its management, the needs of the community to be served, and whether or not its corporate powers were consistent with the purposes of the act, which, all taken together, the approving party should not approve the transaction unless, after considering all such factors, it finds that the transaction be in the public interest. Now, I'm a lawyer in addition to being a historian, and I know that when Congress gives an agency a list this long and this complex and this ill-defined with this many tensions, they're basically saying, hey, agencies, we have no idea what the hell we should do. You figure this out. So if the BMA was meant to resolve these questions, it in fact didn't. The first legal test, and to answer the question, who should resolve the question of bank merger policy, the answer that was not comfortable to the bank agencies was the DOJ, which held that power. What they wanted was exclusive control, and they thought they had gotten it. The act gave over to the agencies, Comptroller for the national banks, the FDIC for state non-member banks, the Fed for member banks, and bank holding companies, the initial approval power, with an advisory opinion from the other three actors, the two other agencies, plus the Department of Justice. And that is not what happened. In its first legal test, a merger that the Comptroller approved, but the DOJ immediately challenged in court. And the Supreme Court sided with the DOJ. The case hinged on whether the 60 Act had in fact given the authority to the Comptroller to decide federal antitrust policy, and whether that policy could be resolved by giving attention to factors other than competition. The DOJ said, no. Well, you just heard the Act. Sounded like Congress said, yeah, or at least they punted to say, we don't know what to do, the agency should figure it out. Justice Brennan wrote this. The Act, the Bank Merger Act, had not immunized approved mergers from challenge under the federal antitrust laws because no express immunity is conferred by the Act. Congress had not used magic words. Those are my words. Banks are hereby not subject to antitrust laws. And because of that, here are Brennan's words, the Clayton Act could not be repealed by implication. Now, here's where Brennan gets interesting, writing again for the majority. He makes equally quick, if somewhat dubious, work of the argument that other factors beyond competition could be considered. He said the idea that, the case was involving Philadelphia Bank, the idea that Philadelphia needs a bank larger than it now has in order to bring business to the area and stimulate its economic development is irrelevant to the court's conclusion, despite the specific and explicit authorization for the agencies to consider such factors. It was an anti-competitive merger, the majority concluded, And such a merger is not saved, here I'm quoting the court, because on some ultimate reckoning of social or economic debits and credits, it may be deemed beneficial. A value choice of such magnitude is beyond the ordinary limits of judicial competence, which of course, by making the decision they made, they usurped for themselves exactly that value judgment. Now, through all of this disarray, let me introduce my favorite comptroller of the currency after Mike Sue, which is James J. Saxon. This is what we'll call the Saxon invasion of the comptroller of the currency. I asked Ben earlier how well James J. Saxon is remembered, and the blank look on his face made me think he's not well remembered at all. And that makes me sad, because he is one of the most important figures in comptroller history. Let's just say that Comptroller Sue's famously deliberative, thoughtful, and scholarly and collaborative approach to hard problems is exactly the opposite of the ethos of one James J. Saxon. He picked fights simply, it seemed, for the joy of picking fights, and antitrust was his main target. When Robert Kennedy, the president's own brother, the president who had appointed James Saxon to his office, authorized lawsuits against mergers that Saxon had approved, Saxon publicly attacked the Kennedys. With those fellows, meaning the RFK DOJ, whom he characterized as antitrust zealots, it is antitrust laws first and the 10 Commandments second. History doesn't record RFK's response. Now, Saxon's critique is a fascinating one and an important one for those of us who see antitrust as the key to improve American competition. Small local community banks had a way of becoming sclerotic wards of the state, he thought. He wanted mergers to allow efficient banks to enter markets where other efficient banks had also entered markets. He wanted to end the practice of local monopolies through small banking footprints and revitalize banking to be more daring, riskier, more profitable, more innovative, and less dependent on the government. He said, we want a dynamic, thriving, risk-taking business, and if it becomes riskless, the government may as well take it over. He was also an unapologetic liberal. He viewed the stranglehold that community banks had as a bastion of Republican politics. He viewed racism in the financial sector as being a problem of community banking, choking out in what we would call today financial inclusion. He thought the banking sector, through a revitalized chartering and merger process, would be and should be the instrument for accomplishing the goals of the Great Society. And so Saxon, facing so many defeats in the courts, started giving out national bank charters like Tootsie Pops. He started approving new lines of business for existing banks that allow for better competition where mergers weren't approved. He started organizing bankers to lobby Congress and try to obfuscate his role in doing so. And that was rightly a major scandal that won him very few friends and many enemies. Now, I'm going to skip a little ahead because I'm interested in taking your questions. I'm going to note that the 60 Act and the Supreme Court decisions that followed led Congress to say enough was enough, and in 1966 they passed a new act, the Bank Merger Amendments, the Bank Merger Act Amendments of 1966, and this led to a major scandal on the front pages of newspapers where people who cared nothing at all about banking became extremely interested because Democrats in the House of Representatives who had received the bill from the Senate, which basically took the DOJ out of the business of bank merger review, organized a coup against their own leader, Wright Patman, the chairman of the House Banking Committee, in what he called a sneak Pearl Harbor type attack on the nation's antitrust laws. He said, if you exempt banks from antitrust, Patman argued, you might as well shoot the policeman in the corner. This is precisely what they had wanted to do, except instead of shooting the policeman, they wanted to shoot Wright Patman. I'll spare you the details. It's pretty juicy and involves quite a lot of cloaks and daggers, literal cloaks, metaphorical daggers. But eventually, the Merger Act amendments were passed, and you remember the 60 Act as I read it to you. Listen to what Congress said in the 66 Act. I just love this so much because it's mostly incoherent. The responsible banking agency, exactly the same, along the same lines. National banks for the Comptroller, state non-members for FDIC, state members for the Fed, could not approve any proposed merger transaction whose effect may be to substantially lessen competition. Okay, it seems like we're onto a good antitrust DOJ type front. unless it finds that the anti-competitive effects of the proposed transaction are clearly outweighed by the public interest, and the public interest is defined by a series of factors. They just took the words and just changed the order, right? It's basically legally the same thing. Now the DOJ no longer had to give advisory opinions. It seems like they were given the boot from antitrust review, except they still had 30 days to challenge that very merger in court, and they could choose to use either the Clayton Act, the Sherman Act, or the BMA. Now, I'm a lawyer as well as a historian, and as I stand here today, I have no idea what this jumble of words in 1966 was supposed to do that was different from the jumble of words in 1960. But you can see is that the table set from the bank holiday to the bank merger amendments is still the table at which we have dined today. These intellectual debates about what bank merger policy should be, is it different from antitrust considerations? Should it be? The relationship between public necessity and the effect of lessening competition. Does considering a factor mean doing something about it? All of these questions that we've been debating today are exactly the questions that they could not resolve beginning in the post-New Deal era. The structural conflicts between and among these various impulses and ethoses remain with us today. And the rest of the 20th century only reaffirms that central tension. By the 1980s, the Borkian revolution in antitrust was complete, which coincided, and I use the word deliberately, it's a coincidence, with the bank antitrust ethos that wanted banking to be left entirely to the domain of banking agencies. The question was not consumer welfare standards, as the Borkian revolution would have it. The question was fire the DOJ from having anything to do with what we, the Comptroller, FDIC, and the Fed, were focused on. Consolidations continued at an even faster pace, even in the midst of significant upheaval. The S&L crisis illustrated small financial institutions could still be both incredibly costly for the government and for the stability of our politics. And the solution was, as in the 1930s, to merge our way out of that problem. By 1994, the old time-honored and uniquely weird American tradition of unit banking was dead, killed with bipartisan enthusiasm. The era of big government seemed over, but the era of big supervision and big banking had only begun. The 2008 crisis, as Raj Cohen explained this morning, was the reinstitution of big bank mergers as an instrument of government policy, what my colleague David Zering has called regulation by deal. And now, as we heard this morning from Sarah Miller, an unapologetic Democratic president has changed tacks on just what bank merger policy should be, tethering it anew to traditional principles of antitrust, going back to a tradition that has been out of vogue for many decades. And so now, where does this leave all of us? Let's turn again to some of the questions posed at the outset. We don't have a handle on who should decide and how. In a coming day, there will be a conflict I make as the prophecy, a prophet of old, based on no inside information whatsoever, between the DOJ and the banking agencies. Whether that conflict will be in private or in public, that conflict will come. And the law gives us very little sense of who gets to win the dispute. The law gives us a sense of the orchestration. To paraphrase a label applied to the Constitution, I will say that the bank merger laws are an invitation to struggle, but not its resolution. Now, how should we evaluate these mergers? Well, remember our old statutory list. The Clayton Act hasn't really changed, nor have the standards for bank merger acts, even as one or two phrases have been added or clarified. And so the question is left then to some of the people in this room to decide how priorities should be done. Is it by focusing on the anti-competitive effects, consumer protection, safety and soundness, exposure to Sam Bankman-Fried? Well, you get the idea. It's a choose-your-own-adventure model. And my question to some of you who have the policy-making power is, which adventure are you going to choose? That'll be up to you. And this, I think, is one of the most important saving graces of bank merger policy. Some people would dismiss this as lawless. There's no transparency, there's no consistency, there's no rule of law. It depends on who is sitting in the seats and who can put their hands on the levers of power. But do you know another name for this? It's called democracy. Right? It's called politics. It's called elections. And when the elections occur, they have consequences. And so it is that the bank merger laws give ample space for politics to do what politics does best, which is sort, which is allow in the great inscrutable mix of the American cake-baking competition, we see all the ingredients that come in, and what comes out is one candidate is elected, the other is not. And the elected president gets to choose the adventure in bank merger policies. Now here, let me just say, I want to conclude, I'll just end this slide. Let me conclude just with two extra other points and then open it up to questions. I told you that I was going to destabilize some of your priors. I hope I've already done so, but here are the places where I would do the most. When I hear Democrats stoutly defending community banking, it puts my historian head on a swivel. Community bankers, just from a purely partisan political perspective, as I already mentioned, are the historical stronghold of Republicans. And now banking, generally, of course, is somewhat of a Republican stronghold, but not in the progressive era, where in the big cities, the big banks were mostly affiliated with the Democratic Party. But beyond just the naked partisan political context, my head's still on a swivel when I hear community banks being held up as the great model here, because of something we learned from James J. Saxon. He argues, again, that the moat created around community banks, the protection from competition, leads to monopoly, racism, entrenchment, lack of innovation, and an expensive business model that is born not by the government, not by the bank, but by the very people it meant to serve. And here's a fun fact. Does anybody know the first African-American bank examiner who was here at OCC in 1964, the very time that James Saxon was there? Roland Burris, who would become even more famous as the man who succeeded Barack Obama in the US Senate, whose appointment to that body also wrapped up Rod Blagojevich's political career, which ended in criminal prosecution. So it all comes back to bank supervision is my point. So is Saxon right? Does enthusiasm for local community banking still have the partisan political content in it that today's Democrats have either gotten wrong or reversed themselves on their priorities, or is it something else? Now, lest my big bank friends get too comfortable, you've got some explaining to do as well. Bank CEOs today hope that quick approval of their mergers are not only good for their shareholders, good for them, but good for America. The idea is that such concentration is required for efficiency, for American competitiveness, that big American economies require big banks to be globally relevant and competitive. And bank CEOs have always made that argument. And I think it resonated more in an earlier era than it does today. Is this still true when we have so many alternatives to traditional banking services to service a thriving American economy? And I don't just mean the so-called shadow banking system. I mean our deep and highly liquid capital markets. If the sine qua non of anti-competitive mergers to the tendency to lessen competition, then the idea that a combined bank will extract super competitive profits at the expense of consumers still sounds like not a good reason to allow a bank to go through. But if the idea is that we allow this to go through because we need giant banks to do the business of our financial stability policy, just to quote one example, doesn't that tell us something more about our financial stability policies? In other words, it seems to me that we should think about a financial stability policy that doesn't require that sort of structure that can extract such super competitive profits. Now, as I said at the outset, I don't have the answers to any of the questions that I've posed. I only know that we've been asking them indeterminately for a very long time. Now, speaking of questions to which I don't have answers, let me now open it up to all of you.
Professor, that was excellent. Thank you very much. I guess using all the historical and legal knowledge you have, if there was a pending bank merger that you didn't like, what levers of power would you use to stop it from getting approved?
So what a great question. I appreciate it, because I want to be really clear about something. When Congress has done, as it has done time and time again, not just in antitrust policy, but in consumer financial protection, in AML, in safety and soundness, in CRA, what they have done when they have encountered a hard problem of banking is punted ever more responsibility to bank supervisors. Bankers hate this. Greg Baer basically, he starts foaming at the mouth a little bit when he thinks about bank supervision and all the unaccountable power that they have. But that's exactly what Congress designed. Congress built it this way. And so what I would say to that question is, what would you do in the face of a merger that you don't want? I'll say the same thing, especially the banking agencies, to a lesser extent the DOJ. The banking agencies can do whatever they want. The legal authority is so ample, it's so spacious, that while the judicialization, Raj Cohen cited a very famous Eighth Circuit case, but note that he cited an Eighth Circuit case, right? It is the idea that there's got to be very specific ways in which these things relate to each other. Pay attention to the great Eighth Circuit, but recognize that Congress has given you substantial authority. So if you want to follow the Borkian tradition and look exclusively at consumer welfare, which means a rubber stamp on every merger that crosses your desk, you're legally allowed to do that if you're a bank regulator. And if you want to pick fights with virtually any bank merger, the statute gives you the authority to do so. So there's an awful lot of room, which is one of the reasons that bankers don't like bank supervision so much.
I think we have another question.
Sorry, I'm supposed to repeat the question because we're mic'd in the room, but not on it. So I hope the question was clear. If you were a regulator and there was a merger that you didn't like, what would you do? That was my answer was to that. Yeah, Jonathan.
I wonder, have you thought as a historian what we may learn by looking abroad? These questions that you ask, we may have failed to answer them definitively, but banking has been around for much longer than the US has. And these struggles are faced in Europe as well.
Yeah.
And in comparison, I think that the large banks in the US have suffered less compared to European banks after the financial crisis. So there may be something that, even though we can't answer these questions particularly well, that the US is doing right.
Oh, sure, absolutely. I hope nobody's heard me condemn America for its approach to this. It is uniquely American, the approach. There are two things that make this the comparative analysis of bank supervision generally and bank merger policy in particular very hard to do and much less, generating much less informational content than you would expect. The first is this long and tortured history with unit banking. It is the DNA of American banking policy. And even though there are a few folks who were doing a brisk business in banking in the unit banking era, pre-Regal-Neal 1994, most of us today were not so engaged in that space, and yet we are still hung over by the drinking that was done at that point. And other countries, other federalist systems, be it Switzerland, Brazil, Canada, now Europe, have just simply not approached this in the same way. And so we don't get the same volume of banks. We don't have the same in these other places, and that creates a real set of issues. The other thing that's almost uniquely American is bank supervision was invented in the United States, essentially around the New Deal, but arguably, depending on how one defines it, at least from the Civil War when this great office was created. And what I mean by that is that we've always had central banks that engage in a kind of examination and supervision, especially with counterparties with respect to note issuance. But the enterprise of a one-to-one supervisor to bank ongoing examination and supervisory relationship was uniquely American until the early 20th century, at which point it was exported to Sweden, Japan, and elsewhere. And then it kind of grew up on its own vector there, and so we get a very different kind of set of institutions. So comparative work here is really important. There's some new work that's just been done on bank supervision comparatively, but the path dependence of the US model makes it pretty hard to generalize or to import good practices from abroad and vice versa, to recognize the great things that have been done in the United States and exporting them elsewhere has been complicated. I think we have time for one more question.
So, quick question. Do you think any of this would change or be alleviated if there were only one federal banking regulator, whether it be under a board or a single administrator?
So Sean Bonata and I count 19 such major legislative efforts, beginning almost immediately after the Federal Reserve was created, which created a fractured federal supervisory approach. So I'm going to take the theoretical question, then I'm going to get back to some earthy practical politics. On God's green earth, it will never occur. You think the CFTC, SEC consolidation thing is not going to happen? This building, your jobs are secure, right? The Fed and the FDIC and the OCC will continue to bicker amongst themselves long after the earth is too hot for human habitation. Would it be different? Would it be different? I think it would be. I think what we would have is less the historical fight that is often happening between and among the FDIC, the Fed, and the Comptroller is the Fed is obsessed with stability and liquidity, the FDIC obsessed with the Deposit Insurance Fund, and the Comptroller obsessed with generating new charters. That's the kind of sense for national banks. And I think that as far as conventional wisdoms go, this is a pretty good one. And so what you do with a single consolidation is you just have a focus. And what would that focus be? Hard to tell. It's hard to imagine that it would be something other than a Fed-dominated approach to stability. But if in the 1990s version of this was a federal banking commission, the FBC, it would hive off all supervision and regulation away from the Fed. And so maybe then that approach would look something a little different. Here the comparative example is really good. We're exceptional in having this kind of approach. The supermajority of countries do not. And the consequences for stability and elsewhere are not really clear that there would be that difference. What I think is good about these differences is that when you have a motivated comptroller who is seeing the world differently from a motivated FDIC chair, Fed chair, or vice chair for supervision, as the case may be, then there are things that can be done unilaterally. The comptroller doesn't need to wait for the Fed chair before making a decision on a national bank, similar for the FDIC and the Fed relative to the others. And so I think that at least provides an opportunity to generate some different traditions in bank merger antitrust as elsewhere. Ben, I've taken some of your time, so I'm going to stop right there. Thank you so much.
I think that deserves at least one more round of applause. Professor Conti-Brown, thank you for the incisive, thoughtful, and helpful remarks. I'm going to try to sum us up very quickly because I know many of you have other places you're probably headed to. Just wanted to reflect for a few minutes on the complex web of issues implicated by bank merger policy that we heard about today. I personally found them very helpful in informing our ongoing debate about the effects of bank mergers on competition, financial stability, and the convenience and needs of our communities. Interestingly, I don't know about the rest of you, I did see some common themes and tensions today. Throughout our panels, I heard calls for being driven by data in our policy decisions, for greater transparency and greater predictability. That is, of course, in complete tension with what Professor Conti-Brown just told us. So I think we'll have a lot to think about. On the topic of competition today, we heard about the significant debate regarding calculations of various metrics to measure competition, as well as the extent to which growth in online and mobile banking and the rise of non-bank competitors should be considered. We heard about whether consumer harm is more attenuated at banks of certain size, the importance of consumer choice and its effect on competition, and whether deposits are still a good proxy for our competitive analysis. With respect to financial stability, we heard an important debate regarding whether and how to consider resolvability and how existing resolution regimes should be assessed within existing frameworks. We also found, to my surprise, that perhaps Randy Quarles and Graham Steele share a certain bond in spirituality. Randy, I heard Randy invite us potentially into his inner spiritual world, and Graham talked about Delphic oracles. And by the same token, Dan Ari and Tim Clark both seem to share an interest in equine metaphors. So we will continue to reflect on this. More seriously, though, we have a lot to think about in terms of the effect of technology on our banking system and a debate about the significant ambiguity around how Congress has defined the financial stability factor. Last but not least, we heard about the impact of mergers on communities. That's also an issue of significant importance. There are fundamental questions for us to address regarding how to define community in this context, as well as a debate regarding how best to evaluate whether the needs of a community are being met. I took particular note of the beginning comment from Pat McCoy about the important principle of the government providing for an impartial allocation of credit in the United States. As we mentioned earlier today, our goal is clear. That's to identify a potential framework for analyzing bank mergers that reflects changes in the banking system, the competitive landscape, and the country's demographics in order to affect merger outcomes that benefit communities, enhance competition, and support a diverse banking system. The optimal pathway to achieving that goal, while also ensuring that any enhancements are realistic and timely, will be the focus of our further work in this area. To return to where we started, I'd like to thank everyone who contributed to the success of today's event, Professor Conti Brown, our panelists and moderators, staff from the Board of Governors of the Federal Reserve System, the Federal Deposit Insurance Corporation, and the Antitrust Division of the U.S. Department of Justice, the lovely OCC staff who executed the symposium, and of course you, our audience, for attending in person remotely. Good night and safe travels.